forecasting for inflation next year and what they're forecasting for the Fed funds rate next year, the unemployment rate and the inflation rate we have that right now. And they have 100 basis points of cuts next year. So I would argue that you've pulled forward all of this. You've pulled forward the slowing in labor. You've pulled forward the slowing in the unemployment rate. So I think there is justification for pulling forward this 100 basis points worth of cuts that they actually are forecasting for next year to this year. So to me, that's the sort of the right calculus of it. I would actually also argue that, when you think about cuts, even if, and again, it's not our forecast. We're not saying they're going to do 100 basis points worth of cuts, but I have a lot of sympathy for the idea, which is what the market is pricing in. I think what we have to keep in mind is even at 100 basis points, if you cut 100 basis points, the Fed is still restrictive. I mean, that's sort of the interesting thing. Policy was calibrated or is calibrated for a meaningfully higher inflation rate and is calibrated for a meaningfully lower unemployment rate. But those things have now moved.
Okay. That said, you have to wonder if this is incredibly restrictive, why the economy isn't feeling it, why you're seeing an acceleration in retail sales.
Yeah. So what I would say is that there have been so many buffers in place, right? Like if you think back to how this whole thing started, all that fiscal stimulus, all of that excess saving, the idea that there was a wealth effect because home prices were rising a lot, equity prices were up a lot. This made people sort of exist in this feel-good environment, and I think that really sort of propelled consumption in so many ways. So I would argue that the hikes that we saw, that aggressive tightening cycle, really didn't have a chance to sort of clamp down because of all of those sort of extra factors that were in play. But I would highlight that you are starting to see delinquency rates on the rise. Modestly, but they're rising. You are starting to see the unemployment rate rise. Again, it's still relatively low, but it's up 0.7% at this point. So I think you're starting to see some of the tight policy now start to show through.
Well, it's this idea that you're not cutting to react. You're cutting just to get us in the right place.
Yeah. That's
when
right.
you think about rate cuts, what even is that line? Because I know you're saying just with the Fed's projections, 100 makes sense.
Yep.
Or is the idea of cutting 100 basis points something that looks like a recession? Where's kind of that cutoff for that level?
Yeah, I think it's such an important idea. And that's why I think, and I've said this before, I think when the Fed starts cutting, I don't think, classically when the Fed starts cutting, it's like, it's over, right? The recession is here. I don't think that's what this is. I think the narrative coming from the Fed has to be, hey, look, we're just looking to extend the cycle, right? We're looking to extend the expansion. I think, so the Fed has a real opportunity here to sort of shift the narrative. And I would argue that they're starting to process this now. When Powell finally shifted to focusing on labor over inflation, which I would argue is long overdue, I think that's step one. And I think the next step is, hey, look, we don't think that things are really sort of slowing in a notable way, but we recognize that policy is calibrated for a completely different inflation regime than what we have right now. And so we can take back some of that aggressive tightening.
Well, Raphael Bostic is certainly one of those individuals that is starting to recalibrate. But if that's the case, and they're going to message that this isn't a deterioration, but we're trying to land the plane, how do they do that before the U.S. election?
So I love this question, and I have we've done this analysis, as I'm sure so many others have. We went back, and we just went back to 1984. It seemed like a fine round number. We looked at every single election from 1984 through to today, and what you see is that history, that modest history, is littered with examples of the Fed adjusting policy during election years. In fact, not just during election years, but in and around the election month. All they needed was the justification from a data perspective. And I would argue that the unemployment rate being up as much as it is, inflation being down as much as it is your justification.
How do we know, though, that it isn't actually headed in the other direction, that we already saw the slowdown, especially because jobless claims are actually going down? And you're seeing, for example, Walmart increasing its expectation for profits. You're seeing companies actually doing better out of the 493 other than the Magnificent
UK interest rate futures show a 34% chance of a Bank of England rate cut in September, down from 40% on Wednesday.
Turbocharged by rate cuts.
So it's again, a super important question. And what I would say is Walmart is maybe the exception to what's going on broadly, right? Because we know from a lot of other retailers that things are starting to feel some of the pressure of a consumer that's really looking around for value. And if Walmart's really the value player, then it actually makes a lot of sense that they performed well. And I didn't look at the numbers directly today, but I heard that they did pretty well. So I think that is an important idea. But again, I think this is exactly my point. I think let this continue to roll out, right? Let the economy continue to sort of expand by just removing some of the aggressive tightening that they have in place. I don't know that unless you think that inflation is going to reaccelerate to 4 handles, which is what this policy is calibrated for. I think the
futures rates odds of Fed easing 25 basis points in September to 74.5% after the strong data, from 65% late on Wednesday.
Just keep in mind when we think about inflation, just think about how labor is doing. The unemployment rate, again, I hate to say it again, but the unemployment rate is up. But in combination with that, hours are down. I think Mike mentioned that earlier, but that broadly speaking, hours are down a lot. Wages are down a lot. Quit rates are down a lot. The consumer's not feeling that great about labor right now. And if you think about the thing that really does the driving from a consumption perspective, it is the unemployment rate. The unemployment rate rises and consumption tends to slow.
Just quickly here. Yeah. What would you have to see in the non-farm payrolls report in September to change your view? So
I think that you need a dud of a report, right? Like, I don't know how you quantify dud. I fully acknowledge that. But I think you need a number that really sort of, that has even worse contours than the one that we saw last report. And I think if you get that, I think that's the Fed's justification for going 50.
Tom Porcelli of PGIM Fixed Income, always wonderful to see you. Thank you for being here.
Thank you.
We are seeing, if you are just joining us, jobless claims came in below expectations. People looking for some sort of increase in the jobless numbers. 227,000 versus 233,000 the prior month, the prior week. We also are seeing retail sales defy all expectations, coming in at 1% versus the expected 0.4%. Markets are seeing good news in equity markets, bad news in bonds as people retrace some of the rate cutting expectations. Joining us now is Matt Miskin of John Hancock. Matt, what's your takeaway from these reports?
I think we're going to get another opportunity to embrace bonds here as they back up. And frankly, we think the dollar here stands to actually benefit and rebound after a lot of weakness. Over the course of the last week or so, we've seen Eurozone ZOO do worse, Eurozone industrial production do worse, but the euro has been crushing it. And the dollar can't seem to buy a bid right now. Well, lo and behold, we've got strong retail sales. Initial jobless claims down to 227,000. That is awesome. The music is still playing. High yield spreads are going to contract on this. And for now, we're in good news is good news land.
Matt, can I just ask, do you think we would have seen this market reaction of yields on the front end up 11 basis points, the strength in the dollar you're talking about, small caps up some 2%, by all accounts, a large market reaction? Do you think it would have been different if it wasn't August, if it wasn't the middle of the summer, and we were all back at our trading desks?
I think it would be. We are now back to good news is good news, and in our view, and we're moving out of that really conundrum type market responses we used to get, where it'd be like, okay, this is bad news, but now all of a sudden rates are lower. That's helping small caps. Good news is good news again for growth. For an asset allocator, that's great news. It's been really messy from a macro standpoint because you get a long-dated Treasury rally and small cap financials doing well. That is a weird asset allocation mix. But now we're seeing that basically longer-dated yields coming down is not necessarily good for growth. We're seeing defensive equities. You look at the guts of the market, it's defensive equities that are doing well. And so, I think it's actually good from an asset, I guess from our perspective, is that it makes sense. It's logical. And for investors, I think that's a good thing because for their portfolios, that also makes a lot more sense.
Well, one of the things that people had cheered last week for their portfolios is finally bonds can act as a hedge, that the correlation is broken. You do see the correlation this morning of stocks up, bond prices down. But Matt, if we're not in an environment of a recession and we're not worried about growth necessarily, does that interplay hold?
We think it does. And frankly, the Fed, you've had a lot of guests on this morning.
So that's Fed fund futures now showing odds of a 50 basis point cut in September fall to around 23.5%.
It's overly optimistic, looking for 50 basis points per meeting through the end of the year, and really looking for 100 basis points in cuts. We actually would underestimate that, look for less cuts in the short term, more cuts into 2025. Now, we're not trying to get cute with this. The bond market's going to see some volatility around this. We would still embrace intermediate, higher quality bonds for 2025, where we think we're going to get more returns out of it. But for now, just get the income. We're still going to get about a half of 2.5% in income to the end of the year. Just be careful, just be happy with that. And then we're going to likely get more returns. But for the meantime, we actually think the dollar gets a nice bounce here. We think that some of this rotation out of the dollar is overdone. And so that's what we look at tactically in the short term.
Well, Matt, at the moment, it looks like the market agrees with you, and it's not trying to be, in your words, too cute, with Fed swaps pricing in less than 100 basis points now after this data for 2024. So what are you expecting in terms of the totality of cuts for this year?
And I think 3, just, even a quarter basis point per meeting, and even maybe just a quarter basis point, and then, a quarter of a percent, 0.25, and then maybe even another one. We skip maybe even November and go to December. Look, it's the beginning of the cutting cycle. Either way you want to put it, that's going to be bullish for bonds over time. But we don't think that right now the economy is screaming for the rate cuts. We've had people come on asking for a 75 basis point cut on the back of not even a 10% correction in the S&P. We think that's overblown. So just be patient. We don't want to, let the politics get in the noise. And look, if you get another opportunity to embrace bonds as yields back up, we would take it. We actually want that right now for our investors as we set up for 2025.
Matt, I feel like you're having this conversation a lot with clients. Is that basically what you're talking about with them? That they say, is the sky falling? Is the Fed going to come in and rescue us?
Yeah, so we talk to clients, investors all over the country. Most are bearish. It is, hey, the recession's right around the corner. And there's $6 trillion in money markets sitting there. Last year, the most popular investment was cash. This year, it's bonds. Investors are relatively conservative, and what we're just trying to do is say, look, if you like the yields in cash of about 5.5%, let's lock that in for the next 5 years in relatively high quality bonds and a modest credit bias, mostly investment grade, single A corporate paper. And let's get you that for the next 5 years. After that, we could talk about equities. We'll look for cheaper options. We'll look for opportunities, but let's make that decision first.
Well, Matt, if you want them to not be bearish, I think a good thing to do is just show them the data today and show them the market reaction today. We've been talking so much about positioning after the past 2 weeks when there were fears of what was the leverage in the system and how it gets washed out. And Matt, here we are today not talking about it at all. We are talking about the fundamentals of this economy. Do I and do your clients need to still be worried about positioning in this market and potential leverage hidden within the system?
We think that you do. I'm not saying, risk management is always important, and we do think it is very relevant. It's just that right now we're seeing relatively conservative positioning. We're seeing a lot of cash on the sidelines. We're just trying to make thoughtful risk management decisions where we're saying, hey, in a portfolio, can we make sure we get really attractive income for years from now? Can we make sure our equities are higher quality, have access to great balance sheets, great profitability in a lower growth environment? And if we can stick to those quality parts of the market, we think you're going to be better off. It reduces the volatility and also reduces downside risk for portfolios.
Matt Miskin of John Hancock, thank you so much, as always, for your thoughts. Michael McKee has been looking through all of the data points. What stands out as you parse through the details?
Well, obviously with retail sales, it's the shift from discretionary spending into the kind of staples spending that you would expect to see if the economy is slowing down, especially at the lower ends, and of course distorted somewhat by auto sales because of the shutdown of the internet in June. But the other things that stand out are, one, when you look at the jobless claims numbers, the biggest declines over the past week were in Texas and in Michigan. So it does show that it was seasonal factors, the hurricane and the plant shutdowns for autos. And so we're kind of back to where we were before July. And the other last thing I would point out is in the Philly Fed number, like the Empire number, hours worked went down. So what you're looking at is weaker manufacturing and companies cutting back on hours, even if not people, and that too reflects a slowing economy.
Great insights. Mike, thanks so much as always. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. Let's recap all that data we just got, starting with U.S. retail sales advancing by more than forecast in July, pointing to a resilient consumer even in the face of high prices and borrowing costs. Sales advanced 1%, well above the median estimate of 0.4%. Meanwhile, initial jobless claims fell for a second straight week, coming in at 227,000, despite a recent pullback in hiring. Meanwhile, shares of Walmart are up in the pre-market, up more than 8%. The company boosted its sales guidance for the full year as a retailer looks to attract shoppers searching for deals. Walmart CFO saying they're seeing a consumer that continues to be choiceful and value-seeking, but they are not seeing any incremental fraying of the consumer's financial health. It now expects net sales to rise as much as 4.75% for the year against previous guidance of 4%. It also lifted its targets for operating income and profits. Meanwhile, for some employees, remote work is okay. Newly appointed Starbucks CEO Brian Niccol won't be required to move to Seattle when he joins the company next month. The coffee chain is setting up a remote office 1,000 miles away in Newport Beach, California. That's where Niccol's former employer Chipotle is based. Niccol will also receive a $10 million cash signing bonus for joining the company and an annual salary of $1.6 million. Plus, he'll be eligible for annual equity awards worth up to $23 million. That's your Bloomberg Brief. Lisa?
Thank you so much. Yahira, great work as always. Up next, setting you up for the end of the week and the week ahead, this is Bloomberg Surveillance.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show, weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Good news is good news for equities after a retail sales print that came in above all expectations and a jobless print that came in below expectations. That has turbocharged gains on the S&P up almost 1%. And that has actually turbocharged gains to the two-year yield up 14 basis points. Counting you down to the opening bell, here is the trading diary to round out this week and into next. Tomorrow, housing starts and building permits at 8:30 a.m. Eastern. UMich sentiment at 10 a.m. Plus more Fed speak from Chicago's Goolsby coming tomorrow afternoon. Looking ahead to next Wednesday, we'll get Fed minutes on 2 p.m. On Thursday, another round of jobless claims plus S&P U.S. PMIs. Coming up tomorrow, don't miss this. John Stoltzfus of Oppenheimer, Noel Dixon of State Street, Caterina Simonetti of Morgan Stanley, and Winter Caesar of Credit Sites. I got to say, today was a really interesting day, and I'm wondering what your main takeaways were, because for me, it was that the retailer, that the consumer is still able to spend, and this economy is not falling off a cliff.
I'm exactly there with you. There's a lot of strength that I think we underappreciated, given that the retail sales number beat all the expectations, given that Walmart, it's not just people trading down, it's that Walmart has a good strategy to capture everybody. But then those pockets of weakness, there's still a little bit of confusion in the data when Mike McKee talks about more people spending on staples than discretionary. So it's all good, but like every tiny little look, there's something maybe not great.
It's noisy. That's what Mohammed El-Arian said on Twitter, but it does feel like what some economists are saying, this normalizing feeling when Mike says people are going more for staples, not discretionary. Walmart cut prices earlier this summer, and they're still seeing people come. into the stores. I have to say, Harris' campaign is trying to sell price gouging. Not sure this is going to work for some big corporations like Walmart.
Well, it sort of depends on who the target is when you start looking under the hood of what the details of that is. When you take a step back, what I find notable is that people are still saying the Fed will be justified in cutting rates by 100 basis points, even with a jobs figure that's coming in with health and retail sales continuing to expand. We heard that from Tom Porcelli of PGIM Fixed Income. We heard that from Joyce Chang of JP Morgan. Key question, how do they message that? We will be talking about that coming up tomorrow. This was Bloomberg Surveillance.
Day 3 at the Cincinnati Open. World number 1 Jannik Sinner brought American qualifier Alex Michelson's run to an end with a clinical display on center court. 7 aces and 25 winners for the Aussie Open champ in the straight sets victory that took just under 2 hours. Sinner moving on to the 3rd round as he looks for his 5th title of the season in the Queen City. And don't forget, Tennis Channel's daily live coverage from Cincinnati hits the air at 11 a.m. Eastern.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like this, the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
The Vivian Tom clientele.
Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that is empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, they are like in the 20s.
The effective Fed fund rate is unchanged at 5.33% for 14th of August.
Wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
Futures rally hard, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today, but Bloomberg Open interest starts right now.
So in 10 minutes time now at 9:10 a.m. Eastern Time, St. Louis Fed President Musalem speaks on the U.S. economy and monetary policy at Greater Louisville Regional Economic Development Updates. No text is expected, but there will be a Q&A.
Coming up, stocks soar, yields jump across the board after higher than expected retail sales point to a resilient consumer. On the earnings front, Walmart raises its sales guidance as it expects to draw shoppers hunting for bargains, and following the big money, the latest flurry of 13F filings show top investors reshuffling their positions in the AI boom. Let's start with a look at where markets are trading right now. We see gains across the board in terms of futures and yields. So you can see S&P futures right now up 1%, NASDAQ 100 futures up even more, and the 2-year yield climbing 13 basis points, back up over 4% and approaching 4.1. Katie?
Yeah, a lot of action in the bond market at the index level on stocks as well. But let's go under the hood right now because Walmart raised its full-year outlook as it sees growth in general merchandise sales and consumers hunting for deals. Walmart obviously benefiting from that trade down. You also have Deere adjusting its business to weaker market conditions for farmers, but it maintained its profit outlook, and you can see that pre-market Deere shares up about 2%. And finally, we want to talk about Ulta here because the shares on a tear after Warren Buffett's Berkshire Hathaway disclosed a new stake in the beauty company. That stock up double digits pre-market, Matt, currently up about 13%.
Yeah, very interesting stuff coming out of the 13Fs. We're going to get through all of those holdings a little bit later. Bill Ackman also buying 3 million shares of Nike. But first, I want to get to the economic data coming out this morning. There's a lot of it after the blowout retail sales numbers. Here to break down what we see on the EcoGo screen is Mike McKee, Bloomberg's chief international economics and policy correspondent. So I guess initial jobless claims is the one that people watch the most closely.
Oh, I think retail sales will get a lot of attention today because it came in stronger than anticipated, and it does suggest that while the economy might be cooling, it is not falling off a cliff, definitely not falling off a cliff. Now, initial jobless claims did, as Matt said, come in at 227, down from 234. Now, the thing to note there is that the biggest drops were in Texas and Michigan, so it was the hurricane, it was the plant retooling in July, they were seasonal effects, and we're kind of past that now. Companies are not letting people go. Retail sales up 1%, stronger than anticipated. There's a reason for that I'll get to in just a second. Retail sales control, though, that's the one that we take out gas, autos, and building material supply stores, and you get a 0.3
Roughly 2,000 futures, 2.3%.
Last month. Philadelphia Fed, though, drops off down 7. We also have, I don't have it on the screen, but the Empire Index from the New York area also declined, and both of those showed a drop in hours worked, which is what you would expect if the economy is slowing, but it does show that companies are cutting back a little, but not letting people go yet. Import prices, the last thing here to mention, up just 0.1%, no change on a year-over-year basis. So we're not importing any inflation at the moment. Now let's take a look at the difference between retail sales and the control number. The retail sales numbers up by, as we mentioned, 1%, and control a lot less. But look at the GD Now numbers from the Atlanta Fed up above. They're projecting 2.9%. That's probably going to go down, but the retail sales numbers give you some hope that it's not going to go down all that much. In the third quarter, it's not all that bad. Gets the recession talk out of the markets, perhaps. Now, why did retail sales go up so much? Cars. Matt, it's you that did it this time. We had the internet hack of the retail car sales system in June, and you can see there's a lot of numbers there, a lot of categories there, but it's the blue that matters. When you look on the right-hand side there, you see the big decline in car sales in the month of June, big rebound in the month of July as all those cars that didn't get sold. So look for those to even out, and we'll take that out. So look beyond the 1% headline number. And finally, with jobless claims, I would just invite you to take a look at the chart that goes back to the point where we were the pandemic, and you look at the recessions in the past, and you look at where we are now with jobless claims on the lower right-hand corner, you're not seeing any hope for a problem with jobless claims. And I'll give you one last stat because I know Katie loves the economic nerd stuff.
I sure do.
In the import prices number, the international airfares to the U.S. dropped almost 5%, which pushes the PCE
in 5 minutes time now at 9:10 a.m. Eastern Time, St. Louis Fed President Musalem speaks on the U.S. economy and monetary policy. No text is expected, but there will be a Q&A. Live stream does not seem to be available for the event. It seems to be in-person registration only. Also, 10 minutes away now, from 9:15 a.m. Eastern Time, we'll get the US industrial production month over month. Forecast minus 0.3% on the prior 0.6%, with a range of 0.3 to minus 0.9% expected. Year over year, the prior read was 1.58%. We also see the US capacity utilization, forecast 78.5% on the prior 78.8%, and the manufacturing outputs month over month, forecast minus 0.3% on the prior 0.4%.
We had a bad print that would spook the markets. And so coming in and seeing a positive print in retail sales suggests that the consumer is actually pretty resilient. And it's a sign that maybe some of the things that we endured last week and some of the volatility is still not that clear of a narrative. So we've seen a massive shift from focus on inflation to focus on the economy. And I think that's where sort of every data point seems to matter to the market.
Does the economy look like it's slowing down so much that we need rate cuts here, Katie?
I would say that there's enough evidence that we're going to see a cut, but I think that people got a little bit too excited saying 100 basis points, 50 basis points. I think the Fed is going to analyze all this data and really sort of determine, given that inflation has come down, perhaps it might be time to consider a shift in policy, but I don't expect them to have a big jump. And that's why today you look at Treasury yields today suggest the economy is not that bad. So, Treasury yields have come back over 4%, which suggests that, the market is reevaluating those hikes and how much cuts and how much cuts we might have. Sorry, flipped it around.
Yeah, it would be interesting to see what markets would do if we were suddenly talking about hikes. But I actually want to talk a little bit more about bonds, even though we're, 23 minutes away from the U.S. market open, because you saw something interesting happen last week. It felt like bonds were finally acting as a hedge these last couple of weeks. You saw that inverse correlation between equities and fixed income come back into play, and suddenly, once again, you had bonds acting in their traditional role. But is that sustainable? Do you think that we're truly entering back into that traditional dynamic, or was that a head fake?
So in general, I would suggest that you have to think about inflation. Bonds behave very differently when you have to worry about inflation, and they cease being as much of a sort of equity hedge. And now that inflation has abated, we've seen more and more of the classic risk-off relationship between stocks and bonds. And I do think as long as you keep seeing moderation in inflation, and we're seeing that as well in the commodity sector, suggesting that that will continue, that we're going to perhaps go back to more classic relationship between bonds and stocks as inflation is no longer affecting bond markets as much.
So what kind of stocks do you like here, Katie? Because, we saw a rotation for a few weeks in July, and that was completely erased very quickly. Are you broadening out at least in terms of, large cap stocks?
Well, this is a good question because what we have really seen in stocks has been a general parallel decrease in overall conviction in stocks, given the recent volatility. I think we're much more focused on global differences. And what you're seeing now is that the US is still looking pretty strong, while sort of Asia and other places are actually looking a little weaker. So I think the play right now is going to be tricky in individual names, just given the adjustments and the devaluation and then revaluation.
Shortly expecting comments from Fed's Muslim, and also just over 5 minutes away now to expect the US industrial production month over month, which is forecast at minus 0.3% on the prior 0.6%, with a range of 0.3% to minus 0.9% expected. Industrial production year over year, the prior read was 1.58%. Capacity utilization, forecast 78.5% on the prior 78.8%. And manufacturing outputs month over month, forecast minus 0.3% on the prior 0.4%.
Different issues going on there can resolve themselves. So I think that's why I was suggesting a more international positioning. Looking at US still looks better than Europe, and even better than when you look in Asia, where there's been more weaker demand, for example.
And Katie, let's talk a little bit more directly about the U.S. and specifically earnings season, because it feels like this earnings season in particular has been pretty mediocre. You know, we have some big wins. We have a lot of big losses, too, as well. And you think about that earnings picture, you overlay it with what's going on in the economy. Even if we enter into this real Goldilocks soft landing sort of scenario and we stay there, if we have a mixed bag of earnings on the corporate side, can we continue higher on the benchmark level?
I think this is an important point because when you look at where we've been this summer, we have seen a massive shift in sentiment from the markets focusing on inflation and the Fed to now the markets focusing on the strength of the economy and the resilience for companies to get through sort of how do we deal with cuts. And I think that's why earnings could be something that could trigger as well more concern. If we do see weaker earnings, it would be, again, another suggestion that things may be overvalued. And I think that's why we're going to have to watch them closely and see if Q3 turns out better than what we've seen recently.
Well, from one Katie to another, great to get your thoughts this morning. Really appreciate you taking the time. That, of course, is Alpha Simplex Chief Research Strategist Katie Kaminsky. And let's get a check on these futures right now because they are flying. The S&P 500 currently up about 0.8% pre-market. Same thing, too, if you take a look at the NASDAQ 100, up even more so, over 1%. And small caps in the lead, up about 2%, I would say. Let's get a look under the hood with Abigail Doolittle.
Well, one stock that's certainly helping out the futures, Katie, let's take a look at the shares of Nike. They're up more than 5% at this point. This after Bill Ackman's Pershing Square has revealed a new stake. They now have 3 million shares worth roughly $229 million. Apparently, they're planning on taking a quieter approach to help the company fix some of its issues. Of course, tough competition from Adidas and Hoka. The stock itself into today down nearly 30% year to date. Turning to the tech space, we do have the shares of Cisco trading higher. They put up encouraging results. They beat. They also offered a solid current quarter forecast. This even as they cut jobs. They're saying that the job cuts aren't to save costs, but more for repositioning toward cybersecurity and the cloud. I would also argue that in the current environment that this could be a positive tell on the IT spend environment. As for Dell, up 3.2%. JP Morgan has added the shares to its analyst focus list. They've hiked the price target to $160, saying that the recent earnings reaction is overdone, that this company has long-term robust positives. And then finally, one laggard here in the morning, or at least one that we're taking a look at. Snowflake shares are down 3.5%. This after Berkshire Hathaway exited their position. We also have Wells Fargo cutting shares to an equal weight from an overweight. The analyst there, Matt, saying that the company is facing decent headwinds. In addition, the valuation at this point hard to defend.
All right, Abby, thanks very much. Abigail Doolittle there talking to us about some of the individual names. We are still about 17 minutes to go until the start of the cash trade. Coming up, bargain hunting shoppers are boosting the shares of Walmart. You can see in the pre-market up 9%. Walmart raising its full year guidance on sales and profits. More on the results next. This is Bloomberg.
One minute remaining. I'll lead with US industrial production month over month.
AI, how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea, but ultimately you still have to do a lot with it.
Fed's Muslim says monetary policy is moderately restrictive.
But at the end, you still have to customize and have to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment.
Are you concerned
10 seconds.
Today We won't be able to differentiate designs by AI and designs by an actual designer.
I don't know. For me, I feel that, when a designer doing, it's the spirit, it's the heart that the computer don't have.
Still waiting. Minus 0.6%, minus 0.6%, that's lower than forecast, minus 0.3%. Capacity utilization 77.8%, 77.8%, lower than forecast, 78.5%. Manufacturing output minus 0.3% as expected. Fed's Muslim added that absent future shocks, inflation seems to have returned back to the path consistent with 2% over time. Labour market no longer overheated, more disinflation work to do. And Muslim says signs of labour market cooling, but layoffs remain low.
Let's get now to high interest to look at what's making headlines around the world. The president of Columbia University resigned after months of chaos on campus.
Muslim says the labour market is no longer a clear upside risk to inflation.
Shafiq's ouster is the third time the leader of an Ivy League college has left because of campus demonstrations opposing the U.S.'s support of Israel. And the fall quarter starts soon. Around $861 billion is what it costs the U.S. government.
Muslim says recent data has bolstered my confidence on inflation.
Payments, nearly doubling what it was 2 years ago. But it's not even counting $100 billion in a bill from the Federal Reserve. That figure is more than the government's annual spending on NASA, the Federal Emergency Management Agency, FEMA, and the Small
Fed's
Business
Muslim says risks to both sides seem more balanced.
Which means the U.S. is spending almost $1 trillion already over a 12-month period on servicing its debt alone.
And Muslim says the time may be nearing for a change in the policy rate. So again, Fed's Muslim says the time may be nearing for a change in the policy rate.
$120 million. The former Chipotle boss is set to be one of the highest paid CEOs in America thanks to this pay package. It's worth $113 million in total because Starbucks is offering him equity to replace awards that he's giving up as he leaves Chipotle. Katie?
All right, we do have some breaking eco news right now to follow on what we learned at 8:30. We just got U.S. July industrial production numbers, and they fell 0.6% month over month. That is a little bit more than the estimate, which had been calling for a 0.3% decline. But you take a look at futures right now, not necessarily making a dent. Meanwhile, let's turn back to earnings because one stock, of course, we're keeping an eye on is Walmart. The company raising its full-year outlook as shoppers continue to search for bargains. And joining us now for more, I'm pleased to say we have Christina Morales. She is senior analyst over at Signum Research. She has a buy rating on Walmart with a $72 price target. And it feels like Walmart pretty much does well in any economic environment. But in this one in particular, it seems like Walmart really benefiting from that trade down.
Yeah, it's true. It's a very defensive stock. And in this environment, it's true because people and consumers are searching for more value items, for more value for their purchases. And Walmart is there. It's offering all kinds of products with in a very wide range to consumers. This quarter, they said they gained again market share, and especially they're luring these higher income consumers. So their broad base of consumption is increasing, and it's quite beneficial because not only the sales are increasing, same-store sales, but also the margins are increasing. The profitability, it's growing. So it's not that the people or the consumers are trading down, and that's why they're going to Walmart, but they're looking for more value-added products, and that's why it's driving the consumption in these stores.
Christina, I saw that general merchandise, which includes everything from clothing to household appliances. In this segment, I was shocked to see that Walmart has had 11 consecutive quarters of declines. Now, they're finally gaining back in that segment. What does that turnaround mean to you?
It's quite good. It seems that not only the consumption is hanging in there, but also the company is doing everything they need to attract the consumers. They're making every time more wide the variety of consumption they're doing. The sales via e-commerce are doing quite well. They had a 22% increase in e-commerce sales. They said they wanted to be a very good competitor to Amazon, and they're achieving that. The
sellers are increasing, the marketplace is doing quite well, and I think that it's the thing that is supporting this increase in general merchandise, that people are finding the items they need in e-commerce and in store-based.
Christina, thanks so much for joining us. Christina Morales there of Signum Research. Talking of general merchandise, Katie, one of those items that they sell is a pool noodle. You know, the styrofoam?
I've heard of them.
And apparently they sold so many pool noodles that if you stretch them end to end, it would cover 30,000 football fields, or 1,700 miles, which means you could stretch the pool noodles that Walmart sold from here to Belize.
See, you could be lying right now, and I would just believe you. Because where did you even find that? Is that on the terminal?
I heard that from the CFO. John David Rainey was saying that in the presentation this morning.
Well, I would believe that man. And the stock, responding. Maybe not to that specifically, but...
All right, let's move on to Cisco. They sell enough stuff to stretch from here to Belize and back. Shares moving higher in the pre-market. The tech giant announcing a bullish revenue forecast for the current quarter thanks to a rebound in orders. Cisco also announcing thousands of job cuts as part of a strategy shift. Woo Jin Ho joins us, Bloomberg Intelligence senior analyst for hardware and networking. And Woo Jin, this is odd because it's a bullish outlook, but they're firing thousands of people. How do you square that circle?
Yeah, hey, Matt. So I think there was some concern when the original reports of headcount cuts meant that the demand environment was going to be weak. Quite the contrary. When they made their first round of headcount cuts a couple of quarters ago, I didn't think they did enough, quite frankly. And I think this round actually right-sizes the business. Another thing in terms of the headcount cuts, you're not going to get the margin expansion that one had hoped for, or at least I had hoped for. And they're essentially redirecting some of the cost savings back to the growth areas, which is security and software.
Yeah, it's interesting looking at comments from the CFO. He said that the layoffs, it's not about trying to boost profits. It's more freeing up resources to shift into cybersecurity, cloud systems, AI-related products. I mean, reading between the lines there, does it sound like they're going to be hiring in those areas?
Yeah, for the most part, Katie, they are. If anything, look, they made their acquisition of Splunk, which closed last quarter or a couple of quarters ago. And they're doubling down in those growth areas. That Splunk and software business is supposed to be growing at a mid-teens rate. Now, counter to that, the core networking business is growing at around a low single digits rate. So, if I'm going to spend my money, I'm going to spend my money where it's going to grow 15 to 20%.
All right, Woo Jin Ho of Bloomberg Intelligence, really appreciate that breakdown. Cisco shares currently up about 7.4% pre-market. We're going to continue to keep an eye on that one. Now coming up, why Warren Buffett is going big on beauty products. We'll have the details next in today's Social Climbers. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
right, it's time now for Social Climbers, the companies making waves on social media this morning. And first up, the U.S. fining T-Mobile $60 million for failing to prevent and report data breaches that happened in 2020 and 2021. The Committee on Foreign Investment in the U.S. levied the fine earlier this year. T-Mobile had signed a national security agreement with the government watchdog in 2018 as part of its merger with Sprint. Next up, Gambling.com playing a winning hand today. The online betting marketing firm reporting a robust second quarter result and raising its full year guidance as well. And finally, Ulta Beauty showing off its shine after Warren Buffett's Berkshire Hathaway disclosed that it took a new stake in the cosmetics retailer. It's been anything but rosy for Ulta, though, since March when it gave that disappointing outlook for the year and said that higher supply chain costs and increased promotions hurt its margins. Of course, you can follow all the latest company buzz on TREN Go on your Bloomberg Terminal Map.
All right, very interesting stuff. Let's take a look at what's going on in the markets. We are rallying in terms of futures ahead of the open, just 4 minutes away. The S&P 500 up 0.9%. NASDAQ 100 futures gaining more than 1%. And look at that, Katie. Russell 2000 futures up more than 2%. It could be a great day to restart that rotation.
Here we go. Yeah, the rotation trade. It's coming up. And
all eyes on the consumer, I guess, this trading day. We're going to cover the open with PGIM, Quantitative Solutions Chief Investment Officer George Patterson. This is Bloomberg.
Fed's Musalem says that the economy has been growing very well. Data does not support the idea of a recession.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Buffalo Pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate.
Fed's Musalem says I see GDP growth as between 1.5 and 2% over the next half of this year.
Thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that you know most households where most of the dollars go against.
So 1 minute remaining now for the US cash equity open and the market on open imbalance.
Like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
We are moments away from the start of trading. Looking at a rally today, folks.
and we're seeing gains of more than 1%.
So looking now to the market on open imbalance, S&P 500, 550 million to the buy side, NASDAQ 100, 5 million to the buy side, Dow 30, 105 million to the buy side, Mag 7 stocks, minus 2.5 million to the buy side.
The New York Stock Exchange, you've got United Community Banks over here at the NASDAQ. You've got Second Chance Rescue.
Fed's Muslim says, I don't see recession in the next few quarters.
Obviously, the cash trade kick in at a higher level than the close yesterday. In fact, let's take a look at the indexes here. The intraday move about 1% on the S&P, what you would expect. The NASDAQ gaining a little bit more. Actually, it looks exactly like futures lined it up for us. Russell shares trading up 2% in the cash trade. In terms of individual stocks to watch, I'm focused today on John Deere, surprising analysts by reaffirming its profit outlook despite weakening market conditions. The company is adjusting production to meet the downward trend in demand because crop prices have fallen through the floor and farmers can't afford to buy new tractors. Sales dropped 17% in the fiscal third quarter, and nonetheless, we see the shares up 2 and change. Katie, what are you looking at?
Also keeping an eye on Tapestry here. That's, of course, the company behind brands such as Kate Spade and Coach. Quarterly profit topping analyst estimates. Retailers warning of a slowdown in consumer spending, but still, Tapestry raised prices during the pandemic amid high demand, surging inflation paying off. You can see shares currently up about 8%. We should also talk about Walmart, though, now at a record high. That's after it raised its sale guidance for the full year, hoping to draw shoppers looking to save on deals. Let's take a closer look now with Bloomberg's Abigail Doolittle.
Yes, Katie, a big gain here for Walmart. The best day, in fact, since March of 2020. So that's the degree of the buying power that we are seeing here for Walmart, up 7.8%. You can see really outperforming the group, but at the same time lifting the group after they did actually miss earnings just slightly, but the sales beat was robust, well, somewhat robust, but we also had same-store sales comp up 4.2% versus the estimate of up 3.4%. Something that really stands out relative to revenue, if we take a look at it on an annual basis, we're going to see some really nice gains here. Now, it's interesting, like sequentially, the quarter that was just reported, growth did drop a little bit, but annually you can see moving in the right direction. And what makes this so interesting is that they are talking about that the higher income consumer, that's really where they're getting this extra boost from, so to speak, that groceries are going gangbusters still, and in addition, e-commerce is strong. They're saying that customers, they're not seeing any signs of their wallets fraying at the edge, but that they are seeing some really discerning, choiceful customers. When you put all this together, Katie, you have to wonder, maybe, whether or not there's something more severe ahead economically. We're nowhere close to a recession right now. But if we were to go there, you can see back in 2020 and then during the GFC that Walmart, relative to the S&P 500, outperforms in a big way. It's interesting to note right now we have
Fed's Muslim says, I don't think the Fed is behind the curve. The economy is doing very well.
Do that again. And again, as we do have these signs that the higher income consumer really choosing Walmart, going there and being very careful with their purchases.
So much. And I'm pleased to say that we're joined now by PGIM Quantitative Solutions Chief Investment Officer George Patterson joining us on set. Great to see you in person.
Great to see you again, too.
So let's talk about the economic environment married to earnings right now, because like Abigail said, really no signs of a recession. But then you think about some of the comments that we're hearing on these earnings call about the consumer trading down, being choiceful. Does that give you any pause about the landscape heading into 2025?
Not really. The consumer is healthy, and we're very much in a good, not
Fed's Muslim says the news has been very encouraging on inflation over the past 3 months.
Of large bellwether firms, but there's many other firms, and I think that's one of the advantages of our approach, which is a quantitative approach, because we're able to scour and look across thousands or tens of thousands of companies.
And it's interesting, this is something we were talking about with Katie Kaminsky at the top of the hour, that earnings have been kind of mixed, kind of meh, but then you think about the economic environment, you think about the volatility that we saw in the past month when we were really nervous about that growth scare. It really feels like it's the economic environment that investors are queuing off of right now.
Yeah, the economic environment people are trying to read the tea leaves, and this is the big challenge. It's always challenging. I find it a bit odd that you get one data
Fed's
point.
Muslim says we just have to be confident that inflation trend is secure.
Can really cause people to take take big positions or put on big trades. But economics moves a little bit slower.
Does it worry you? I mean, you say that you see no indication of a recession, and yet, you know, the yield curve has been inverted for a long time. We got the SOM rule triggered with unemployment jumping to 4.3%. Credit card debt is off the hook and very expensive at these rates. The U.S. is paying, you know, basically $1 trillion a year just to service our interests. Are you not worried about a recession?
So we're definitely worried about a slowdown, but it's a very low probability. I think the deficit and the debt is a big issue, and that's going to be a definite limit in terms of like what flexibility government officials are going to have in terms of, you know, future fiscal policy. But in the near term, we really see that things are very strong. You know, not booming, but no signs of an imminent recession. For example, go try and get a restaurant reservation for Friday night. Still pretty hard to do.
Are you worried at all about positioning? We heard so much talk about the carry trade last week, and maybe it's unwound, but who knows if it's still a problem, right? It's so hard to see. And then Bloomberg has a great op-ed piece about private equity and how much leverage they've put on top of leverage on top of leverage.
You sound worried, Matt.
No, I'm just trying
Fed's Muslim says the risk of easing too early or too much could be costly.
Brown swans here. Do you worry about any of these things?
I don't worry about private equity because largely, if you have to look at who owns the private equity, and the owners of private equity are large institutions, large plans. They have prepared for this. They have managed their liquidity so that they can deal with these cash calls from private equity. So, you know, that's the biggest challenge, is that, you know, when you get into private equity, you can't get out easily and you have cash calls. So, you know, you need to have a liquid portfolio around that. It allows you to be able to fund those
Brent
calls
crude rising
without
$1 a
selling
barrel.
an asset that you want to own for the long term.
Let's go around the world here. I want to go to small caps because we launched this show on July 8th, and then suddenly small caps were ripping. It was very exciting. We were talking about this broadening out. Then it fizzled. Now you have the Russell 2000 up 2%. What is going on with small caps? What is the mood music there?
So people are expecting rate cuts. And if you look, where am I going to benefit the most from a rate cut? It's in small cap. Those are the companies that are more susceptible to needing financing. They probably don't have fixed rate financing. Much more of it's floating. A little bit less quality than in large cap. They don't have the same terms that, you know, like a Walmart or a Home Depot can have. So if you look for the marginal trade, it's in small caps. And if you go back to July 12th, 13th, it was really industrials, financials. A little bit of consumer that really took off. REITs also will be a big beneficiary. So again, I think small caps are going to move, right? There's a huge valuation gap. Small caps are going to move based on potential interest rate cuts, but again, there's a huge move out there. This one was a little bit of a head fake back in July.
What kind of interest rate cuts do you expect? I saw, by the way, Raphael Bostic. It's almost like somebody at the Fed called him up. Tuesday, he was out saying, like, we don't need to cut rates. I don't want to do it till the end of the year because I need to see more data. Then I'm sure someone calls him in the middle of the night. And then on Wednesday at the FT, he's like, actually, I think September is a good place to start.
Yeah, in all honesty, it's a tough, you know, it's a very tough thing. So what I will remind you is on the whole way up that people were talking about increasing rates, the forecasts were all wrong, right? They kept raising and raising and the forecast caught up. So again, I think, to be honest, it's more important to think about your long-term investment strategy than try and forecast, are we getting 25 or 50? A lot of times it's, for us, for our clients, that's the most important fact, is getting the long-term perspective correct.
Well, when you look medium term, when you look long term, what's the conviction trade right now? Or the conviction investment, if you want to call it that?
So if you're looking for conviction, I would say small cap, maybe a little bit of mid cap. Not so, you don't want to go so far down in small cap that you're having negative earnings, but I would say more in the you know, the upper part of small cap or mid cap. And again, anything that's interest rate sensitive.
High quality small cap.
High quality small cap. You know, I don't think now is the time for kind of a junk rally. There will be a time for it, but I think it's a little bit too early.
All right, George, great having you on the program. Thanks so much. Please come back soon. George Patterson, PGM Quantitative Solutions Chief Investment Officer. Coming up, we're going to talk about John Deere, reporting more than a 40% drop in year-over-year net income. I told you about the 17% drop in sales, but the company reaffirmed its outlook in a surprise to analysts, and as a result, the shares in the cash trade are now at more than 5%. We'll talk about that next. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time,
Feds Musalem says I don't think the recent volatility has had a macro impact yet.
I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Good morning from our world headquarters in New York. I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, KeyBank says Brinker International is a buy. The analyst sees a compelling entry point for the stock following its post-earnings decline. The parent company of Chili's and Maggiano's Little Italy issued a fiscal year profit forecast that trailed estimates yesterday. But the KeyBank analyst says that the results were misunderstood. Next up, Deutsche Bank says that Robinhood is a buy. The analyst says upside for the e-broker looks good in both the near and the long term. Robinhood, of course, reported strong second quarter earning results last week. And finally, it's the Goldilocks scenario for chicken. Well, it's over. According to Bank of America, the firm says that Pilgrim's Pride, it's one of the largest poultry producers in the U.S., no longer a buy. Bank of America says share upside will be more difficult given the downward pricing pressure on chicken.
All right, I'm glad I know that. Thank you very much. Taking a look now at Walmart. It hit an all-time high this morning on its way to its biggest single market cap add in the company's history. Take a look at this fantastic chart that Terrell Holt put together. By the way, you can make that panel disappear. Good job. All right, this is showing that Walmart today is adding almost $40 billion, or exactly $40 billion in market cap after raising its forecast for revenue and profit for the full year. So pretty amazing stuff. Let's turn to another economic bellwether that's in a world of hurt in comparison. John Deere shares, they're actually rising because the company reaffirmed its profit guidance, but analysts expected Deere to cut its outlook due to weak market conditions. Soy and corn prices, as we talk about at this show, are at the lowest levels since 2020, giving farmers little reason to splurge on new equipment. Bloomberg Intelligence industrials analyst Chris Cellino joins us right now to talk about it. And Chris, it's amazing that they didn't cut because, you know, the profit fell 40% in the reporting period, sales fell 17%, and we know that farmers are earning considerably less money than in years past. Like, I think net income for farmers fell 26% last year because we have these crop prices falling through the floor. So why is Deere holding tight?
You're right. I mean, these results were a lot better, or not as bad as many had feared heading into the print. The top line, margins, earnings, all better than expected in what is, as you mentioned, a pretty challenging environment for farmers. Pricing, I think, was
U.S. crude futures rise by more than $1 to $78.30 a barrel.
Pricing actually uptick here in the ag businesses in the quarter. And to your point, they largely kept their 2024 outlook intact when all their peers cut their outlook this quarter. So while we don't think we're out of the woods yet, and there's certainly probably more downside in 4Q as they continue to cut production and manage the inventories, I think this probably alleviates some concerns of a more severe downturn in the near term.
Well, even still, I mean, you talk about their peers cutting their outlooks and what seems to be an industry-wide issue. Of course, Deere apparently resilient here. But with that, all of that in mind, I mean, are we potentially setting ourselves up for disappointment in 3 more months?
I don't think so. I think it's pretty well understood that 4Q is going to be weaker than 3Q. The question now, I think the biggest focus will be on, can they get inventories in line with production exiting the year so that they could produce in line with retail demand in 2025. Inventories are still quite elevated. They were relatively flat in the quarter, but there's still a lot.
Fed's Musalem says models suggest interest rates going forward are likely to be higher than pre-pandemic.
In terms of the crop prices, is there anything to support a rebound here? I mean, I know it's record production. That's one of the main reasons for the drop. What's the outlook?
Yeah, if you look at crop prices, and really the ones that matter for Deere are corn, soy, wheat, we're down 15, 25% plus here year to date. The crop price outlook, isn't particularly encouraging given the record production that we'll see. Obviously, weather could always throw a wrinkle in things and is a wild card. But at least for the near term, there doesn't seem to be any kind of immediate support on the crop price front, which obviously pressures farmer income and their appetite to go out and spend on equipment.
Well, at least in the near term, Deere shares certainly higher right now, up to the tune of about 4%. Bloomberg Intelligence industrials analyst Christopher Cellino, really appreciate your insight there. Now, coming up, hedge funds still leaning on big tech, and Bill Ackman's Pershing Square running over to Nike. That and more in our Wall Street Beat up next. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
DOJ or other authorities.
At 10 a.m. Eastern Time, we get U.S. business inventories month over month. Forecast 0.3% on the prior 0.5%. And US NAHB Housing Market Index forecast 43 on the prior 42.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
This is Bloomberg Open Interest. Let's take a check on markets right now. About 20 minutes into the cash trade, we are absolutely flying right now. The S&P 500 up about 1%. You take a look at the NASDAQ 100 up 1.5%. We got good news on retail sales today. The consumer still spending, and investors clearly like that. Bond investors, not as much. A sell-off underway. You have 2-year yields currently up about 14 basis points, Matt.
All right, getting ever closer to 4.1 on the 2-year. Time now for Wall Street Beat. Hedge funds are still buying into tech names like Apple for the most part, but they're trimming positions in some, including NVIDIA, as they reshuffle their portfolios. For more takeaways from the 13F filings, we're joined by Bloomberg hedge fund reporter Hema Parmar. Hema, thanks so much for joining us. Let's talk, first of all, about what we're seeing and what the most interesting moves are. I thought the NVIDIA someone trimmed a stake by like 84% in NVIDIA. I thought it was pretty interesting.
Yeah, we are seeing some selling of NVIDIA, and it's really prescient. If you did cut that stake ahead of the volatility that we saw, and that's one thing we're really looking at, is how funds were positioned ahead of the volatility. So some selling of NVIDIA, some selling of Microsoft to buy 140 funds, some selling of Meta too. On the flip side, some buying of Amazon, Taiwan Semiconductor, aggregate buying of Apple. They saw the most buying in 3 months in that stock across a number of funds.
It was Tepper, by the way. I just looked back at my notes. So yeah. Appaloosa cut its stake in NVIDIA by 84%. It's now 1.4% of the portfolio.
Yes.
Cut its stake in Alibaba by 7%, but Alibaba is still 12% of all of Appaloosa's holdings.
Very big position.
And Chinese stocks are like 26% of all of their holdings. So
He's very focused. He's a very concentrated portfolio. On the flip side, though, Michael Burry increases exposure in Alibaba. So it's interesting when you see concentrated investors taking opposing positions and having opposing views.
And of course, these are a backward look, but it'll be interesting to see. Of course, NVIDIA doesn't report until the end of this month. It feels like the stakes really high.
But the Chinese economy hasn't looked like healthy previously, right? It's looked bad in the last quarter and the quarter before and the quarter before.
Yeah, well, David Tepper's sticking by that bet. Let's talk about Berkshire Hathaway, though. Ulta Beauty, obviously, really moving on the heels of that news. I mean, what do we know there? Yeah,
So he's starting a new position in Ulta, driven the stocks up a little bit. It looks like he might be buying the dip. That stock's fallen a great deal over this year, picked up a little bit since. He's also started a new position in an aerospace company called Heiko, and he was on a selling spree earlier this year, cutting his Apple stake by about 50%. So we're seeing, some potentially bearish sentiment, but clearly a bullish view on Ulta.
Do people still watch? Is Berkshire still the most important 13F that you get?
It's up there. People really love to know what Warren Buffett's doing.
Fed's Muslim says election years can bring uncertainty, though, and that can affect economic confidence.
At the multi-strats or the quant funds, because they trade in and out of stocks so frequently that a snapshot of one specific quarter may not tell us that much.
Yeah, well, that's what I wanted to ask. Of course, this is a backward-looking snapshot. You also track hedge funds' returns very closely.
Yes.
How closely do the 13Fs that we get versus the returns, how linked are they?
Because it's a little bit backwards looking, it's always a bit delayed. So right now, we really do care about how funds are either looking forward or how they manage the volatility. And the 13Fs, while insightful, they really only show us through June. So there's always a bit of a gap. Typically, we hear performance numbers as of now.
and the positioning is a little bit dated. So it's not always helpful in that respect, but it does give us some clarity into tech positioning, into how funds are maybe taking bearish or bullish views on their equity exposure. So it tells us some things for sure.
All right, Hema, thanks so
At
much.
10 a.m. Eastern Time, get US business inventories month over month. Forecast 0.3% on the prior 0.5%, and US NAHB housing market index forecast 43 on the prior 42.
Interesting. Talk about buying the dip there. Of course, Bill Ackman moving into Nike. He has a pretty small portfolio overall, so it's always
in terms of the number of stocks that he holds.
Exactly.
Yeah.
Exactly.
But 3 million shares in Nike at $230 million stake in Nike, so it's pretty interesting a move indeed. All right, let's get you to the trading diary, what you need to be watching this afternoon and tomorrow. We're going to hear from Philadelphia Fed President or Fed head Patrick Harker this afternoon, and the Fed talk has been coming fast and furious. It's hard to keep up. Tomorrow, U.S. housing starts are released, plus University of Michigan consumer sentiment data comes out. And we hear from Chicago Fed President Austin Goolsbee, who is concerned about the labor picture in the afternoon. Coming up in the next hour, we're going to hear from the chief economist at MasterCard. Michelle Meyer joins us. Also, the CEO of Priceline. That'll be fascinating as we get a look at what the consumer is doing in terms of travel. Have they been pulling back? And we're going to go out to Carmel, California, where Dave Majors is standing by, the CEO of Mecum Auctions. They kick off a 3-day sale at Monterey Car Week ahead of the Pebble Beach Concours d'Elegance. This is Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are 3 fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number 2, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then
1 minute remaining. I'll lead with US business inventories month over month.
Information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
10 seconds. Zero spot 3%, 0.3% as expected. NAHB Housing Market Index 39, lower than forecast 43. NAHB Housing Market Index prior revised 41.
And yields jump across the board as higher than expected retail sales point to a resilient consumer. And speaking of that consumer, we'll talk global travel trends with Priceline CEO Brett Keller as vacationers make their Labor Day plans. And on the campaign trail, Donald Trump downplays the economy's significance as Kamala Harris proposes a price gouging ban on food and groceries, Matt.
All right, that'll be all interesting stuff to talk about.
Big time.
I'm really looking forward to it. But the markets have to hold your focus right now. The S&P 500 up more than 1%. The NASDAQ 100 up almost 2%, and I think the Russell 2000 is there as well. Meanwhile, yields are rising. We saw the 2-year earlier at 4.09, the 3-year...
We have posted the US business inventories June report on the feed for all those interested.
So we're getting 10, 15 basis point moves in bonds today as we get good news on the economic front.
Yeah, and it has certainly been an eco-heavy week from PPI to CPI and retail sales this morning. Let's break it all down now with MasterCard Chief Economist Michelle Meyer. Great to have you with us on this week in particular. You take a look at retail sales really blowing past the estimates here. People really outspending in force, but take us below the surface there. What are people actually spending their money on right now?
Well, in this most recent report, the majority of the categories of retail spend increased. So it showed some breadth in the spending, even in the face of some, kind of pops higher, like what we saw with autos, for example, because of some of the special factors. So you do see that consumers are out there spending, and that's quite consistent with what we're seeing in our own insights. Our spending pulse data is showing continued growth, really being driven by online spending, particularly this last month with online retail sales ex autos running just above 8% year over year from our spending pulse data. And similarly, we're seeing consumers out there spending, but being mindful, making choices in terms of how they want to deploy their dollars, whether it's still for some summer experiences, or now they're looking for some restocking, or the replacement cycles kicking in for some electronics as well.
Interesting. And so we think about that mindful, that choicefulness among consumers. I mean, does that speak to this trade down, or are we seeing people actually rotate from more discretionary categories into more heavily spending on staples?
I think it's all a function of the fact that we're still coming out of this very unusual economic cycle, and we're trying to find a new balance and a new normal. So the cycles for the consumer basket were not uniform, right? When we first came out of the pandemic, we saw everybody buying these big durable goods, household appliances, electronics, things that they needed to stay at home. Once you had that reopening, once travel was back, it swung dramatically the other direction, especially in an environment where interest rates were higher, making it less attractive to buy those interest rate sensitive items. And now I think we're past some of those really large swings, and we're finding a new equilibrium. And that means for some categories, consumers are going to be a lot less willing to accept higher prices. We're going to see disinflation, or even for some big ticket items, deflation, which was also revealed in the CPI report earlier in the week.
I mean, you mentioned retail sales already, Michelle, and good morning, by the way. A huge bounce back. I look at the Bloomberg has this ECAN function where we can really look at a granular level at retail sales, and it's impressive to see the auto sales bounce back after the auto sales drop. It's the blue block for those of you looking at the chart here on TV. What's the story with auto sales? I mean, taking away the noise of this month and last month, what does the trajectory look like to you?
Well, Matt, I know autos is near and dear to your heart, so you probably have that perspective better than anyone else. But I mean, I think part of what happens in autos, notwithstanding the most recent month, because that was due to idiosyncratic factors related to the cyber attacks. But in general, autos is an interest-sensitive sector. So an environment where interest rates are rising quickly, affordability gets challenged. And certainly we saw that in terms of some dampening sales as interest rates were heading higher. We're now seeing the reverse, right? Markets are certainly pricing in Fed cuts, and the Fed is signaling that easing is coming. So I think we're going to be entering an environment where it becomes a little bit more affordable for people who've been waiting on the sidelines to make some of these big ticket purchases.
In terms of rates, what do you expect? I mean, we were hearing for a long time 75 basis points, 50 basis points, not a long time, a couple days basically, after the growth scare of last Friday. That seems to have all died down. And even though Bostic made like a quick turn to the end of from the end of the year to next month, it does seem like people are now in agreement that we only need 25 basis points and we don't need to front load all the cuts this year.
So when we look at it at the MasterCard Economics Institute, we're looking at where we're seeing the economy going in the medium term, right? Because monetary policy, of course, works with, as we all like to say, long and variable lags. And I think that the markets overreacted to what happened after the jobs report, assuming that the Fed was significantly behind the curve and had to catch up. That was not what we were seeing broadly in the data, right? With you look past that 1 month of data, the labor market is cooling. It is not collapsing, right? We are still seeing record low jobless claims. We're just seeing a moderation in the rate of hiring. We're still seeing the consumer spend. We're just seeing a consumer that's a lot more choosy and really conscious of the prices that they're accepting. We're still seeing investment, but again, a prioritization of the type of corporate investment. So to me, it's an economy that needs a normalization of monetary policy, not a dramatic easing of monetary policy. So I think what the market is now heading towards, which is perhaps a more measured cutting cycle, is the right approach, with increasingly 25 basis points being priced in September seems quite reasonable. Of course, we're going to hear from Fed Chair Powell at Jackson Hole. That's going to be important. We have to look out for the next jobs report. But I think the market has now settled down to the idea that the Fed is going to be easing, going to be normalizing monetary policy.
Right, a lot to look forward to at Jackson Hole. It seems like they always tend to make news out in the mountains there, but I'm glad that you brought up the long and variable lags, because I want to talk about that as it pertains to the consumer level. If we get a 25 basis point cut in September, do we actually see that translate to the credit card spend level? How does it actually affect actual citizens?
Well, you have to think about that interest rate transmission. And it's not just when the Fed starts cutting, it's when the market starts pricing it in, right? So you already are seeing an easing of financial conditions now that the market's pricing in these Fed cuts with interest rates heading lower. And over time, that does feed into the economy in some segments faster than others. So in the face of the big move in markets over the last 2 weeks, there was a pop higher in mortgage refinancings, for example, when you look at what's happening in the mortgage market. So I think the consumer responds. I think in general, borrowers start to see some impact in terms of lower interest rates, but it takes time ultimately for both the increase in interest rates to feed into the economy fully and that decline, particularly in the U.S., where we have a lot of fixed rate mortgages.
Yeah, 80% locked into mortgages under 5%. Michelle, great to have you on our new show. Really glad that you could come on. I hope we get you back soon. MasterCard Chief Economist Michelle Meyer. Let's get a look now at the stocks moving at this hour, just about 40 minutes into the trade. For that, we go to Abigail Doolittle. Abby?
And not surprisingly, with the indexes trading sharply higher, we also have some stocks beneath the surface helping out that action, one of them being Cisco, up 9%. They beat both top and bottom line estimates. They also raised the guide on sales for the current quarter in a very healthy way. The full year guide of $55 billion to $56.2 billion really supports a path for demand stability, at least according to some analysts. They did cut jobs, but folks are viewing this as a positive since they're cutting jobs to then bulk up in newer areas such as cybersecurity and the cloud. And I would also suggest this really points, this strength, especially the sales guide, points to the strength, the stability of the overall IT spend. As for the shares of Ulta, these are also sharply higher, up about 9.7% as Berkshire Hathaway has revealed a stake. They bought about 690,000 shares. The stake is valued at roughly $266 million. And right now, this stock having its best day going back to December of 2023 at the highs. It had been the best day since 2020. And then finally, rounding it out, another gainer on 13F action. Nike Pershing Square has revealed a new position. They now own a total of 3 million shares worth about $229 million. The sports retailer, Katie, of course, has struggled this year. Competition from Hoka and Adidas. Inventory issues into today down 29%. But folks seem encouraged by Pershing Square's stake and also the promise for a quiet approach in terms of turning things around.
Yeah, definitely some needed good news for Nike there, down by more than 20% year to date before that news. Abigail Doolittle, thank you so much.
Is that your favorite segment, the running shoes segment?
Absolutely, yeah.
Do you wear Nike running shoes?
No, I am a Hoka gal, but I do wear Nikes for road races. Their super shoes are pretty fun. Very expensive, but, you know.
What about Adidas?
Not as much, and it's interesting that you went with that pronunciation.
Yes, because the founder was named Adi Dassler.
Yeah.
And hence the Germans pronounce it Adidas.
Here in America, though, I think we say Adidas. But in any case, coming up, speaking of America, Kamala Harris will propose a price gouging ban on groceries as it all comes down to the economy for the 2024 presidential election. That's next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money. If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Now to high interest, to look at what's making headlines around the world. A drunken evening and a rented yacht were behind the destruction of Nord Stream 2. This according to reporting from the Wall Street Journal. Officers involved in the plot, Ukrainian officers, point to heavy boozing, patriotism, and iron determination of the people involved, leading to the blowup. Despite initially approving the plot, reportedly, President Zelensky actually asked them to halt it after the CIA told him to pull the plug. It's an amazing story. Americans appear to be yanking money out of their stock brokerages accounts to fund their online betting. That's the key finding in a recent study which reports that the worrying trend is most acute among the most financially strained households. That part is no surprise. Federal authorities have charged 2 men visiting the U.S. from South America with stealing $1 million Patek Philippe wristwatch at a Beverly Hills restaurant. Authorities said the thieves were part of a crime tourism ring. A spate of watch thefts has plagued New York City in recent months, with the latest recorded on August 9th at a subway station. So it's happening, Katie, on both coasts.
Well, let's turn to politics now, because Kamala Harris set to propose a federal ban on food and grocery price gouging. Polls, of course, have shown that the economy is the biggest issue for voters this November, and Trump holds a wide lead over Harris when it comes to economic policy. But yesterday, Trump downplayed the economy's role.
China's central bank governor says China will gradually shift away from a focus on quantitative targets.
They say it's the most important subject. I'm not sure it is, but they say it's the most important. Inflation is the most important, but that's part of economy.
And China will place greater emphasis on the use of price-based tools such as interest rates.
Let's start with Trump. This, of course, was interesting because, as I mentioned, I mean, he is holding a lead when it comes to voters' perception of the economy. So a bit of an about-face here, it seems.
Yeah, this has been sort of a rough couple weeks for Trump as he's been trying to recalibrate his messaging. The entrance of Harris into the race has sort of thrown him off course. So he's been doing, his campaign staff at least has been trying to keep him more on message. So this speech he did yesterday in North Carolina was billed as an economic-focused speech. And he did talk a lot about the economy, gave out some vague proposals, some of the things he's talked about in terms of not taxing tips, not taxing Social Security, wanting to increase tariffs, wanting to, get rid of any, efforts to move towards electric vehicles. But he a couple different times referenced, I don't think economy is the most important issue, kind of vague statements of they wanted me to give an economy speech. Clearly that he's, not totally on board with focusing on economic messaging, despite the fact that, as you point out, that he actually has a wide lead over Harris on this. Voters trust him a lot more. And when you talk to voters, and particularly high-dollar donors, why they want Trump, they're, frequently reference things like tax cuts and his sort of, tough on China stance.
It is no surprise that Donald Trump is not sticking to his talking points, but it does look like Kamala Harris is kind of ripping them off, right? I mean, she has stolen some of his policy. For example, the no taxes on tips, and she's all over food inflation, right? She wants to ban price gouging. I'm not sure how that would work, and it is already illegal in most states anyway, but what are we learning about her platform?
So she's bit by bit sort of drolling out some of these things, and these are key issues that when you look at sort of what is behind the proposals, these are things that appeal to key voting blocs. So the no taxes on tips, it's no surprise that both Trump and Harris proposed this idea in Las Vegas, where there's a high proportion of voters who are tipped workers, people who work in the hospitality casino industry. Also, things like price gouging, those are and groceries, those are things that appeal specifically to women, specifically to suburban women, and in sort of these blue wall states, Michigan, Pennsylvania, Wisconsin, that's where the economy is doing most poorly of all the swing states and where people are most feeling the pinch on household budgets. So it's a key sort of way to go after voters, even if these proposals, aren't likely to ever come to fruition.
And it's interesting, too, in addition, that your team's reporting shows that she also plans to carefully scrutinize mergers. You think about the Kroger-Albertsons tie-up, for example, potentially in the balance here. What do we know about that?
Yeah, so this is like a continuation, and this is kind of her showing her cards of how she would proceed on antitrust going forward. The Biden administration has taken a pretty strident stance there. Lena Khan of the FTC has been at the forefront of that, and she's showing that she would not back down at all. What's interesting as well is that J.D. Vance, on Trump's running mate on the Republican ticket, has also expressed the same kinds of desires to have more oversight over mergers and acquisitions. So this is, you kind of see the politics melding here of, that both sides are proposing very similar policies.
All right, Laura, thanks so much for joining us. Bloomberg's Laura Davison reporting in Washington. By the way, if you take a look at WSL Election, which is a great function on the Bloomberg terminal that helps you round up both
taking a look at the Fear and Greed Index, 33 out of 100 equaling fear, and the Crypto Fear and Greed Index, 29 out of 100 also equaling fear. And looking at the VIX, currently down at 6.6% at 15.13.
Starbucks CEO working from Seattle. We'll take a look at some of the sweet perks awaiting Brian Nickel. Social Climbers is next. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
At 10:30 a.m. Eastern Time, we get weekly EIA natural gas change. Forecast a build of 1 BCF on the prior build of 21 BCF.
We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Let's get a look at this rally, why don't we? We are up across the board in terms of the indexes. S&P 500 adding more than 1%. What a week it's turned out to be. This is the best 5-day rally that we've seen so far this year. In terms of the NASDAQ 100, we're up almost 2%, 1 3/4. It is 2% if you look at the smaller cap stocks on the Russell 2000, for example. And we are seeing rates rise as well. So investors are selling off bonds, feel comfortable enough to let go of that debt. The 10-year yield is up to 3.92, and the 2-year yield is up to, I think, 4.08 right now. So big rate rises across the board. In terms of individual stocks we're watching, check out B. Riley. Those shares have been halted. On Monday, the firm announced a new round of write-downs, and then we heard about a widening U.S. investigation from the SEC about whether it gave investors an accurate picture of its financial health and investigating the relationship between the CEO and the head of the asset that was written down. And now you see the stock falling, I think today, another more than 20%, and you see the worst drawdown, Katie, in a decade.
We'll continue to keep an eye on that one, but it's time now for Social Climbers. The company's making waves this morning, and first up, Ulta Beauty showing off its shine after Warren Buffett's Berkshire Hathaway disclosed that it took a new stake in the cosmetics retailer. Of course, it's been anything but rosy for Ulta Beauty since about March, when it gave that disappointing outlook and said that higher supply chain costs and increased promotions hurt its margins. Next up, we have Coach parent Tapestry beating Wall Street expectations despite weak consumer confidence and inflation fears. The handbag maker also reiterating its commitment to buying Capri Holdings, parent company for brands including Jimmy Choo. The FTC, of course, sued to block this deal in April, a trial set next month. And finally, when newly appointed Starbucks CEO takes over next month, he won't be in Seattle. Brian Niccol instead will be working remotely from Newport Beach, California, where Chipotle, of course, is currently located. Niccol agreed to commute to Starbucks headquarters and travel as much as needed to do his job. White-collar Starbucks employees, on the other hand, are still required to be in the office at least 3 days a week, Matt.
All right. You can follow, by the way, all the latest company buzz on TrenGo, TREN-GO, on your Bloomberg terminal. Let's keep talking about this Starbucks issue. It has bet on Brian Niccol, and the pay package is pretty eye-popping. It's going to cost the coffee chain about $113 million to get Niccol in the office. That includes giving him, I think, $75 million in stock grants to make up for what he's lost leaving Chipotle. Plus, they're going to have to pay the outgoing CEO about $10 million, at least $10 million. So a pretty much expensive exercise, but it's been worth it in terms of adding like $20 billion in market cap, right? Let's talk with Bloomberg's Brian Chapata, managing editor for Wealth, about this. So we're talking about some big numbers. If you break it down, they're still big, but not as big, right? Like just his pay package for this year, it's only like less than $30 million.
Only, yeah. Definitely. Definitely only. No, it's an interesting one. He's kind of a breed of the superstar CEO almost that we're seeing, where if you are successful in keeping a company on the rise, that you will get poached. To your point, a lot of the money that he's getting is a result of what he would have gotten at Chipotle. So Starbucks really had to sweeten the deal and basically basically comp him to just get him, and then in addition to that, signing bonus, equity,
$10 million
grants.
signing bonus,
Yeah.
$75 million equity grants, and like, what is it, $25 million pay package?
Yeah, it's a lot of money, but you know, if he's the guy that they want, Elliott
At 10:30 a.m. Eastern Time, we get our weekly EIA natural gas change forecast, a build of 1 BCF on the prior build of 21 BCF.
Incensed about this, and like I read, I mean, white collar workers. I don't know. It seems to keep.
I'm
coming
not
up.
incensed.
In our meeting, it was a real point of discussion. I mean, what do we know about that?
Well, I mean, I think it's part of the transition, right? That needs to happen in this current day and age. Like, you're not just going to start pack up and move. I mean,
Dude, for $113 million, I'm going to pack up and move tomorrow. Like yesterday, I'm out of
What if you could do it from home? Because that also sounds
exactly. Well,
crazy.
if you can demand, if you can say, listen, you're only giving me $113 million. I want a full setup in my office at home. You pay for that. And then I'll come into the office like once in a while.
I made Chipotle stock go up like 280% in 4 years. Maybe you have some.
I mean, again, it speaks to just the fact that Brian Niccol was very clearly in demand, very clearly the guy. And so they said, okay, this is what you want. This is fine. We're going to make it happen.
It's going to be really interesting to see if they change the Starbucks work from home policy for the office workers.
Apparently, they ran it by Schultz, but they did not run it by Elliott, at least according to our reporting, right? Schultz still has a big say in what goes on at Starbucks.
I mean, Schultz is super interesting, right? Like, obviously from the wealth team, he's a billionaire multiple times over. He's also been the CEO 3 separate times, so it feels like you can't quite distance Starbucks from Schultz. Starbucks is just a super interesting one, you know, from the wealth perspective. Melody Hobson, the board chair, also is a part owner of the Denver Broncos with Rob Walton, right? And she's also married to George Lucas of Star Wars fame, right? So it's a really interesting company in terms of the billionaires and the money that's swirling around it.
It is. It is. Brian, thanks so much for joining us. Brian Chapata there on Starbucks. This is Bloomberg.
The biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? Is it just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends.
1 minute remaining.
I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg.
10 seconds.
Pricing has been going up. We're guiding in Q3 and Q4 for prices to go
Draw
up.
6 BCF, draw 6 BCF, lower than the expected build of 1 BCF.
More for those experiences. Pricing will absolutely go up in both quarters, and it looks that way for 2025 certainly as well.
They're willing to pay it. And they're also willing to book much further ahead.
The U.S. economy is a little bit stronger than people are giving it credit for, and the consumer will come back as
Seeing some
the
upside in
economy
US
continues to
natural
strengthen.
gas.
And that was a string of top executives speaking on Bloomberg Television about the consumer and specifically about travel demand. Looking now to add his insight, we have Priceline CEO Brett Keller joining us now. Brett, it's great to have you with us because it feels like for the cruises, you're still seeing really robust demand there. We were talking about pricing power with some of the CEOs of some of the big cruise lines earlier in the day on Bloomberg TV today. And then you take a look at the airlines. It's a much different picture, of course, when it comes to the forecast for travel demand. From where
We have posted the weekly EIA natural gas report on the feed for all those
I
interested.
think what we're seeing is that consumers are certainly seeking out value, and cruise lines create and produce a lot of value for consumers. It's one of the cheapest ways to travel in terms of all-inclusive meals, entertainment, et cetera, and many times you can spend less than $100 per person per night. So it's great value there. We're seeing the same thing. We have shoppers coming into Priceline specifically focused on our value offers, whether that's our vacation packages, express deals, et cetera. When you look at the flight industry, listen, TSA numbers continue to show that there's growth year on year. In fact, we're tracking 5 or 6% up year on year for the last month. And so consumers are still flying. I think what happened in the airline space is they added a little too much capacity, and so they're removing that as they look forward over the next quarter, and that's going to put a little more pressure on pricing as their prices have been down for most of the year.
I mean, what's your opinion there that maybe the airlines were betting that this post-pandemic burst of travel that we saw was going to be sustained, whereas now it seems like maybe we're returning to more normal pre-pandemic levels?
Yeah, obviously travel's been very hot for the last year and a half. Consumers were really investing significantly in that part of their spend. And so we saw a lot of travel overseas, which is a very rich part of the travel experience for the airlines. And so I think what's happening is consumers are pumping the brakes just a little bit, but travel is still healthy. It continues to be one of the highest prioritized discretionary spend categories. And we're certainly seeing that, I think, across the industry. But there are some pockets, leisure travel in particular. Consumers are being a little more careful about how they're spending their dollar as they've kind of come through this peak of summer now in travel and are looking forward to Labor Day and beyond.
Last year, Brett, AI was the buzzword in markets, and it's also something we heard a lot from companies. How have you worked AI into your product?
Yeah, thank you for asking that. Listen, we were one of the innovators of AI over a year ago. We launched a chatbot and have put that to work. And we're finding that really across the consumer booking process, this is becoming more and more natural for consumers to interact with. So they're using it not only to plan and think of itineraries ahead of booking their travel, but during the booking process itself, they're engaging in our chatbot, asking questions about the property that they want to stay at, the location, the activities nearby, and then post-purchase, they're using it to service their product. It's a much easier way to very quickly cancel a reservation, make changes to a reservation, or find out more information about a refund or other things that are important to the consumer. So we're finding it to be a very useful and innovative tool to help the consumer just smooth out that travel process all along the way.
How hard are consumers working to save money? I mean, when you say refund, it makes me think about sometimes it's not easy to get those. You've got to do the legwork. When I look at, for example, car rental prices, it always doubles once I add all the insurance and fees. And then if I really want to save money, I'll actually call my credit card and say, hey, am I insured for this rental car? Or figure out with my State Farm agent. Like, are customers doing the extra work to save the money?
Yes, consumers are absolutely, I think, taking the time to not only shop ahead of their trip, to look at the various different players in the space who can deliver the best value and the lowest price. And two, to your point, when it comes to add-ons, whether that's insurance, activities, even dining, they are making very specific decisions to fit that within their budget. And so Priceline, for example, offers an insurance product with the rental car. And we've actually seen the insurance take rates
White House's
go up.
Kirby says we have info that Iran attack could come with little warning.
Part of the post-pandemic experience, people are really trying to protect their purchases to ensure that that if, in fact, they have travel disruption or something happens on the trip, they're covered for that. And so consumers are interested in that.
Are they clicking on the insurance, the airline insurance as well? Every time you buy a ticket, the airline says, hey, if you give me $20 more, you can cancel on the day of. Are more consumers using that?
Yeah, we have seen an increase in travel insurance associated with an airline ticket purchase, especially for the bigger transactions like a vacation package. People really do want to protect their investment, and insurance is a legitimate and a very good way to do that.
I want to talk too about trends that we might be seeing when it comes to length of travel. There was a really interesting story on the terminal a couple days ago that had data from Embark Beyond, which found that the average trip length is down 14% year over year. It now averages 6.2 days rather than 7.8 days. Now, Embark Beyond, it serves primarily U.S. ultra-high net worth individuals. But are you seeing similar trends when it comes to Priceline's customers?
No, we service the value consumer, and in the data that we're looking at, we haven't seen a material difference in length of stay for our consumers. They continue to, book at a fairly normal rate in terms of how far out they're looking, and so we're not seeing a significant collapse, for example, in last-minute bookings. And consumers are, really taking the same types of trips. I think where we're seeing the focus now is on what type of trip am I going to take? And am I going to change that behavior based on what my budget's going to allow me to do? And so obviously last year and really earlier this year, we saw a lot of travel overseas, over to Europe, over to Asia. Now, as we approach Labor Day, we're seeing a lot more consumers interested in more nearby destinations. So things like Mexico, the Caribbean, the Bahamas. People still want to take that vacation. They want to get to beaches and warm destinations, but they're sticking a little bit closer than they were, say, 6 months ago.
And I mean, it's interesting to tie it back into, how we started this conversation. You think about how people are traveling. We've been talking about the trade down across industries really all year. When you think about sort of the shift from airlines, now cruises are hot really now. You see people traveling by car more. I mean, is that part of that overall trade down narrative?
Yeah, that's something we watch very closely because, it's a very rational thing to do, right? You would have stayed in a 5-star hotel, now you're going to stay in a 4. You would have stayed in a 3, and now you're shifting down to a 2. We haven't seen a material move in that trade down experience in the bookings and in the consumers that we're looking at here at Priceline. And again, I think people still want to travel, but they are looking for discounts. They're looking for deals to save. They want to do the same trip they did before, but they'd like to knock off a couple of dollars on that trip and bring the pricing down. And so, again, we're seeing a lot more interest in our value offers on our Priceline website.
All right, Brett, it's always a fascinating conversation with you, of course, as we monitor the consumer and the traveler. That, of course, is Priceline CEO Brett Keller. Let's get a check on these markets right now, about an hour into the U.S. trading day. We're going to do that with Bloomberg's Abigail Doolittle.
We have a pretty solid rally on our hands, Katie. We have the S&P 500 up more than 1%, up for a 6th day in a row, and it's extraordinary. Take a look at the VIX that had spiked to about a 65, 66 handle on the height of the yen carry trade unwind, at least that leg of it. There could potentially be more. It's now back below a 15 handle at a 14.8. Really pretty interesting. Taking a look at the dollar yen at a almost 150. The charts are very interesting here because it does still look like you could see that dollar yen slide to 130. If that happened, it would suggest that the yen carry trade unwind, that there's more to go. Right now, though, that is certainly not the case. And then another big mover here, the 2-year yield backing up 12 basis points as those claims came in better than expected, suggesting that the economy may in fact be okay. And on the other hand, suggesting that the Fed may not be able to cut as much, so yields moving in that direction. In fact, let's put this move into the perspective of recent moves to see just how big it is. So of course, here is this large move and going all the way back to the beginning of June, matching the size of that move, which was closer to, let's call it 15 basis points or so. And then finally, some movers on the day, Matt. If we take a look at Tesla, it is up 7%. Not really clear what the news is there, but it's certainly driving some of these big indexes, as are Amazon and Nvidia. A nice rebound for some of these mega cap tech names. And then, of course, there is Walmart up 6.4%. Good quarter, good guide. And it seems as though higher income folks really going there, supporting that store, but they're not seeing any fraying in the incomes of their customers. So net, Walmart putting out some good color, interesting color, but suggesting that the economy is okay right now.
All right, Abigail, thanks very much. Abigail Doolittle, look at some stocks for us an hour into the trade. Coming up, car connoisseurs are racing to Pebble Beach for one of the most important weeks in the auto industry. We speak with Mecum Auctions CEO Dave Majors next. This is Bloomberg.
The top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Morning from our world headquarters in New York. I'm Menace Crenny.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. Billionaire Gautam Adani founded one of India's biggest and most controversial business groups after being rocked by accusations from short seller Hindenburg Research last year. Adani is now preparing for the company's future in a real-life succession story. Meet the family members he's handpicked to take over the business as we deep dive into the facts and rumors surrounding the Adani Group. Inside Adani, a Bloomberg exclusive replays all weekend, only on Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rain World Cup. This is a three.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Let's get to the trading diary. This is what you need to be watching this afternoon and tomorrow. We'll hear from Philadelphia Fed head Patrick Harker this afternoon, so you want to pay attention to that on your terminal. You can type FedGo. Tomorrow, U.S. housing starts are released. Plus, we're going to get University of Michigan consumer sentiment data, and we're going to hear from Chicago Fed President Austin Goolsbee in the afternoon. He is focused on the labor picture. I also saw a great story on the Bloomberg terminal today pointing out that over the last 12 months, total debt servicing costs have been $860 billion. However, if you add in the amount of money that the Fed has to remit in interest expenses, it gets closer to $1 trillion over the last 12 months. This is how much the Fed has had to pay out in terms of interest, and the total debt servicing costs for the U.S., Katie, now exceed what we spend on the military, what we spend on Social Security. In fact, nothing else exceeds that. We spend 20% of our tax revenue just paying interest on the debt that we owe.
Yeah, $861 billion. That is what the Treasury spent in net interest on the national debt over 12 months through July. For context, that is almost double what it was 2 years ago. Of course, this is the consequence of that rate hiking campaign that the Fed has been on. But whenever I see numbers like this, of course, they're large, they're scary, we're spending a lot of money. But it kind of reminds me of what Steve Eisman was telling us about the deficit. How do you trade on this? I mean, what does it matter for investors truly in the here and now?
Well, it doesn't matter until it does matter. And when it does, all of a sudden...
Just like valuation.
All of a sudden, the way you want to trade on it is to have sold everything before.
Right.
You know, just buy water, canned food, and guns.
I want you to give me a heads up right before that moment happens.
You know, obviously we don't see it kicking off now. And when I talk to investors about this, they all say, look, treasuries are trading at 4%, right?
Yeah.
The dollar is strong. No one cares.
Fine.
But at some point, someone will care. It's still, you notice when you look at the Democratic platform, what's being built of it, when you look at Donald Trump, when you look at the Republicans, no one cares about reining in spending.
And I don't know if it's going to come up necessarily when we get to the debate stage finally, whether we're going to get that level of substance, but we'll have to see. In any case, in the here and now, we're looking at a rally, a green day on the screen. If you take a look at the S&P 500, up over 1%. Even more so, if you take a look at big tech, what a move we're seeing in the NASDAQ 100, up about 2% right now. Of course, we got retail sales coming in better than expected. Of course, the consumer is still resilient. They're still spending money. At the same time, of course, you have inflation coming down. We got that softer than expected PPI. You add it all together, and really, it kind of looks like a soft landing here, and you're definitely seeing that reflected in the markets, Matt.
All right, yeah, the rally over the past 5 days really has been amazing. I mean, we've been up, 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 and completely erased all of the losses that we had on that manic Monday.
No one's thinking about interest expenses. It's crazy.
It's true. No one's thinking about interest expenses. Nobody's terribly worried about the slowdown that we were worried about. The carry trade hasn't freaked anybody out. We just continue to run, and investors are willing to sell off treasuries as well.
There you go. All right.
We are going to go out to the West Coast, live in Pebble Beach for one of the most important weeks in the auto industry. We'll speak with Mecum Auctions CEO Dave Majors next. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
plenty of economic data coming out this morning, of course, headlined by that blowout retail sales number. Here to break down everything we've learned about the economy this week, I'm pleased to say we have Mike McKee, Bloomberg's chief international economics and policy correspondent. And I'll ask you the question I've been throwing to our markets guests. You think about what we got in PPI, CPI, and now retail sales. I mean, is this nirvana? Is this the soft landing?
I tweeted that earlier today. I think that there was a senator back in the Vietnam War days whose idea for ending the war was declare victory and go home, just leave. And I'm saying they should declare soft landing and go home, cut rates, and say we did it, because it's about as good as you're going to get right now. The Fed wanted to slow the economy, and retail sales shows a slowdown, but it doesn't show any kind of hard landing or crash, and obviously inflation continues to come down.
And of course it depends on which quintile you're in, right? Because in some circles, spending continues unabated.
Well, we've seen the money people got from the pandemic has pretty much evaporated, which means that people at the lower income scales are spending on their paychecks again, and they tend to spend most of it. And so you see the impact, more people shopping at grocery stores and at lower end stores. Walmart today was a good example of what's going on, because they reported that they're seeing more people from upper incomes come in as well, as people trade down to try to take advantage of lower prices. We've seen inflation rates fall, but inflation levels are still high. And Walmart hasn't seen any diminution of its regular customers, so they're still seeing people out there spending on pretty much everything, and now they're bringing in more people.
Including pool noodles.
Yes, so many pool noodles.
How many?
In fact, if you spread out the pool noodles sold by Walmart in the last quarter, it would cover 30,000 football fields. So I just worked it out. I'm not sure if I'm right, but that's about 1,700 miles. Anyway, Mike, thanks so much for joining us. Mike McKee, their Chief Economics and Policy Correspondent. Monterey Car Week kicks off today in Carmel, California, with rallies, races, new car debuts, and the most important classic car concourse in the world at Pebble Beach. Plus, there are always record-setting sales. The average price of cars auctioned off at Monterey is now about $1 million a piece, and the average age of those cars crossing the block keeps getting younger every year. Mecum Auctions CEO Dave Majors joins us now from Pebble Beach to preview his three-day sale. Dave, thanks so much for joining us. I'm so jealous that you're out there. I know it's your 15th year. Talk to us about, I think it's very interesting that, you know, I don't know the exact years, but the average age of a car crossing the block in Monterey was like early 60s 10 years ago, and now we're creeping into the 70s. So newer vehicles are becoming the big hits, right?
Yeah, and I think, you know, even if you look at the collections that we've brought here to Monterey, what we're starting to see is a lot of interest in the later model exotics, the Porsches, the Ferraris, Mercedes are getting a lot of attention in Monterey, as well as, you know, even pre-war. We've got a Delage here, we have a Delahaye, we have a Packard that's here. So you have pre-war cars, and then of course we have the mid-50s and 60s. We've got some 60s and 70s American muscle cars, but then there are a lot of exotics too. I think that I counted the number of Ferraris here at our auction. There are 26 of them. The earliest is from 1952, and the latest is from 2021. So pretty much everything in between.
Are all of these prices, Dave, continuing to rise? I mean, obviously we have high net worth investors watching Bloomberg television, and during the pandemic, prices for any vehicle were up. But did any of them turn over, or did they just go up, up, up?
Well, actually, coming out of the pandemic, starting in 2021, we saw pretty much a meteoric rise in prices of vehicles across the board. And as you know, even used car prices escalated significantly during that time period. But collector cars, it didn't matter if it was pre-war or late model, they all were going up 25–30% a year. The sell-through percentages were going up. We're a reserve auction. When we would go to auction, we were selling 90% of the cars that would cross the block, which is about 20% higher than typical. What we've seen starting in 2024 is not a retreat necessarily, but we have seen prices flatten out. And I would say we're probably going to see that in 2024, and I expect that to continue on into at least the first part of 2025. And of course, what we've seen in the collector car auction business is every presidential election year, we see a little bit of market stabilization. The market goes cold for just a bit as everybody stands by to see what's going to happen in the White House.
Which car do you expect to garner the highest price that you're selling, and what makes, you know, a record setter worth that much?
Well, we have a 1969 Ford GT40 Mark II that will cross the block on Saturday. The expectation is somewhere north of $8 million for that car, and that's a car that everybody's familiar with now because of the Ford versus Ferrari movie. It is one of the Ford versus Ferrari movie cars, a later version of that car, but actually the Mark II was a car that was built prior to the Mark III and Mark IV that you saw in the Ford versus Ferrari movies. But it was a smaller engine block, and the Ford decided that they were going to put larger engine blocks in their vehicles, consequently won Le Mans 66, 67, 68. And then it was decided that engines and power plants were too big in cars that were racing in road races, and the rules changed, and the Mark II came back in with its 289 and had success in racing careers after starting with 1969. So it is the heritage of the Ford GT40, and of course we know 2005, 2006 Ford brought those cars back, and then they brought them back again in 2017. So very recognizable car and has a great provenance.
I like Gen 2 myself. Dave, thanks so much for joining us. Dave Majors of Mecum Auctions, coming to us from Pebble Beach. For all things cars, by the way, you can and should listen to my podcast, Hot Pursuit with Hannah Elliott. You can check it out on the Bloomberg Terminal or wherever you get your podcasts.
You know, I've listened to it, actually.
Have you?
Yeah, I listened to your interview with Jim Farley. It was pretty good.
CEO Ford, that was a good one.
Yeah, I would recommend it. Anyway, you take a look at markets right now. We're still rallying. The S&P 500 up quite mightily on the day, up over 3% for the week. Of course, before we get to Friday, we'll continue to follow all of that and more. This is Bloomberg.
Saturday mornings, I understand you have off.
Yeah, Saturday is always a day where I power down. So I run at a relative high pace throughout the week, try to wrap things up, and Saturday is a quiet day for me in terms of work. And I start typically by playing tennis with my wife. We go for a swim all year round. After that, have a nice lunch, and then I'm on to a good trajectory for the weekend. And then Sunday, I try to prepare for the coming weeks. But through a weekend, I would send either no emails or very few emails, because I want to drive a culture where all get an opportunity to spend the weekend as they fancy. I think what we do is so difficult, and it takes so much creative thinking to succeed, that if you're always on, always busy, the bandwidth of your reflection is just too narrow. And I generally believe that Monday mornings I'm a better leader than I am, say, Friday afternoon. I also take all my vacations. I generally believe I'm a much better CEO right after a vacation than I am before vacation.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
The US to sell $76 billion in 3-month bills on August 19th to settle on August 22nd. The US to sell $70 billion in 6-month bills on August 19th to settle on August 22nd.
Investor moves as Soros and Druckenmiller, well, they sell out before the sell-off.
And the Tesla
The US to sell $8 billion in 30-year reopen tips on August 22nd to settle on August 30th. The US to sell $16 billion 20-year bonds on August 21st to settle on September 3rd.
About the whopping $14 billion valuation. But first, let's check in on these markets. We are having a strong day. Good news is good news again. The retail sales coming in, the fact that jobless claims are also showing a strong US economy. But yes, we might not factor in the rate cuts coming hard and fast, but there still can be room to cut for the Federal Reserve. So we're up 1.8% on the NASDAQ 100. Look, the bond market is pricing in what seems to be a more resilient economy and one where perhaps we can't cut into a fast pace, but still 12 basis point move on the bond market, a sell-off, but still movement into the tech stocks. Ed, what are you watching on the micro?
There is a lot to cram in this morning. Earnings is a part of the story. Cisco, look, it's markedly higher. Job cuts confirmed, but a strong outlook for sales and a pivot to the cloud, cybersecurity, and of course, artificial intelligence. Later in the show, we'll get deeper analysis in-house with Bloomberg Intelligence that you'll want to tune in for. Then we go over to Asia, actually. Really interesting in both China and Southeast Asia, the earnings story. Alibaba's ADRs, those are the US-listed shares, are higher. They've been lower overnight because of a kind of weaker sales outlook that we were worried about. JD.com flying higher. The e-commerce and digital story in China strong with them up 5%. And then Grab down 6.3% on the ADRs. Ride-hailing in that Southeast Asia market, there seems to be a lot of competition impacting JD. We will go over that. And then there's all of the 13F interest in who is buying or not buying or holding or not holding or selling and reducing their stake in tech globally. Lots to discuss.
That is such an interesting part of the story today, and we're going to delve right into it. Because, look, we've got George Soros, you've got Stanley Druckenmiller. Both their investment firms actually managed to trim their holdings in the Magnificent Seven stocks before the major downturn in such tech names back in mid-July. Pretty prescient. For more on the story and other investor moves, let's bring in Bloomberg's Hema Palmer, who's joining us on the daily at the moment. Hema, look, it does feel like they managed to cool this a little bit. Tell us about the names that they trimmed.
Yes, so we care about these titans of the industry, billionaire investors. They sold some of their stake. George Soros sold some of his stake in Alphabet and Amazon. So some prescient moves there. Stanley Druckenmiller sold some of his exposure to NVIDIA. Also quite interesting. David Tepper, another family office investor, former hedge fund manager, cut some of his stake in Amazon, Microsoft, and Meta. So we do see some trimming of those tech positions ahead of what was a pretty significant sell-off.
We kind of discussed this 24 hours ago, Hema, but you know, they come thick and fast, the 13F filings. You see individual fund names that are stock pickers in particular. They go one way or the other. But in aggregate, was it a good second quarter for technology or a bad second quarter for technology in terms of going in and out?
Yeah, so I would say in aggregate, we did see some selling of some tech bets, which for the investors was a pretty good move ahead of the volatility that we saw. So we did see some selling of Microsoft, 140 hedge funds sold that stake, some trimming of Meta, some trimming of NVIDIA. Apple, though, a popular stock buy, the most buying we've seen in about 3 months.
Unlike, well, the Oracle of Omaha. I'm interested in the Tiger Cubs that we talk about so much. What moves have they been making? Have they been making back any of the losses, basically, we've been so accustomed to of late?
Yeah, so their performance, we did see a little bit of a downturn during the volatility. Not terrible, but not great. Every month does matter when it comes to these funds that are trying to dig themselves out of a hole. But in terms of their 13F positioning, some interesting moves. United Health seems to be a popular buy for these funds. Tiger Global started a brand new position in that company. It's 7th largest holding. Co2 started a small stake. Lone Pine bought some as well too. So United Health did seem to be a little bit popular. D1 started a brand new position in XPO. That's a logistics company, and that's now D1's 5th largest holding. So we do see some kind of interesting moves on the margins in companies that are not necessarily traditional tech.
Bloomberg's Hema Palmer, thank you very much. Alibaba reported earnings, posting a disappointed 4% rise in revenue, even after aggressive promotions to try and drive spending. Joining us for more on the China tech earnings story is Bloomberg's Isabel Lee. The ADRs are higher, though, now. It's kind of interesting when you go from the Asian session into the US session, but overall, it's sales growth weakness that we're worried about.
It's slightly higher. I think investors have digested the news overnight, but they're still not that thrilled. The 4% rise in revenue, you're correct, it was a rise, but it was anemic, and we have profit plunging around 27%. Alibaba really has just struggled to drive its growth. We have Eddie Wu, the CEO, who was installed last year, making it his priority to focus on the twin business of cloud computing and commerce. He has also been making bets on AI in the long run, but investors have been worried that Alibaba's intense drive to beat its competitors, PDD and JD.com, will compress margins, and the three-way rivalry among those have been really intensifying for a while. And a little quick note, Alibaba's biggest rival, Tencent, reported better than expected earnings, but we did have the company warning of weakening consumption, and JD.com also reported better than expected earnings. So it's really Alibaba that's kind of in the backseat for now, but it's just one quarter, and zooming out, the economy in China is still not looking that fantastic, Ed.
I mean, it's interesting, just going back to the 13Fs we were discussing, we understand that Michael Berry, for example, has actually been beefing up his Alibaba stake. People do believe in a turnaround for this business. Is it all to do with ultimately a weak revenue stream, a weak consumer? Because they did seem to really put it away when it was GMV focused and indeed margin focused.
Yes, Michael Burry did increase his Alibaba stake by around 7%, and we also have David Tepper slashing his Alibaba stake for a little bit, but it's still the biggest holding in his company. And I think that's really the main question. Would you invest in China because now it's cheap? We have the other end, though, saying that they will not invest because it's cheap for a reason. If you zoom out, we have the latest data from China still showing an economy weakening. We have domestic demand faltering. We have property crisis that is still prolonged in slumping. So it's really not proving to be better. But then if you ask others, they're still seeing a bright spot. I mean, no economy goes up in a straight line. They see this as a blip in China's economy, but still believes that this second largest economy in the world will be a bright horizon someday.
I mean, as we're saying, David, trimming by 7%, Michael Berry upping some different views on individual names. But I'm interested as to, we were talking of Alibaba more of the rejuvenation, the reorientation, the dissecting of this business. What does the future look like? How are they managing to stabilize? How are they thinking about IPOs and the like? Any hints there?
With the IPOs, it's still unclear, but you can see Alibaba really making a big push into the AI space. So that's the good news. But the bad news is its rivals are also doing the same. And you see the same thing play out here in the US, the AI halo, so to speak. But now it's kind of fizzled a little bit. We have investors already questioning when they will see the payout of their millions of investments into AI. But in China, the same is playing out. Alibaba has made huge stakes into the AI industry, and so has PDD and JD.com. And that's why I think it will just always be a three-way rivalry for those.
Bloomberg's Isabel Lee on the China Tech Beat. Thank you very much. Let's discuss whether Alibaba's strategic adjustments could position it to recapture market share from the likes of PDD and other competitors now, with Jacob Cook, CEO of WPIC Marketing and Technologies. It's a firm which drives market expansion for global brands in China, but also Japan, South Korea, and more. And it was interesting. I wanted to kind of start talking about the e-commerce landscape, but as Isabel outlined quite clearly, those same e-commerce names are increasingly thinking about cloud, basically, and AI. Good morning, the e-commerce market in China.
Yeah, good morning. It's really kind of gone from a two-horse race over the years between JD and Alibaba into a four-horse race now, with with China's TikTok, Douyin, and PDD. What we really liked, I think, about the reports that came out as we've kind of digested through them is they're actually maybe a little bit disappointing on the overall revenue, but showed good growth in terms of GMV. And up until now, a lot of the growth from the competitors is actually eaten into a lot of that. So it's stabilized there. And it also stabilized with JD. That was a great result too as well. So in terms of that landscape, JD had a much shorter cycle in terms of changing what they wanted to do from the subsidies that they were giving away to consumers many years ago to really operational efficiencies and getting closer and tighter supply chains. So that changed. I think we saw 92% increase in profit with them. So that was great. Alibaba's not through that transition yet. Eddie Wu's been very clear about that he's not really focused on bottom line profits yet until he gets a lot of this divergence and restructuring and stuff done. And we've seen, their GMV hold as well. And I think it was even up a couple of points. So that's been really good. And I think that tells us that they're probably pretty happy with where they are in their transition.
Jacob, how destabilizing for the global brands that you represent is it when a company such as Alibaba is doing a reorientation, a restructuring? How willing are they to stay with, to try and grow in China at the moment?
I think extremely well. I think Alibaba has always been a very good partner. The people in the, that you end up engaging with as a brand out of their Hangzhou campus are actually very professional, and usually a lot of the best in the business in the individual categories too. But what was also announced is we're going to get a whole bunch more merchant programs too as well, and new ways to advertise. So we're excited about that level of innovation. Overall, customer acquisition costs have been fairly stable on Tmall, and they've been relatively attractive for brands to do that. It's been actually more destabilizing to have to really rush into these other trends at PDD and Douyin, which have completely different approaches to e-commerce.
In the moment, JD is the outlier. Shares are up significantly, right? Is it the outlier? Is there a point of difference in its place in that market and its strategy?
Yeah, it's a simpler business. It doesn't have all of the massive business units that Alibaba does in terms of especially cloud computing being much larger. And they announced really what they were going to do with restructuring and stop with these subsidies and race for customers is really focus on operational efficiencies. They did go through a round of management layoffs a couple of years ago. And to us, what we look at is that sort of being very successful. And again, I think the differences here between the two of them is what's going on with Alibaba and how they're going to compete against in the new e-commerce landscape is a longer transition process. And I see them being about halfway through that right now.
What's your main piece of advice for a company that's wanting to access e-commerce growth in China right now?
I think my advice is to actually go for it. I know there's a lot of headwinds in the economy, especially due to real estate, but if you take away luxury goods, which really isn't aligning with that new younger consumer that's more into Lululemon, and you take away durables, which are related to new home sales, e-commerce growth in China is still lower double digits. And we saw, a great 618 a couple months ago, and we're all really optimistic about 1111 in a lot of categories, excluding the ones that I just mentioned.
Jacob Cook, CEO of WPIC Marketing and Technologies. We really appreciate the expertise. Thank you. Coming up, a closer look at how Google search might be providing the giant with the AI advantage. That's next on Bloomberg Technology.
If you look at private equity just as one piece of the institutional equity market, there are 3 times as many dollars invested than uninvested, right? So you have about $3.5 trillion in the ground that needs to get resolved versus about $1.5 trillion that's wanting to be invested. So if you're a private equity manager, you're trying to decide, do I take my capital and put it into my existing portfolio to either defend what I own or to try to grow it and create more value? Or do I use some, to your point, some creative financing to extend the duration or the runway of what I own and then try to put the capital into the new market environment? And everyone's taking a different approach. It's a function of where you are in your life cycle. Everyone is dealing with that. Even the highest performing PE firms, you're seeing slower fundraising. And in this deal environment, you have to start thinking creatively about how to get liquidity back to your investors.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Taking a look at Google, following the federal court ruling last week that Google is an illegal monopoly. We're taking
Fed bids for 4-week bills total $301 million.
Publishers face a choice between offering up their content for use by AI models that can make their sites obsolete and disappear from Google search, which is a top source of traffic. Let's break it all down with Bloomberg's Julia Love, who joins me here on set. What we're really talking about here is web crawler. In other words, a mechanism to go through a website's data and position it in search. And that gives Google an advantage because some of that data ends up in the training of large language models, essentially. Good morning.
Good morning. Yes, so Google has been at this for decades now. It crawls the web, millions of different sites, to be able to show a detailed index to users. But that now gives it an edge over search startups that are trying to get into the game because they want to crawl too. But many websites block pretty much everyone from crawling except for Google and Microsoft's Bing, and so startups are at a real disadvantage.
To choose whether or not to crawl, ultimately, Julia, there's also the macro perspective that regulators are really worried about this advantage that Google seems to have in the world of AI. They already think it's a monopoly in search. This might just double down on it?
Yes, absolutely. I think this underscores that this is just one of many advantages that Google continues to have in the AI race. Publishers face a difficult choice. They're very worried about the AI overviews that Google displays at the top of search and what that could mean for their traffic. But they worry that if they blocked the Google bot from crawling, then that will affect their visibility of Google search, which would just be a death blow. And that's a consideration that they don't face with search startups like Perplexity, where it's easier to just block the crawler.
Meanwhile, I think Overviews is going live in new countries today. Julia Love, brilliant to have you. Thank you. Now let's take a look at all of this in the context of the reports that Bloomberg has been bringing you about the Department of Justice considering breaking up Google. It would be a rare antitrust move. Let's bring in Sarah Olam, Senior Fellow at the Technology Policy Institute. And Sarah, we were just hearing about ultimately the fears that AI, the dominance that Google has in AI, just once again doubles down on its monopolistic traits that have already been seen. Do you agree with that? Do you think that antitrust and breaking it up could help?
Well, right now we're 10 days out after Judge Amit Mehta released a ruling on August 5th after a 10-week bench trial on U.S. versus Google. And so the talk about remedies of possibly breaking up Google, that's all going to start September 4th with the remedies hearing. We can talk about what those remedies are being floated as, but we won't know what the Justice Department recommends until then.
We won't know, but one of the ideas that we reported is on the table, citing sources, right, is the divestment of data. If you read the story, the original report from Bloomberg's Neil Nyland, that's what is being discussed. Maybe you divest it is its own entity. Do you see a way that would work in practice, Sarah?
Well, what's interesting is Android was discussed at the Google Pixel event as being part of implementing Gemini in with search. The Android question is very interesting because it's a global market for Android, and the U.S. market is only a fraction of who uses Android. It's not clear at all that Android is core to the general search question in the monopoly trial. So we can discuss whether that could help with remedies, but really what I think is more likely is that limits on exclusive contracts and defaults would survive or would be more reasonable within scope. But definitely people are talking about the operating system market, the browser market, how AI fits into everything. But one thing to note, though, is that, like the Microsoft case, like the AT&T case, it's going to take several years for this to go through appeal and remedy and settlements. So what is AI-powered search going to look like in 3 years, 4 years? I think that's an important question.
Sarah Olam, Senior Fellow at the Technology Policy Institute. Thank you. Now, coming up on the show, we'll discuss Elon Musk's platform X and whether it can recover from its advertiser loss. We get the Bloomberg opinion take. That's next. Karen.
At 11:30 a.m. Eastern Time, the US sells $95 billion in 4-week bills. Prior high yield 5.285% and a prior bid cover of 2.77.
Shares absolutely plummeted. Now revenue growth is back on more than 20%. We rally. This is Bloomberg Technology.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Is X a failing social network? Well, that's the hypothesis come from Bloomberg Opinion's Dave Lee, saying in his latest piece that with the platform losing advertisers, even getting under increasing scrutiny from regulators, the social platform, quote, reeks of failing social network syndrome. Bloomberg Opinion's Dave Lee is here with more, and you use, reorientate a phrase from a pretty famous restaurant critic and repurpose it. Look, why does it reek of a failing social platform? For many, with the Trump discussion, it's one of the most active it's been for a while.
Well, this is a phrase that Anthony Bourdain, as you said, used to describe restaurants that were going under. And the way he described it is it wasn't that they'd go under overnight or even for a few months or a while, but there's something in the air when there's a place that isn't quite right. And I said that applies to X, formerly known as Twitter, of course. And it's for many reasons. I think what's happened on that network since Elon Musk took it over quite clearly is it's become almost a single issue network for Elon Musk's politics, this issue of the culture wars, as we describe it. And what is happening less on X is some of the communities that made many normal people want to use it in the first place. So if we're talking about football, talking about music, talking about books, whatever, those communities are finding it harder to interact with each other, and certainly no new people seem to be joining those discussions in a way they might have done previously.
And look, if you go to your own X page, you haven't been posting since 2023. But you were almost forced to re-engage with the platform for this story, and then Elon Musk re-engaged with you.
Yes, quite. So I haven't posted for almost a year, and that was based on my feelings towards what my feed was showing me in terms of the types of content I was getting without following certain users. And I didn't feel like it was well, this is something that Elon Musk sent to me today. Or mentioned me about today. I checked my screen time. It's actually an average of 19 minutes a day this week, and that was only because I downloaded the app to listen to his conversation, his interview with Donald Trump earlier in the week. So without that, which went on for almost a couple of hours, I think, my time on X would be very, very minute. I check in on it to see what's happening. I'm a journalist, of course. I need to do that. But in terms of engaging with the network, I think its usefulness has gone now.
At 11:30 a.m. Eastern Time, the US sells $95 billion in 4-week bills, prior high yield 5.285%, and a prior bid to cover of 2.77.
I use X a lot. I spend a lot of time on the platform. I share a lot of my reporting. I don't see a lot of data supportive that video does very well when I show video to the content. And it's interesting, one of the communities that does well there is Tesla, of course. But your issue in the opinion piece is about advertising, advertiser flight and money. Does Musk even care about the advertisers? Is it even a priority for him to have revenue growth as a basic question?
I mean, look, we've seen what Elon Musk has said directly to advertisers in words that we can't repeat on air, only to then, a couple of months later, now sort of be suing some advertising groups in order to, say, punish them for boycotting the platform. I mean, look, I think Elon Musk is quite sincere when he says he doesn't care if advertisers don't want to advertise on his platform, given he thinks it's now this sort of this arena for free speech. But the problem is he'll need to care, right? I mean, this is a website that needs money to survive. As rich as Elon Musk is, it still needs to be a functioning business. And I think that's going to be Twitter's problem as we go past the election, because right now I think a lot of the attention on it is to do with the presidential election. Once the votes are counted, people may move.
Yes. I have a lot of questions about monetizing Grok or monetizing X through Grok and XAI. Bloomberg's opinion, Dave Lee. Thank you very much. Coming up, we're going to talk more about Tesla's self-driving feature with that analyst. This is Bloomberg Technology.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo Pet Products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that you know most households where most of the dollars go against the pet, but
Shortly expecting the results of the 4-week bill auction, I'll lead with the high yield.
Supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
Good morning from our world headquarters in New York. I'm Menace Crennick.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco. A quick check-in on the markets. NASDAQ 100 is up for a 6th straight session. There was a 7-day run of gains that ended July 10th, and we've talked a lot about how over many weeks, actually, the NASDAQ 100 was under pressure. We're kind of bracing still for NVIDIA earnings on the 28th of this month, but now the 13F look back, some of the economic data is a factor. Those single names are quite interesting. Again, it's kind of backward looking. But if you think about the mega caps, there were notable funds, Soros, Druckenmiller, who cut exposure to certain mega cap names in the second quarter. Many increased their positions in NVIDIA, which is notably higher today, having gone past the high, which was, I think, July 18th. Tesla is also interesting, up 6%. Some funds increased, some funds decreased. No real news catalyst out there, but we're going to get to a really interesting conversation on Tesla and full self-driving in a few minutes' time, Kara.
Yeah, first, let's just quickly check in on a big mover today. Cisco rising after giving a pretty bullish revenue forecast for the current period. It's all about a rebound in orders, even though it, of course, announced plans to cut thousands of jobs as part of a strategy shift. Let's get to Bloomberg Intelligence analyst Woo Jin Ho. And Woo Jin, look, it's that inventory digestion that is now in the rearview mirror, but job cuts looking forward.
Yeah, hey, thanks, Caroline. So I think part and parcel in terms of the job cuts, I thought the first round of job cuts that they announced a couple of quarters back wasn't enough, and essentially they're trimming the fat on their legacy business to really drive up the cash cow of the networking business. Now, one of the things that they said on the call was that they're rediverting some of those cost savings to the growthier parts of the business, which is essentially the Splunk observability plus the security side of the business, which I think is the right move.
Woo Jin, good morning. It's Ed in SF. What's the Cisco story? You know, when Ian King was on the show yesterday reporting, it was about a company in transition. I thought that
5.26%, 5.26%, bid to cover ratio, 2.9, 2.9.
And Ed, you know, Ian is 100% right. The way I view from a revenue standpoint, fiscal 2025 is going to be a transition year, just primarily because of the backlog headwinds. There's some residual backlog headwinds that Cisco is going through. But one of the things that they are trying to monetize is the data that goes inside the network. And that's one of the reasons why, or the main reason why they made the Splunk acquisition. Now, it's going to take, like any large acquisition does, it takes several quarters to really integrate into the system. And then with the hopes of possibly monetizing the data for faster growth and better margins.
Is there an AI story for Cisco? You know, if you think about some of the trading action, particularly June, July through August, maybe it was the idea that there isn't as much of one as we thought.
Yeah, so a couple of things to that. From a core networking standpoint, there was a small AI story. What they said on the call was that there was an additional $1 billion of orders. So that brings it to about $2 billion of total cumulative orders that they see to date. But from a revenue standpoint, it's not that small on a $55, $56 billion base. But the longer term is, if we think that data is going to be gold to fill to fuel these large language models. You know, Cisco is potentially in the nexus of that, right? Because data has to run through the network.
Woo Jin Ho, all things Cisco, we thank you. Now, let's just get back to Tesla. Ed, you were pointing us there a moment ago, because last month we spoke with Truist analyst William Stein, who said he nearly crashed while using an older version of full self-driving in a Tesla demo car. He published a research note on the experience, claiming FSD just wasn't ready for the prime time. There was a lot of questions for Will from around the world and why he didn't try the latest update of FSD. So why didn't he film that experience too? He went back to the Tesla store. He took the test again, this time using version 12.5 and an updated iteration of FSD. His conclusion, look, Tesla's FSD version 12.5 was a fast fail. Will Stein, he's here with us. So why was it a fast fail?
Well, very early into my test drive, FSD took this car through a red light, making a left turn from the second to left and not turn lane. It's an illegal move. Didn't feel terribly unsafe, but clearly illegal. If I were driving the car and there were an officer there, I'm pretty confident I would have been stopped. So from my perspective, even though I didn't get in a crash, and it wasn't even safe for me to really intervene. It was safer for me to let the car make this turn. This was a clearly illegal move. So from my perspective, this was a fast fail.
Let's do this again, Will. The basics of the test. Where were you? Whose Tesla vehicle were you using? What was the duration of the test? And why did you not film it in full?
Yeah, let me address the last question first. I'm not a video vlogger or whatever. I'm not a social media personality, right? I'm an equity research analyst at Truist Securities, writing research for our institutional investor clients. Film or video is not a typical media that I operate in.
Okay.
Regarding the test, it was similar to the two prior ones that I did, and that included using a test vehicle from Tesla with the latest software that they had available at the time. It's in suburban New York, and it was about a 10-mile drive that I asked the car to take me on, just to a local spot close to where I live, and back. And that was the test. And in each case, there were different characterizations of how the car felt and the level of safety. But in each case, there were failures, making it really not, let's say, appropriate to think about full self-driving in the way that a robo-taxi would.
Well, a lot of people ask me, why are you getting this guy on the show? And you kind of answered that. You are a research analyst who provides research to institutional investors looking at Tesla. But what interested me is you are a semiconductor and AI analyst. And Elon Musk says on the earnings calls with some regularity, to understand our future as an AI or autonomous driving company, go and use it for yourself. So you did. My question, your thesis on the jump from your test to a robo-taxi future at Tesla, why do you not see it?
Well, it's just not obvious today, right? Now, the company is already generating revenue from FSD. It's one of the three major AI projects that we know about going on at Tesla. We believe there's significant value already embedded in these AI projects in the stock, so we think it's important to understand whether this works or not. My assertion is that it doesn't work today. That doesn't mean that Tesla can't generate revenue from it, and it also doesn't mean that they can't get there eventually. It's just not ready today.
And there is the crux of the issue. How important is it that we see robo-taxi in October?
Well, I think the idea that FSD needs to work is critical to the stock. In my opinion, only about a third of the stock's value is wrapped up in the automotive production and energy capture and storage businesses. About 2/3 of the value of the stock are wrapped up in these AI projects. So he's got to show something at this robo-taxi day. He's already pushed out that date from August to October. But if we have the supposition that robo-taxi will depend on FSD, that is not ready. So let's see.
Will, I'm an FSD user. I got version 12.5 the day it was released. I'm on 12.5.1.3 at the moment. It's not perfect. Today I completed the dog leg at Lombard and Van Ness for the first time. Will you keep testing with this regularity?
I'll test when there's, let's say a reason, a major upgrade, or if there's a request by the company. Elon Musk told me to, is the way I like to say it, right? After Q1, he challenged investors to go try it. I did. We wrote about it. After Q2, same thing. The criticisms I got were around, hey, 12.5 is such a massive upgrade, you're missing the mark. You have to go try this newer one and see the improvements. And I did that. And I would say, improved in some ways, but still a critical failure in my opinion.
William Stein, Truist Managing Director of Tech Equity Research, thank you very much.
Thank you.
Next, Singaporean state-owned investor Temasek spent billions of dollars in the second quarter buying shares in US tech giants. Just before the sector dropped in July, Temasek increased the value of its holdings in 11 big tech firms by $3.3 billion in the 3 months through the end of June. The majority of the increases went into 6 of those names: Microsoft, Apple, Nvidia, Alphabet, Meta, and Amazon. By the end of July, however, most of those companies saw their stocks slide amid concern about the extent of AI-related gains and also fears of a recession. Okay, coming up on the show, we're going to be joined by Trey Stevens, Executive Chairman, co-founder of Anduril, and a big investor partner at Founders Fund. That's next. This is Bloomberg Technology.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
AI, how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea, but ultimately you still have to do a lot with it. To just give you very superficial ideas, and but at the end you still have to customize and how to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment. Yeah.
Are you concerned one day we won't be able to differentiate designs by AI and designs by an actual designer?
I don't know. For me, I see that when the designer doing is the spirit, is the heart that the computer don't have.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Time Time for Talking Tech, and first up, Apple pushes ahead with a tabletop robot. The company's moving forward with the development of a tabletop home device that's said to combine an iPad-like device with a robotic limb. The tech giant has several hundred people working on the new hardware as it searches for new sources of revenue. Plus, Nvidia is said to have scrapped millions of YouTube videos without consent from creators to train and develop its AI models. That's according to a new federal lawsuit filed in California. The AI darling allegedly instructed employees to use tools to download videos and evade detection in an effort to train its Cosmos AI video project. And fintech firm Klarna is said to be close in choosing Goldman Sachs to lead its US IPO next year. That's according to sources who also say the company is seeking a valuation of about $20 billion. Deliberations are ongoing. Details of the IPO could change. Kara.
Well, talking of companies that are currently private and doing some big rounds, defense technology startup Anduril has raised $1.5 billion in a new funding round and plans to spend hundreds of millions on a new facility to manufacture its rockets, its underwater vehicles, and other autonomous weapon systems here in the US. Tell us more about the deal. Trey Stevens is executive chair, is co-founder of Anduril. Of course, you're a founders fund as well, which puts a big chunk of change into Anduril for a $14 billion market capitalization. The raising of funds is for manufacturing. Where will that be? Why make it in the US?
Yeah, the investment by Founders Fund officially makes it the largest position that Founders Fund has had in our 20-year history. So as the founder of the company, co-founder of the company, that's kind of exciting on both sides of the table there. The Arsenal One project is a significant undertaking for the company. It's kind of predicated by this recognition that our weapons inventory in the United States literally is missing a zero on the end of it. And we may be okay on day 0, stretched on day 30, but there's no way that we have the amount of equipment that we need if we were to go into an active conflict on day 300. What Arsenal is all about is putting our own skin in the game rather than asking the taxpayer to pony up all of the risk, and giving a head start, a leap into production of these systems at quantity, so that we're not asking the taxpayer to do that by themselves.
But the taxpayer does do it for legacy rivals. Why shouldn't they do it for you? Why do it on your own?
Right, that is the historical model. The problem is that is exactly what slows innovation, because the business model of the legacy defense industry is cost plus. It's let's wait until the government pays us to do something and then we'll get some small amount of margin on top of that. This isn't the way technology innovation works, as you know. The requirement is to step up, put your own capital into internal research and development, and then you have to kind of take the position of betting on yourself, that the thing that you're building and developing is the thing that the customer is going to buy at the end of the day. And that's exactly what we're doing at Anduril.
Trey, good morning. I saw a post from your social media about the location of the facility. I think you might have been facetious, but where will it be? Not San Francisco, but will it be in SoCal?
Right. I was frankly amazed at the amount of people that thought I was being serious when I said that we were deliberating putting it in San Francisco. We're obviously not putting Arsenal One in San Francisco. I think there are a lot of states that are very much in play.
Interesting.
This will come down to site availability, greenfield versus brownfield, and the incentives that we're able to get from the states to accelerate as quickly as possible into the program. So not sure yet, can't really comment any further than that, but hopefully we'll have more information in the coming months.
There are just so many people that credit Anduril as being sort of the leading defense tech startup, right? You talked to Kara really interesting about don't put the burden on the taxpayer to fund the growth of operations. But I'm trying to sort of build a timeline of when all of the big money from government does go to Anduril, and that there's an openness to just engage with Silicon Valley.
The culture is certainly shifting. We've seen tremendous moves since, honestly, SpaceX and Palantir were founded earlier on in the 21st century. Anduril is stepping into that wave. We have the benefit of being able to stand on the shoulders of giants that have done an incredible job creating that market space. I think the defense tech industry as a whole has seen a major boom that you guys have talked about quite a bit here on air at Bloomberg. The question is really about how much the government is going to be able to lean into picking winners, not in an unfair sense, but really in the sense of identifying the companies that are going to be able to scale to the size of the problem. And that's the focus that we've had since the beginning, is not on research and development projects, but on scaling into production requirements that the warfighter has. And that's a culture that's shifting over time as we move away from very high cost, low volume, legacy, exquisite systems into some of these higher volume, attritable assets in the autonomy space that we're focused on as a company.
How does the cultural change depend on who's in the White House? It's a sensitive question, but when you look at who's first put money into Anduril, well, J.D. Vance was one of them. He could be in the White House. Would that make a big change, do you think?
You know, it's obviously like a weird conversation in Silicon Valley because there's this kind of belief that defense is this weirdly Republican thing. And the reality is, for anyone that works in DC, is, you know, that this is just completely false. Defense is a bipartisan area, you know, as all the other bills are kind of drudging their way through Congress. The National Defense Authorization Act passes with a near supermajority every single year. I don't think we're affected at all by politics, whether it's, you know, a Harris administration or a potential second Trump administration. We're in a good place in either case. It's more about leaning into the things that the Pentagon needs and not really worrying about how politics affects that.
There is some state-level politics. Elon pulling SpaceX from Hawthorne in California. But Anduril's so core to SoCal story. I'm sorry to go back to it, Trey, but what do you make of that?
You know, for us, the location of our research and development facilities is largely predicated on access to talent. It's really important that we have the ability to recruit and retain the best software engineers, the best hardware engineers that are going to be able that will be critical to us building the products that we're working on. So do I think that it would be just as easy to do that in places that don't have a critical mass of engineering talent? Not necessarily. We have no plan to leave Southern California as our headquarters at any point in the future right now.
Trey Stevens, Executive Chairman and co-founder of Anduril and a partner at Founders Fund, of course. Thank you. Now, coming up on the show, Sanjay Poonen, CEO and President of Cohesity, joins us on the firm's latest cybersecurity report. Caro, what are you looking at?
Quick check on some shares. Trading Lenovo on the higher side, 0.7% on the American depository receipts. Why? Better than expected quarterly profit. It's all about servers. It's all about PC growth too. This is Bloomberg Technology.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Wow.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Almost half of companies need more than 6 days to recover data and restore usual business. That's one of the takeaways from Cohesity's latest report on cyber resilience. Sanjay Poonen, CEO and president of Cohesity, joins me now. And the reason DDoS or denial of service is definitely on the rise. Bad actors are more active. Other conclusions from your research?
Yeah, thank you, Ed, for having me. Yes, we did a survey of 3,000 IT and security people in U.S. and G7 countries. There were three things that stood out. One, which I expected, which is 2/3 of the people surveyed said they've been ransomware attacked and they expect it to increase. But two things stood out. One was 2% of them believe they could be resilient in a day, and approximately 50% said it would take them a week to resolve. That's not acceptable. And the second aspect of it was almost 90% of them said they believe their organization would pay the ransom, and 75% of them believe the ransom will be over $1 million. That's also not acceptable. So, there's a treasure trove of data in what we survey, and I'm a data junkie. I found those three results to be somewhat alarming.
And therefore, they do what, Sanjay? I imagine they use Cohesity. But at what point, how do you get someone to be able to tackle this within a matter of days rather than a matter of weeks?
Well, listen, I think the most important thing we've learned from the CrowdStrike, Microsoft fallout, whether the formerly known as Twitter X was DDoS and the Microsoft DDoS attack, is we as an industry have to focus on resilience. It's a little bit like the healthcare industry, Caroline. When we all faced COVID, it didn't matter whether you're going to get COVID or not. The question was how quickly could you recover from it? And you almost have to plan for the fact that it's not just if, but when you get attacked. And you're going to probably get ransomware attacked. How quickly can you recover? Resilience is the most operative word. It should not take us days to recover from that CrowdStrike Microsoft fallout. It should be hours.
That environment must be good for your business, though. How's Cohesity doing? If the activity and the defense is on the up.
Well, Ed, we just finished our fiscal year. Since you asked me, I'll break it out here on your program. We had a record year. We closed our year at $549 million in revenue, growing 26%, which is the fastest among all our peers for the fiscal 24. And we turned free cash flow positive, which is the first time any of our companies. So profitable growth. As you know, we announced our intent to acquire Veritas, which puts us, when we close that transaction, pending regulatory approvals, as the biggest in our space. So business is good. And we're really, really focused on serving our customers.
20 seconds. You're going to go public anytime soon?
We have to close this transaction. That's step number one. But the anticipation is once we close the transaction, digest it, with the next stage is hopefully a public offering at the right time.
Sanjay, great to have you on. Sanjay Poonen, CEO and president of Cohesity. Some fascinating data about his business and about the world of cybersecurity. But that does it for this edition of Bloomberg Technology, Ed.
Don't forget, check out the podcast. You know where to find it, on the terminal, Apple, Spotify, and iHeart. The team in New York, the team here in San Francisco, that does it. This is Bloomberg Technology.
It's a multi-trillion-dollar industry.
Shortly expecting the Freddie Mac mortgage rate statistics for the US.
Bloomberg ETF IQ, Monday on Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money. If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
US 30-year fixed-rate mortgages 6.49% August 15th week versus 6.47% in the prior week.
Aggressive rate cuts this year. How is that showing up in financial markets? It is risk on. Stocks are gaining. You've got big cap stocks, big tech stocks, and also small caps all advancing thanks to the bigger than expected gain in July retail sales. You can see the NASDAQ here leading the way up 2%, but small caps doing even better, higher by 2.5%. We also have the retail sales report lifting oil for the first time in 3 days. NYMEX crude gaining almost 2% to $78.44 a barrel. Now, as part of this risk on trade, treasuries are declining, which is pushing yields up. Shorter duration in particular leading the way. You're looking here at the 2-year yield, which is very sensitive to Fed policy. At one point, the 2-year rose as much as 15 basis points, almost 16 basis points. Now, from macro to micro, here are a couple of the big equity movers we're keeping an eye on. Cisco shares surging for their best day in more than 4 years. This after the company gave a bullish revenue forecast for this quarter and announced plans to cut thousands of jobs as part of a larger strategy shift. Meanwhile, you look at Walmart stock, it is perched at a record high, currently up 6.5%. That's not a daily move for Walmart. This after raising its full-year sales guidance, despite warnings from economists and investors alike that consumer strength is starting to slow. If you look at Walmart's e-commerce sales in the U.S., that grew 22% in the quarter. And sticking with retail, Nike also higher by 4%. Bill Ackman's Pershing Square disclosed a new stake in the sportswear company. A 13F filing showed that Pershing holds about 3 million shares in Nike, worth almost $230 million. Now, outside of retail company news, the government today said U.S. retail sales accelerated in July. Earlier today, we caught up with Tom Porcelli from PGIM Fixed Income. He still sees weakness in the consumer even with these positive headlines.
You are starting to see delinquency rates on the rise. Modestly, but they're rising. You are starting to see the unemployment rate rise. Again, it's still relatively low, but it's up 0.7% at this point. So I think you're starting to see some of the tight policy now start to show through.
Nonetheless, the headline retail sales number did come in stronger than expected, and markets are recalibrating their expectations for how the Fed proceeds with rate cuts this year. So putting this all together, we'd like to bring in now Crossmark Global Chief Market Strategist Victoria Fernandez with more. Hi, Victoria. It's good to see you. Let's just take a step back here for a moment. What does this week's data, and here we're referring to PPI, CPI, and retail sales this morning, mean for the growth scare narrative that was really starting to take hold after last Monday?
Yeah, I think, Scarlett, when you see the reaction that the market has had, you can tell that it's taking a little bit of a breather and saying, okay, maybe we're not headed for the recession or the hard landing that was anticipated a week ago, more of a soft landing. But I think a lot of it has to do with the repricing of what the Fed is going to do. You had a lot of people calling for emergency meetings to lower the Fed funds rates, asking for 50 basis points in September. I think we had priced into the market 4.5 cuts from now till the end of the year. Some of that has been repriced as CPI was a good number, but there were some elements that tell us there's still some sticky inflation. So maybe the Fed needs to, kind of walk before they run. Retail sales, again, strong. So the consumer is still there. Fed won't want to lower rates too quickly and stoke more demand to keep inflation high. So I think they're saying, all right, a 25 basis point cut in September is probably what the market is rallying around, assuming that is the first in a few steps. We'll see if the Fed delivers on that in a few weeks.
Yeah, absolutely. And I'm glad you mentioned how at one point the market was pricing in 4, maybe 5 rate cuts for this year. Right now it's about 92 basis points. So that's just under 4 cuts. I know that before the inflation data, Victoria, you were anticipating 2 rate cuts. So talk to us about how you see those rate cuts playing out, because the market seems to think that there might be a supersized rate cut still in there for 2024.
Yeah, the market does, and I'm a little surprised because there are some, kind of pushing and pulling in the markets right now with some of the data. You do have things that are saying, look, the economy is doing well. Atlanta Fed GDP at a 2.9% for the next quarter. Again, equity markets doing well on the rebound. They had a quick reversal. Retail sales good, but there are some warning signs as well. The JOLTS report is telling you maybe there is some weakness in that labor market when you start digging down there. Regional Fed surveys today were negative. Manufacturing, we know, is negative. Industrial production is poor. So I think the Fed is going to go very slowly. I do still anticipate 2 rate cuts. I think we'll get the first 25 basis point cut in September. The market will probably be okay with that because I anticipate next Friday at Jackson Hole, Powell will start to lay the groundwork for that. So it shouldn't be a surprise. And then I think we get the next one in December.
Okay, and I'm glad you bring up Powell because certainly that's the thing that everyone's kind of watching for. What do you think will be the catalysts in between that speech from Jay Powell at Jackson Hole? I mean, is it going to be Fed speak, which feels like it'll be less important given that Powell will be speaking soon? Is it going to be NVIDIA's earnings report next Wednesday?
Yeah, I mean, obviously, NVIDIA's earnings report is going to be key. It is the driver of the market in the first part of the year. They have had a huge pullback, so I would anticipate that if they report strong earnings, we'll see these tech names start rallying again. They have this week. I mean, I think NVIDIA's up, 10% this week already. So I would anticipate that, yes, that could be something to continue to drive some of those tech names, some of the risk-on elements of the market. But yet we've still got to look, Scarlett, at some of the things that are telling you to be guarded. You've got high beta versus low beta. You've got Bitcoin, both of their charts in a dark cross, right? 50-day moving below 200-day, which is very risk off and less liquidity in the market. So if you're looking at triggers, NVIDIA could be important. I think you do need to watch some of the liquidity elements in the market and what's happening there. Earnings is coming to a close, but we'd get another jobs report and more inflation before the next Fed meeting. Obviously, all of that will play into the decision.
Absolutely. What is your takeaway from earnings season thus far? I mean, you said it's pretty much over. We know big tech didn't really deliver the high-flying expectations that investors had placed on them. But what about the industrials complex? What about the companies that are exposed to the consumer so far?
Yeah, it's really interesting because if you look last week, consumer discretionary was your worst performing sector, which probably didn't surprise anyone. We were concerned about the consumer, concerned about the labor market and wages. But yet industrials was your best performing sector. You wouldn't expect that if you're expecting a slowdown in the economy, but they seem to be doing pretty well. Deere's report was pretty strong. Cat was okay. So I think there's some different elements in this market that are giving conflicting stories. stories. But saying that, with some of the tech names and the runs that they've had, I think you should go in and trim some of those names and get a little bit of defensiveness in your portfolio from now till the end of the year. Look at some of the staples, look at some healthcare names, even some of the financials. We've seen those names come back over the last couple of days. Could be an opportunity.
We're seeing today stocks rally and bonds fall. This is a dynamic that was clearly missing when the Fed began raising rates in 2022, and both asset classes tumbled. What is your confidence that we've returned to this traditional inverse relationship between stocks and bonds?
Yeah, I'm not sure that I would say with 100% confidence that we are here and it's going to stay this way. Because of all the things we've been talking about, because of some of the red flags in the economy, I think there can still be a lot of turning and a lot of volatility from now through the end of the year. And it's not just what the Fed's doing and what other central banks are doing. You've got geopolitical issues that are here. We've got a presidential election that could be quite controversial from now through the end of the year. So there's a lot of elements there that can cause some choppiness. So as long as we stay with good news is good news and bad news is bad news, we'll have this relationship. If it starts to revert back because there's concerns that the Fed is not going to cut rates quickly enough for market expectations, we'll start to see that relationship change again.
Yeah, good news is good news for now, but we've seen this get scrambled quite a bit over the past week. Crossmark Global Chief Market Strategist Victoria Fernandez, thank you so much. Coming up, a closer look at China as the country reports mixed economic data and Alibaba disappoints on earnings. This is Bloomberg.
The top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything. Billionaire Gautam Adani founded one of India's biggest and most controversial business groups. After being rocked by accusations from short seller Hindenburg Research last year, Adani is now preparing for the company's future in a real-life succession story. Meet the family members he's handpicked to take over the business as we deep dive into the facts and rumors surrounding the Adani Group. Inside Adani, a Bloomberg exclusive replays all weekend, only on Bloomberg.
This is Bloomberg Markets. I'm Scarlett Fu. Overnight, we got fresh data on China's economy. The new numbers showed that the country's economic malaise extended into the third quarter. Bloomberg Economics chief economist Tom Orlik joins us now from Washington. So, Tom, it was pretty much a data dump out of the country that spans the industrial economy to the consumer economy. What did we learn overall?
So, not an impressive set of numbers out of China, Scarlett. We had industrial output missing expectations, we had investment missing expectations, and we had retail sales slightly beating expectations, but still coming in at a pretty dismal pace. What does this all tell us? Well, it tells us that the drag from the property slow motion collapse remains considerable. Property sales down more than 20% year on year, and the steady drip of stimulus which the PBOC and the Ministry of Finance are injecting into the economy, well, that's staving off a kind of an outright collapse, but it's far from sufficient to restore robust growth momentum.
Yeah, far from sufficient is pretty telling there. So when it comes to government response, for anyone who is looking for any kind of big, showy fiscal stimulus, is that pretty much waiting for Godot?
So certainly there's no bazooka, Scarlett. The hope is that there's at least a lot of water pistols. So the People's Bank of China have cut interest rates by 20 basis points. We think they'll do another 10 basis points by the end of the year. There's some fiscal deficit spending still to come, enough to finance a bit more infrastructure spending. And the PBOC has said it's going to flex its balance sheet to finance loans from state-owned banks to buy up some of that enormous inventory of unsold property. So they've done a bit. There's a bit more they can still do. What's the impact of that going to be? Well, if they succeed, I think it's maintaining a tepid pace of growth into 2025.
Yeah.
That's the upside. If they don't do enough, then we'd be concerned about a renewed slide.
So, Tom, if you take a step back, it just strikes me as curious that, you know, the rest of the world emerged from the pandemic dealing with inflation, rising prices, but China came out of the pandemic, and I know it came out on a different timeline than everyone else, and there's talk of potential deflation. Why is there such a stark difference?
So it's a really great question, Scarlett. I think I'd point to a couple of factors. So the first is the pandemic kind of really put a kind of exclamation mark on some of China's biggest problems. Chief among them, oversupply. And when you've got an economy which is oversupplied, as we saw in Japan over past decades, that really weighs on prices. So that's the first factor.
Yeah.
The second factor is, why did the US come out of the pandemic pretty strong? Well, because they put a lot of stimulus into the economy.
Okay.
Huge fiscal stimulus, starting with Trump, extending through Biden. That also lit a fire under prices.
Yeah.
China, because it's got this problem of high debt, didn't do so much on stimulus, and that's why their challenge now is not soaring prices, it's slumping prices.
So the U.S. brought out the bazooka, in other words. Bloomberg Economics chief economist Tom Orlik, thank you so much. Now we're going to stay with the Chinese economy and hone in on one part of it, which is retail, e-commerce specifically, because Alibaba reported that its Chinese commerce business shrank for the first time in at least a year. Bloomberg's Peter Elstrom has the details. He joins us now from London. Peter, I mean, when I was looking at these Alibaba numbers, what really jumped out at me was 4% revenue increase. That is the slowest pace of more than 1 year. Does this tell us more about Alibaba's struggles specifically, or about the Chinese consumer struggles?
Well, it's a good question. Alibaba is something of a bellwether for the Chinese economy. Because of their big e-commerce company, they give us some insights into how the Chinese consumers are feeling at this point, how much they're spending. Yesterday, we got results from Tencent, which gave us a little bit of an insight. But today, we really got more with Alibaba. And as you say, the e-commerce business shrank about 1% this quarter. That was a pretty poor result. It was certainly disappointing for investors. Overall, the top line grew a bit more, the 4%, because of some strength in other businesses, including the cloud computing business, where they are getting some growth there. Also, their international operations are growing a bit more rapidly. But this sign of weakness in the Chinese consumer, and the Chinese consumer spending in particular, is a bit of a concern for the company and more broadly for the economy.
Yeah, absolutely. And you mentioned the cloud business. You can't talk about the cloud in the U.S. without pivoting to AI, or at least that's what the companies want to do constantly. To what extent can AI products save Alibaba's cloud business in terms of really becoming a driver for growth here in a way that maybe is not priced in yet?
Yeah, these are early days for AI investments globally. I mean, certainly for the Western companies, I'd say the Chinese companies are a couple steps behind them in terms of investments. So Alibaba is putting a lot of money into their AI capabilities at this point. They're trying to incorporate some of that into their various businesses around the company. The cloud computing business is growing a bit, but one of the concerns, overall operating margins did shrink. They went from 18% a year ago to 15% this year. That's partly because they are investing so much money in AI. And on the conference call, the earnings call afterwards with analysts, the CEO, Eddie Wu, was asked the question, are you going to continue to invest at this kind of pace in AI? And he said, we are. We're determined to kind of make progress in AI and invest. That also is a cause for concern unless they can find some sort of payoff at the other end of these big investments.
Yeah, exactly. We've seen that game play out here in the United States when it comes to the big tech companies and their capex on AI. You mentioned Eddie Wu. Obviously, he's the CEO, new CEO, and Alibaba is in this reorganization mode. What is his playbook, and does it differ significantly, meaningfully from his predecessor, Daniel Zhang's?
Yeah, Daniel Zhang was pretty focused on expanding in a number of areas adjacent to the core e-commerce business. He made a lot of acquisitions, a lot of investments that were adjacent in things like brick and mortar retail, in new kind of retail ventures. In particular, they expanded abroad also. Eddie Wu and Joe Tsai, who's now the chairman of the company, also are much more focused on the traditional businesses that really matter to them. E-commerce in China is the core. That's the heart of the business. They have to make that successful. That's why the shrinkage was kind of a concern. In addition to that, they see a lot of opportunity in cloud computing. If they're able to add some corporate customers on top of that, then they may be able to benefit. Beyond that, they're trying to sell off some of these assets. They've sold off some of their holdings. They're looking at some other spin-offs too. They've talked about how they want to focus on those core businesses, and therefore they'll be able to get some value out of that going forward. That's the plan anyways.
Okay, so clearly a company in transition. Peter, really appreciate your joining us. Peter Elstrom, usually based in Tokyo, but in London for the week. Thank you so much. Coming up on Bloomberg Markets, flexible work arrangements are getting normalized, including for Starbucks' incoming CEO. We've got more on that. This is Bloomberg.
If you look at private equity just as one piece of the institutional equity market, there are 3 times as many dollars invested than uninvested, right? So you have about $3.5 trillion in the ground that needs to get resolved versus about $1.5 trillion that's wanting to be invested. So if you're a private equity manager, you're trying to decide, do I take my capital and put it into my existing portfolio to either defend what I own or to try to grow it and create more value? Or do I use some, to your point, some creative financing to extend the duration or the runway of what I own and then try to put the capital into the new market environment? And everyone's taking a different approach. It's a function of where you are in your life cycle. Everyone is dealing with that. Even the highest performing PE firms, you're seeing slower fundraising. And in this deal environment, you have to start thinking creatively about how to get liquidity back to your investors.
This is Bloomberg Markets. I'm Scarlett Fu. Well, chalk up a win for the work-from-home crowd because just this week, Starbucks appointed a new CEO, Brian Niccol, poaching him from Chipotle. But when he takes over next month, he won't be in Seattle. Instead, he'll be working from Newport Beach, California, where Chipotle is currently based. Let's discuss all of this with Bloomberg opinion columnist Beth Coates. So, Beth, Starbucks is letting its incoming CEO essentially work from home. It's one thing if you're running a tech company, you've got a lot of software programmers working from home themselves, but this is Starbucks, so I was kind of shocked.
So interestingly, he's not relocating from California, but he will be working out of Seattle. So part of it is going to be commuting regularly. But the terms are kind of unclear. I don't know how often he's going to be in Seattle, even though that they're saying that will be his main office.
Yeah, exactly. And apparently he will be commuting to Seattle and travel as needed. That as needed leaves a lot to the imagination. As you said, we don't have the details yet. That's an awful lot of flexibilities that we know most companies aren't offering to their rank and file employees.
Absolutely. And I think it shows how much Starbucks really wanted to get Nickel to join the company. I think it was one of a couple of concessions they made. And interestingly, when he joined Chipotle, Chipotle was willing to relocate the entire company headquarters for him to California from Denver. So I think it's just one of those aspects. If you're that desirable, you can kind of make whatever arrangement you want.
Okay, so this is a Brian Nickel thing more than anything else, more than a Chipotle or Starbucks thing. Like, he can call the shots here in terms of where he wants to work, and the companies will move to him. Got it. Okay, and yeah, as you point out, it speaks to how desperately or urgently Starbucks wanted Nickel. Meantime, you look at another big household name company, and the remote work debate got extra heated when Eric Schmidt, who formerly ran Alphabet, I think it was called Google back then, said that his former company is losing the AI race because of its remote work policy. Can you just highlight for us exactly what he said? And by the way, who he was saying this to?
Sure. So this was at a conversation he was having at Stanford. It was a talk or a lecture. I don't think he really meant for it to go public like that. Since his comments have come out, the video has been taken down, and he actually has walked them back. But he was basically saying that the company is struggling to compete in AI because it has these flexible work arrangements. And his argument is, how can you sort of behave and compete like a startup if people aren't willing to work that hard? So he's sort of equating here, willingness to work hard with remote, which I think is sort of really is pretty reductionist, and I think made a lot of people angry.
Yeah, absolutely. It made the Alphabet Workers Union, which represents about 1,000 employees in the U.S. and Canada, really upset because they put out a statement on X saying flexible work arrangements don't slow down our work. Understaffing, shifting priorities, constant layoffs, stagnant wages, and lack of follow-through from management on projects. These factors slow Google workers down every day. So they had a laundry list of issues that they say may be the bigger problem. I mean, Alphabet's no longer a startup, so how can you put startup-type expectations on employees if that's the case?
I think that's such an important point. And I think it's also worth noting that a couple of the most successful AI startups do have hybrid work arrangements. So I think, again, using remote, flexible, hybrid as an excuse for maybe deeper cultural problems that the company might be having. And to your point, it is not a startup anymore, and expecting it to behave that way, I think, sort of sets it up for failure. It's just not possible.
Yeah, and as you mentioned, a lot of tech companies do have hybrid work policies. I believe Alphabet itself has a policy of working in the office 3 days a week. So it's not as if people are never in the office. They're following the rules.
Right, exactly. So I do think that there does seem to be a bit of a generational divide here. And I think that a certain segment of the population wants a return to the way things were, seems to think that any issue that arises is an easy fallback. And I do think that it's going to be interesting to see what happens at Starbucks, right? Like if the company struggles and Nickel can't turn things around, people might turn to this and blame his work arrangement here.
Yeah. Well, it didn't happen at Chipotle, so he has the experience to fall back on where it's not going to happen to him at Starbucks. Beth, always a pleasure speaking with you. Beth Coed, Bloomberg opinion columnist who writes about work issues, culture issues at companies. You can find her work on Be Opinion Go on Bloomberg. Coming up, Dana Tulsi joins the show following that unexpected jump in U.S. retail sales. We'll get her read on the economy and on companies next. This is Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Welcome to Bloomberg Markets. I'm Scarlett Fu. So it's midday here in the U.S., and we had a retail sales report that was much better than expected, and good news was interpreted as good news for the markets. You have equities at session highs right now, with the S&P 500 gaining 1.5%. Big tech doing even better, with the NASDAQ 100 gaining 2.3%. And we see bonds tumbling, so that is pushing yields up. The 2-year in particular, much more sensitive to what the Fed does next, which everyone is pretty much at this point pricing in a 25 basis point rate cut. The 2-year 4.09%, just a hair under 4.10%, and the 10-year yield at 3.92% at the moment. But let's go back to equities, because there are a couple of notable movers there, and Abigail Doolittle has them for us. Abigail.
Well, clearly this mover, Scarlett, is not one that's boosting the indexes to these highs, up more than 1.5%, as you were mentioning. SIGA Technologies down 27%, actually off of the lows. Right now, this is the worst day since 2015 for the antiviral maker, at the lows, down more than 40%. At that point, the worst day ever since the company traded publicly, going back to 1997. This as their MPOX study failed to meet the goal. The company's pushing back, saying there were some unusual circumstances around it, such as folks who were enrolled in it already being 1 week into their case of MPOX and that they were within a hospital. But investors clearly not liking this. A piece of it could also be into this. The stock had been up 129% on the year. Clearly expectations for this binary event to go the other way, and then it went this way. Now, this could be bad news for SIGA Technologies, but let's take a look at another antiviral maker, the shares of GeoVax, up 5.2% on the open on the news, that negative news for SIGA. This stock had been up 30% at this point. They are also working on an MPOX vaccine. Taking a look, though, at some of the stocks that are working and helping out those indexes that you looked at, take a look at the shares of Walmart, up 6.6% at the highs. The stock had been up closer to 9 or 10%, something along those lines. At that point, the best day going all the way back to 2020. That was the degree of the buying power. This, of course, after they put up a really a good quarter. They also raised the full year view to as much of 4.75% growth versus the prior view of 4%. And it's a case, really, Scarlett, of consumers hunting for bargains, even high-end consumers, people really focusing on necessities and groceries. E-commerce, a big point of their story, up 22%. And then, of course, we have some of these other Target and BJ's reporting next week. Home Depot hanging on to the gains from its report earlier this week. So overall, retail doing really pretty well.
All right, good stuff. Abigail, thank you so much. You mentioned retail, you mentioned Walmart. Here's how executives are responding to potential weakness that we're seeing in the consumer.
Pricing has been going up. We're guiding in Q3 and Q4 for prices to go up.
As we're taking in new bookings, which we get to see each and every day,
the willingness for our guests to pay more for those experiences.
Pricing will absolutely go up in both quarters, and it looks that way for 2025 certainly as well.
They're willing to pay it. And they're also willing to book much further ahead.
The U.S. economy is a little bit stronger than people are giving it credit for, and the consumer will come back as the economy continues to strengthen.
As Abigail was just telling us, Walmart shares at an all-time high today. The company boosted its full-year sales and profit outlook. Pretty much a bullish call, as peers have been warning of a weakened consumer. So for a deeper dive into Walmart, I want to bring in Bloomberg Intelligence senior analyst Jennifer Bartashis. Jen, what was the most encouraging part of Walmart's results? How much can we really read into this being a Walmart story versus a broader consumer story?
So I think some of the most encouraging things that we took away from the call this morning is that it's the second quarter in a row where they've talked about higher income consumers coming into Walmart, but more importantly, that they feel that they now have the framework to keep those customers even after the economy starts to get a little bit better. So historically, when people are challenged, they flood into Walmart, but then as things get better, they leave. So if they're able to hold on to this new cohort of consumers that they're getting, that's really good news for the long-term growth of the company.
Yeah, they want to reduce that churn. It's like a cable provider not wanting to give the customers they sign up because there's a new show available. What about the advertising business? Because we know that Walmart bought Vizio and it's trying to leverage its big customer base into something that can, really kind of smooth out its earnings, its revenue and its earnings over time.
Yeah, the advertising business is doing very well. Walmart Connect, which is that business in the United States, continues to grow in the low 20%, and it's really a sign that they're able to engage with their partners to bring advertising revenue into the company. From a profit perspective, this is great because they're looking at multiple businesses that have much higher margin, and that changes the business mix of the entire company and makes it overall a more profitable company.
Do we know what kind of breakdown they want between the advertising business and the retail side, which obviously features much thinner margins?
Well, as a rule of thumb, the advertising business can carry a margin of up to 80%. When you're talking about the retail business, you're in the teens, and on an operating margin perspective, you're in the low to mid-single digits. So it is a very important component of their long-term strategy. Other businesses like fulfillment services, which is increasingly important with their e-commerce operations, are also higher margin. And so when you start to bring multiple businesses with higher margin profiles in, it really does change that entire framework.
Yeah, that's a really important point. But I guess we go back to the main point, which is that as the world's biggest retailer, Walmart has access and has a window into the consumer that no other company does. The key comment I saw in the earnings release was that we are not seeing any incremental fraying of our consumers' financial health. You mentioned a little bit earlier that they are attracting more customers in times when things are a little bit tougher. It's harder for the consumer. But who exactly is the consumer right now? How much trading down is taking place, or is that something that we're going to see in the coming months?
Well, I think if you looked historically, Walmart's core customer was always the lower income to lower income consumer. They're bringing in slightly higher household incomes, and that may actually be a bigger threat to companies like Target, which tended to have a higher income core consumer. What's interesting about Walmart is that it's not just about price, it's also about things like convenience. The uptake of their online order and having it delivered or having it pick up at the curb, that growth is really showing that regardless of your income level, consumers are looking for more than just price. And that is part of what makes it a longer term story, so that when the economy gets better, people don't need that really cheap price, but there are other things that still keep them engaged with that ecosystem.
Very well said. Bloomberg Intelligence senior analyst Jennifer Bartashis, thank you so much. We're going to stay with retail here because big picture, July sales rose well above estimates by about 1%, highlighting consumer resilience, even in the face of, still elevated prices and borrowing costs. So joining us now for more on the retail sector overall is Dana Telsey. She is founder and CEO of Telsey Advisory Group. Dana, thank you so much. I know that we're just talking about Walmart, and you don't cover Walmart specifically, but I'm curious to get your take because the CEO of Walmart, Doug McMillon, says that we aren't experiencing a weaker consumer overall. They want value. They want a broad assortment of items and services. Is Walmart an outlier here, or given what other retailers have told us, have shared with us?
You mentioned at the beginning, Walmart's the biggest retailer out there, and I think they're gaining share. I think the share gains that they have, given the extensive reach they have into many different income cohorts right now, plus the fact that look what he said about ticket and traffic both showed gains. So I think they're gaining share from others. The value pricing that they have, the convenience, whether it's in-store or online, coupled with the broad category assortment, and look what he said about back to school. Back to school is strong for them. I don't think the words that, and frankly, the picture that we're seeing from Walmart, we're going to hear from other retailers. It feels like they're stronger than others because of their offering, their price, value, and convenience relationship.
Yeah, but then we were just hearing from Jen Bartashis that it's not just about price. It's convenience, as you mentioned. It's about the value proposition they offer overall. Is this something that other retailers can kind of present themselves as offering, or are certain brands just seen as in a better position to benefit when consumers are fatigued of high prices and are looking to seek out better pricing, better value?
I think overall, you're seeing that shift to value. You're seeing it with the off-pricers who will begin to report their earnings next week. And then the other types of shopping, I think there's intentional shopping being done by consumers that are focused on particular brands that have innovation and offer something new and different that consumers are willing to open their pocketbook for. So it's value and it's differentiation with innovation that leads to that intentional shopping.
One thing that the CFO of Walmart did mention as sources of uncertainty are the upcoming elections and the unrest in the Middle East. I'm curious to get your take. How does this affect consumer behavior? And is there any way for these retailers, these merchants, to kind of get ahead of that?
I think one of the things we're seeing retailers do in response to what is an uncertain, whether it's political or geopolitical environment that's out there, look how they're managing their inventories. You're not hearing of inventory increases. You're hearing definitely of inventory moderation. So leaner inventories allow you to manage your margin. And you've seen almost more confidence in the margins than you have in some of the sales, given the volatility. Going into election seasons, we did a piece looking back at the past 13 elections. What typically does best for consumer stocks is incumbents and Democrats. We'll have to see what that brings this year as we go through the election cycle.
So what are the skills then needed for a retail CEO in this kind of environment with a consumer, again, fatigued with high prices, seeking value, seeking differentiation, seeking convenience, but also someone who's capable of managing inventory in a fast-changing world?
When you think of what drives success in retail and for brands, there's always three markers, and the drivers of them change. So the markers of concept, execution, and management are what deliver a successful brand and retailer. To have a successful concept is about innovation. To drive execution, it's about seamless and speed. And for management to have a vision for growth, it's data. So companies that have innovative product that utilize seamless and speed enhancements and that utilize data to inform are what's going to lead to growth. And I think that's what you've seen out of Walmart's results today.
All right, well said. Dana Telsey is founder and CEO of Telsey Advisory Group. She's going to stay with us as we also take a look at shares of Ulta Beauty, trading at the highest in almost 4 years. This is after 13F filings show Warren Buffett's Berkshire Hathaway has added a stake in the company. It's our stock of the hour. This is Bloomberg.
biggest risk in property and casualty, is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? It's just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg Markets. I'm Scarlett Fu. It's time now for our stock of the hour, and we are watching shares of Ulta, which at one point today was on pace for its biggest rally since 2020. And why? Berkshire Hathaway disclosing a new stake in Ulta that's valued at roughly $266 million. When Warren Buffett gives his stamp of approval, the stock soars. Dana Telsey, founder and CEO of Telsey Advisory Group, is still with us, and she has an outperform rating on the shares. So Dana, Warren Buffett likes Ulta. What about the stock screams discount and value in the Buffett sense?
I think in the Buffett sense, take a look at where the valuation of the stock is. This stock had been at nearly $600. Today it's trading, around $368, $369. So it's come down dramatically. I think the category is still a solid category. When you think about Ulta, it offers goods in the mass to prestige categories and price points. They just relaunched their own private label Ulta Beauty line, which accounts for 3 to 4% of sales. And Investor Day is coming up on October 16th, where they'll give out their long-term algorithm. Their footprint and their physical locations are convenient to consumers. And now with an even smaller box size of 5,000 square feet, we'll have to see what the expanded potential could reach. And the digital channel is also an opportunity for them. It captures the grandmother, the mom, and the daughter, and with services included like hair salons, it brings people back. And let's not forget the Target partnership, which currently has room to expand into additional stores. It's in just over 500 stores currently.
Okay, that's a long laundry list of things to like about the company. We know that Warren Buffett doesn't time his stock purchases necessarily because he seeks out value, but thinking about the broader economy and how we're headed for a period of uncertainty and perhaps even a downturn, do you buy this idea of the lipstick recession indicator that when times get tough, people buy small luxuries like cosmetics?
Yes, I do. I think overall, what's happening with the cosmetics category remains strong. During the pandemic, it was a crazy Zoom cosmetics category because the growth rate for the industry was up double digits. It's normalizing now back to around mid-single digits. But you look at that in comparison to other categories, and that's still strong growth. However, one thing to note, there's expanded distribution points. Whether you have companies like Sephora and Kohl's, obviously you have Ulta and Target, there's been more distribution points for beauty. Even the off-pricers having more beauty assortment in their stores. So that's the competitive force. With Ulta's loyalty program, they need to keep enhancing and refining to be the destination of choice.
I want to talk about another company that's also gaining, outperforming the market. Tapestry is up by 3 1/3%. You have the lower end, which you could argue is cosmetics because low price point, and then you have the higher end. So it really gives weight to this idea that we're in this K-shaped economy where high-end stuff does well and low-end stuff does well too. When we look at Tapestry, the earnings came in better than analysts had anticipated, despite warnings from other luxury purveyors that perhaps things were slowing down. What is Tapestry doing right?
A couple things. Remember what we said before, product innovation. Innovation in the Coach brand is working. Their price points are not at the upper end of the core luxury. Even some of their newer product innovations like the Tabby handbag was placed into some of their outlet stores at full price and exceeded plan. Their gross margin was up 600 basis points over 2019 levels. But what everyone wants to know about Tapestry is what's going to happen with the potential Tapestry-Capri combination. On one end, Tapestry just said today that they continue to remain fully embrace that acquisition, and they see the opportunity for it to be accretive to Tapestry's baseline with the high teens operating margin even at depressed sales of the Michael Kors business and more than $200 million of synergies, while if it does not go through, you have an excess cash flow generator at Tapestry of around $800 million. The potential for a share buyback definitely exists. So the strength of the Coach brand along with the potential buyback, well, keep in mind, Kate Spade and Stuart Weitzman not performing at the same levels of Coach, and there's work to do.
Right. And I know that Coach was able to raise prices and still hold on to its customers and boost sales. You mentioned Capri, 7th straight decline in annual sales, and that was what the company had told us. Even if Tapestry wants to move forward with it, is it in a position to get a lower price now, renegotiate the price point?
It's been asked millions of times. They haven't made any comments on it. It'll be interesting to see if the deal can get approved from the FTC, and then we'll hear more. Right now, they have the financing in place at that price point, so let's see what changes.
All right, Dana Telsey, always a pleasure speaking with you, and thank you so much for an extended conversation with us. Dana Telsey is founder and CEO of Telsey Advisory Group. Coming up, we're going to move on to the world of higher education because a third Ivy League college president has resigned as a result of the campus protest war over the war in Gaza. This is Bloomberg.
AI, how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea, but ultimately you still have to do a lot with it. They just give you very superficial ideas, and but at the end you still have to customize and how to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment.
Yeah. Are you concerned one day we won't be able to differentiate designs by AI and designs by an actual designer?
I don't know. For me, I see that, when the designer is doing, it's the spirit, it's the heart that the computer don't have.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg Markets. I'm Scarlett Fu. Columbia University President Manu Shafiq is now the third Ivy League leader to resign as universities across the U.S. grapple with protests over the war in Gaza. Bloomberg's Katya Porzakansky reported on this, and she joins us now. So it's been a quiet summer. There hasn't really been any protests. I mean, even the protesters need to go do their internships. So why now? Why is she stepping down now?
That's a good question, and I think a lot of us are wondering that. There doesn't seem to have been a sudden reason for it, and it does seem to be a surprise. Her resignation was a surprise to faculty, students, and the board. But we know that school's about to start in 3 weeks. We know that Columbia hasn't really figured out a plan yet. There's talk about giving their public safety officers a little bit more powers to arrest students. Right now, they can't even touch students. We know that they've clamped down on the campus, on access to campus already a couple weeks ago. We know there's already been threats from the protesters to bring it back even harder this time. One protester said that an encampment is now the baseline for them. So we know things are going to be heating up really soon, and Columbia doesn't really have a path forward to buckling down in terms of protecting student safety or also catering to the free speech wishes of some of the protesters.
So yeah, I mean, the October 7th anniversary is coming up in the fall, so that will definitely be something that people are on the lookout for. I mentioned she's the third Ivy League president to do so. You had Penn's Elizabeth McGill and Claudine Gay of Harvard. Coincidence or conspiracy that these are all women?
Well, I mean, I don't know.
I'm not feeding conspiracy theories.
There are also people who testified in front of Congress and said things that were not well received. With Manu Shafiq, she is dealing with. She had a much better time in front of Congress, but still dealing with a lot of accusations that it has gotten out of control on campus in terms of anti-Semitism. The Anti-Semitism Task Force did an analysis, and they found hundreds of cases of people who have had felt discrimination, and also professors that have told their students that they would get extra credit if they participated in these encampments and protests, which if you are a Jew student or an Israeli student, probably not a great feeling.
So you mentioned the congressional hearings and how all three of them spoke before Congress. Elise Stefanik, the congresswoman who kind of led the charge on this, has been very vocal about wanting to bring down a lot of these university presidents. And I think she even tweeted after Manu Shafiq stepped down, she's saying that there's still more to come. This is part of now a bigger culture war, but what specifically is she looking for from these schools?
I think it's hard to say, what exactly she's looking for that isn't politically motivated. I mean, I think there's also political motivations to a certain degree, but I think in general, strong stances against not only protesters, but general discontent on campuses that is making a lot of Jewish students feel unwelcome. And you're also talking about civil rights violations in some cases, students that are unable to participate in campus activities. You have a judge that now just said to UCLA they need to protect the Jewish students who are blocked from accessing campus at all. You're talking about federal funds. And Congress is in charge of making sure
that's a good point
that these schools are abiding by their civil rights obligations.
Yeah, otherwise they'll close the spigot basically in terms of federal funding. Katya, always a pleasure. Katya Porzakansky here with us on the resignation of Columbia University's President Manu Shafiq. That does it for me. I'm Scarlett Fu, and for Bloomberg Markets this hour, we're keeping an eye on the gains in equities on the better than expected retail sales report. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
Morning from our world headquarters in New York. I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
It's the passing of the baton. Welcome to the fastest show in politics as the president appears on stage today with Kamala Harris for the first time since Biden dropped out of the presidential race. I'm Joe Matthew alongside Kaylee Lines in Washington. Welcome to the Thursday edition of Balance of Power on Bloomberg TV and radio. Kaylee, they're going to take the
At
stage
1:10 p.m. Eastern Time, we expect comments from Fed's Harker, who gives a speech on the Federal Reserve Bank of Philadelphia's Center for the Restoration of Economic Data. Text is expected, but no Q&A.
Has to say about this, but yes, we all knew that both Harris and Trump would be sharing the stage on September 10th. And we learned today, October 1st, is when we'd see J.D. Vance and Tim Walz share a stage. And according to the Harris campaign, there will be another presidential debate, so 2 in total, in the month of October. No news yet on what exactly that date would be, who would be hosting it, and whether or not Donald Trump is also signing up.
Right.
For that.
Although the Trump campaign is at an anytime, anywhere posture lately, so let's see if we find out maybe even this hour what the response will be. There's no word on a host, no word on rules, so we have a few things to figure out. But there was a time we didn't know if we'd see any of these candidates on stage together, and it looks like we'll be having a couple of special evenings coming up.
Yep, at least 2 are confirmed. And in the meantime, we still have much to look forward to as we look ahead to the convention in Chicago next week. We will be hearing from Kamala Harris beforehand, not just today alongside President Biden, which surely is a big moment, the incumbent and the could-be successor standing next to each other. But of course, tomorrow she's going to be delivering her own address in North Carolina on economic policy.
Yeah, we've actually had some news on that. Bloomberg matching earlier reports, she will put forth a federal ban on price gouging. And we'll talk about all of this coming up with Laura Davison covering Bloomberg politics for us here in Washington.
Indeed, we will. But as always, we got to start with a check on the markets because it is an up day for stocks. After today's strong retail sales data, let's get the latest with Amy Morris here in Washington.
It sure is, Kaylee. Another inflation report did very little to change bets that feds are set to cut interest rates next month. Retail sales data underscored the strength of the economy, allaying fears that the Fed's high rates would be risking a pronounced slowdown. Retail sales advanced 1% in July. That's the most since early 2023. Car sales bounced back after a cyber attack. Electronics and appliances posted solid gains. E-commerce rose at a more modest clip. Bloomberg Economics says consumers are spending at a slower pace than years past, but they are spending at Walmart. The world's biggest retailer had another quarter of strong sales that topped almost all expectations, with its comparatively low prices proving a powerful draw for millions who have been struggling with rising costs for housing and groceries and pretty much everything else. Walmart raised its profit outlook for the full year as it expects to reel in even more deal hunters. Shares right now for Walmart are 6.6% higher. And we check markets for you all day long here at Bloomberg. The S&P 500 500 up 1.3%. NASDAQ up more than 2% now, and the Dow up 1.1%. The 10-year Treasury yield at 3.93% and the 2-year yield at 4.1%. And the number of Americans applying for unemployment benefits fell last week. That's another sign the job market remains resilient in the face of those high interest rates. Jobless claims fell for a second week to the lowest level since early July. Initial claims decreased by 7,000 to 227,000 in the week ending August 10th. That's a Bloomberg Business Flash. Now back to Balance of Power with Joe Matthew and Kaylee Lyons.
All right, Amy Morris checking in on a busy day in the markets. Thank you so much. It's a busy day in politics as well, and that's why you're here listening and watching Balance of Power. I'm Kaylee Lyons alongside Joe Matthew. It's going to be an incredibly packed afternoon for presidential candidates and for current incumbent presidents. As this hour, we are awaiting remarks jointly from President Biden and Kamala Harris about their administration's effort to lower costs for the American people. And then later on this afternoon, we will be hearing from the Republican nominee. Donald Trump will be holding yet another news conference for the second week in a row. This one not from Mar-a-Lago, but from Bedminster, New Jersey. And then, of course, the weekend's Friday with an economic address from Kamala Harris in North Carolina.
Yeah, we've got a lot to do before we even get to Chicago. That last news conference from Donald Trump did involve questions from reporters, which is the point of a news conference. It also went on for a very long time and seemed to lose direction, kind of like his economic address did yesterday as we got into Hannibal Lecter and all of the other things. We do know, however, that Joe Biden and Kamala Harris will be talking about their efforts to lower prices together. A lot of questions, Kaylee, about whether she can find some sunlight between herself and the president tomorrow. And that's a real balancing act, knowing that this has been a major political problem for him.
Especially when she will be with him in Maryland today, having to seem still supportive of the man who technically is her boss. She serves at the pleasure of this president, but she will also perhaps try to differentiate herself from him one day later.
That's the idea. Covering the pivot for us, helping our coverage, of course, is Laura Davison, Bloomberg Politics editor, with us here at the table today in Washington. Laura, this is quite a high wire act, we could say, for Kamala Harris. She appears with Joe Biden today.
At 1:10 p.m. Eastern Time, we expect comments from Fed's Harker, who gives a speech on the Federal Reserve Bank of Philadelphia's Center for the Restoration of Economic Data. Text is expected, but no Q&A.
Is, take all the good stuff from Biden, from his legacy of, the prescription drugs, which is what they're going to be talking about today. That's been a very popular piece of his legislation, the work he's done on infrastructure investments and chips, tie herself to those things, but be able to separate herself from his record on inflation and some of the other things that have been a lot less popular. And, just looking at the polling, voters give Biden very low marks for economic issues. And even compared to Trump, Harris is not polling as well on the economy.
Well, and when we heard Trump giving what was dubbed to be an economic address in Asheville, North Carolina yesterday, he did go after the Biden-Harris administration on inflation, talking about how high prices for various goods have gone during the 3.5 years of it. What he didn't do, other than kind of saying, drill, baby, drill, and we're going to deregulate, was give an explicit policy proposal to get prices down. Are we actually going to get that from Harris tomorrow?
It's possible we'll get a little bit of detail, but I'm sure nowhere near the level of detail that Bloomberg readers and listeners would want on this. I've already been getting lots of questions from folks, and I'm setting expectations that this is going to be, campaigning in prose or campaigning in poetry rather than the detailed policy list that people want. It is noteworthy, however, that she started to dot out some of these policy proposals we saw last night. A proposal on food and grocery price gouging. She's already talked about no taxes on tips. Another proposal that sounds familiar for those who have been listening to Trump speeches. So we're starting to see little details, but it behooves her to be specific on narrow issues that are popular versus giving a big 300-page economic policy report where there's lots of stuff that people could find to criticize.
Well, she'll have her chance, I guess, in some upcoming debates. One of the things I think you were working on before you joined us was this breaking news in the last hour, at least according to the Harris campaign. There will be 2 presidential debates, not just September 10th, but one in October. And we now know there will be a vice presidential debate on October 1st. How important will these be in determining the outcome
of this election.
Well, if we've learned anything from 2024, it is that debates can definitely direct the race. Yes. So, this is really important because one of these, the September 10th debate, that first one will be before most voters start voting. But that October one, depending when that is, that's going to be right in the thick of when people are early voting. And this could potentially, depending how this goes, sway voters. Different issues could come up. They could be challenged on, if there is, say, a flare-up on foreign policy or something. This is a chance for voters to get a sense on some of the issues that candidates may want to shy away from on the campaign trail.
Well, and it will be certainly a guarantee that Kamala Harris will be answering questions, at least from the moderators, which we haven't really seen her do much of. This is a point that the Trump campaign has been making frequently, and perhaps that's also why we're going to see Donald Trump theoretically asking some questions at another press conference, the second in as many weeks. Laura, is he just going to keep this up until Harris starts doing her own, or do we know what the strategy is here?
Well, part of the strategy is, that Trump, this is a line he wants to use in the attack, is that Harris is not speaking directly to the media, that she's, that she's sort of avoiding them and just going on these scripted appearances. But also this is self-serving in a way that this helps him pull the spotlight back on himself without having to do, some of the harder, more in the weeds work of campaigning. He has been very frustrated by the media attention that Harris has gotten over recent weeks. So if you can, call a press conference at your golf club, why not have press come and spend an hour talking with them and at least get some of your talking points out there. It's unclear how much these are actually helping him. He is arguably going off script on some of these things. His comments at the NABJ were not helpful for his campaign.
All right, so we'll see how this goes this afternoon. Laura Davison, Bloomberg politics editor. Thank you.
1 minute remaining until we get the text release for Fed's Harker.
Bedminster, New Jersey, in that press conference, of course. First, we will see Joe Biden and Harris together, as we've mentioned, in Maryland. And what's interesting is this is kind of part campaign for Harris, but also part define the legacy for Joe Biden.
Yes,
he tries to protect how he will be viewed in history as the 46th president of the United States. And we know that's something else he wants to have his legacy marked by, Joe. And he said as much in his Oval Office address after he left the race, is peace in the Middle East and a ceasefire deal between Israel and Gaza. Those efforts are underway today.
Well, that's true. This is time to get to the table here. We've been looking forward to this for some time, Kaylee and Qatar. And it's happening at once as Israel waits for this potential retaliatory strike by Iran. There's some news as well
10 seconds.
On the war against Hamas here, as American officials reportedly tell Israel now that they can make no further progress in the battle against Hamas without further jeopardizing civilian life. We still have hostages.
Fed's Harker doesn't comment on monetary policy in the prepared remarks.
Are pursuing at this very delicate moment, Kaylee. We don't even know if Hamas is at the table here, correct?
Yeah, they aren't at the table in Doha. It's other negotiators, those mediators will be bringing the message back to Yahya Sinwar and the other leadership. So it's on this note. We turn now to Hagar Shamali. She, of course, is formerly of the National Security Council. Now she's founder and CEO of Greenwich Media Strategies. Welcome back to Balance of Power on Bloomberg TV and radio. Hagar, if we could first just begin with the talks that are happening in Doha, given Hamas is not there at the table and they're still rehashing, trying to reach a deal based on an outline that was announced by President Biden back in May. That was months ago, and the parties didn't agree to it then. Do you really believe that they'll be agreeing to it now?
Well, there's a lot of hope. I mean, the White House has expressed a lot of hope. They feel that they're coming close to an end. Now, I know I've said that a few times over the last few months, but it is normal in these types of negotiations for them to be very touch and go. The thing that you've had now is, just to explain, is that they've agreed on this outline, this general outline that President Biden put forward at the end of May, as you noted, and that outline they remain in agreement on. But the way it works from there is that they have to agree on every single little detail, and those details are what are not only are they getting hung up on those details, but as time wears on, each side comes with new demands. So time is not really on their side on this one, except this time there is a lingering aspect in the background, and that's this potential assault attack that we're all waiting for coming from Iran and Hezbollah. And a deal on this ceasefire could actually thwart that attack and put it entirely to the side, which would be, really, huge and really kind of win-win all around. But that said, the details of such, and I can go into a few of them. For example, they're arguing on the phases of hostages who should be released, and first would be women and remaining children, and then men and soldiers, and so they're arguing over those phases. That Israel doesn't like the phases that Hamas is putting forward on that. Israel wants to have a military presence along the border between Gaza and Egypt, and Hamas is now against that. So there are things like that. Israel wants to set up checkpoints inside Gaza to check on people to weed out militants. Hamas doesn't like that. So there are these details, that things of this kind that aren't in that broader outline that they're trying to figure out now. And by the way, that's the similar process, whether it's a ceasefire or a peace negotiation. And so it's very common, but unfortunately, you're talking about two sides who have deep distrust on both ends. And Israel's goal at the end of the day is not the same as the United States' goal. Their goal ultimately is to defeat Hamas completely. And I think that they feel that that's not there yet. And Hamas knows that. So they're afraid that even after a ceasefire, Israel would resume some kind of violence. And so that's also in the background here.
Hagar, there's a belief that the release of the hostages, still more than 100 living and dead hostages held in Gaza, cannot be secured militarily. Do you believe that?
Oh, I do believe that. I mean, after October 7, when so many hostages were taken in, knowing how brutal Hamas is and the conditions in Gaza, and I knew that the response from Israel was going to be severe and that the conditions would then worsen in Gaza. I always thought that their lives were really pretty much, the lives of the hostages were hanging by a thread. But I think that's especially more evident now. And proof of that is the fact that now you have Gaza's entire population, almost the entire population of 2.2 million people have been displaced and have had to continue to move many times. And so you have hostages in the mix of that. You obviously have water and food issues and medicine issues. And I believe the Israeli government came out saying that it's believed that only half or a third of those hostages, it's about 115 left, are still alive. And so that's why you have increasing pressure inside Israel. You have had protests today, knowing that these talks are taking place in Doha. The families of the hostages are protesting, saying that they don't want the negotiators to return without a deal. And of course, they've said that before, but they really mean it this time because they know that time is of the essence for these hostages. But the U.S., what they're trying to convey is, hey, Israel, you have defeated Hamas significantly to the point where we don't believe they could actually pose a significant threat to you or govern Gaza. And therefore, it's time to get the hostages back. And if you want to focus on continuing to undermine Hamas, it has to be with these very specific targeted operations that kill leaders, as you saw in Iran and in Lebanon. And that is, by the way, where I think the war is headed anyway. So that's what the U.S. is trying to convey is, listen, you're not going to find any more opportunities to bomb your way
Shortly
out of
expecting the
this.
results of the
And
Fed
you're only
reverse
gonna find
repo
yourself
operation.
endangering way too many civilians. It's time to move on, to release the hostages and move to the next phase of this.
Well, as you allude to, the assassinations, the strikes against these leaders in Beirut and Tehran, we are still waiting the response from Hezbollah or Iran or both on that front. Hagar, what is your expectation? The longer we wait, does it indicate the strike against Israel, the retaliation is only going to be more severe, or does it suggest one might not be coming at all?
The longer we wait, the more it implies that they are waiting to see what happens with the ceasefire talks, because Iran has something to gain out of these ceasefire talks as well. We have to remember that you have now a huge presence, a U.S. military presence in the region, and that's been doubled down by the U.S. Defense Department, right? Another submarine was sent in. Another
63 counterparties take $307.141 billion at the Fed reverse repo operation.
They want to respond, but they don't want to enter a war into any kind of engagement with the United States. And they've made that very clear. They want, it seems, a repeat of April, where you had 300 drones and missiles launched by Iran. All of them were successfully intercepted except one or two, and Israel responded, but then every side retreated. And that's kind of my expectation for the next assault. But now that we've gone this far, they've waited this long, and we have these ceasefire talks, my expectation is they're definitely holding on until they see how those ceasefire talks happen. And we'll know more at the end of the weekend, because it's really today and Friday that are the peak of these talks, apparently, according to the White House at least. And then if those talks falter, then I would expect this assault that we've all been waiting for to actually happen. But if there's some glimmer of light, then a glimmer of hope, I would expect them to retreat a little bit, because at the end of the day, any engagement with the United States, anything that undermines the Iranian regime in general at a time where their own people are against the regime, it threatens their power. It threatens their existence altogether. And so they're aware of that. So that's what I expect. We're not going to see anything until these ceasefire talks are over. At least we know what direction they're taking.
Hagar, we only have a minute left. I don't want to have to cut you off here, so just fair warning. I'm wondering what you're hearing about pro-Palestinian protesters, if anything, disrupting the DNC next week in Chicago.
I am hearing actually that they are planning on disrupting the DNC. They tried, I believe last night, the vice president was at a fundraising event in the city, and they tried to. It became violent. They tried to break into the restaurant. They ended up throwing things at the police and smoke canisters and getting very violent. And I expect them to try again, and I expect the vice president to put them in their place once again. This is not anybody. I do a lot of work in human rights, a lot of work with activists. I'm teaching them how to protest effectively, and that is not the way.
Well, let's stay in touch on that. This is going to be interesting as we head for Chicago next week. Hagar Shamali, always a pleasure to spend time. Greenwich Media Strategies, former National Security Council on Syria and Lebanon, with us here on Bloomberg. A lot more straight ahead. We'll assemble our panel next on Balance of Power on Bloomberg TV and radio.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money. If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
It's 1:21 on Wall Street. I'm Amy Morris, and this just crossed the Bloomberg terminal. Paramount which is restructuring its TV production business as part of a whole cost-cutting effort, may soon be getting an offer from Bronfman Group. Shares of Paramount jumped on the news, now 7% higher. Of course, we're going to keep an eye on that for you. Stocks climbed, bonds tumbled as retail sales data underscored the strength of the U.S. economy, allaying fears the Federal Reserve's high rates would be risking a pronounced slowdown. Retail sales advanced 1% in July. That's the most since early 2023. And we check markets for you all day long at Bloomberg. The S&P 500 up 1.4%, NASDAQ up 2%, and the Dow up 1.2%. The 10-year Treasury yield at 3.93% and the 2-year yield at 4.1%. Walmart raised its sales guidance for the full year, buoyed by consumers buying necessities and seeking deals, even as they curtail their spending elsewhere. Walmart shares now 6.5% higher. That's a Bloomberg Business Flash. Want to go back now to Balance of Power with Joe Matthew and Kaylee Lines.
All right, Amy Morris, thank you so much with the check on the markets. Markets, of course, are awaiting clues, not just in the economic data, but also clues about economic policy from both of the presidential candidates. We thought we might get some yesterday when Donald Trump gave a speech in Nashville, North Carolina, that was supposed to be about the economy, and to a large extent it was, but he veered into a number of other different subject areas and actually questioned whether or not the economy was the number one issue at all. Here's a taste of the former president yesterday.
Today we're going to talk about one subject, and then we'll start going back to the other, because we sort of love that, don't we? But it's an important, they say it's the most important subject. I'm not sure it is, but they say it's the most important. Inflation is the most important, but that's part of economy.
It's kind of like when he said that picking a vice president wasn't all that important. That was the purpose of the speech yesterday. Kaylee, I guess he made a little bit of news, address housing costs by opening big tracts of federal land for development. He, of course, talked about making the 2017 tax cuts permanent. Yep. And then tariffs, we've heard that before, 20% across the board. So the fact is there was really no real news. The question will be how detailed Kamala Harris gets tomorrow, when apparently she's going to propose a bill that'll ban price gouging in the food business.
Yeah.
Clear that Democrats would have to own Capitol Hill to pass that.
Well, true. She was looking at higher grocery prices, essentially wants to make sure that the companies that produce this food aren't able to take excess profits beyond actual business costs. Dictate. Other than that, we're not totally sure what else she will have to say when she herself is in North Carolina tomorrow. And of course, before that speech, she'll be with Joe Biden in Maryland today, also focusing on costs, but specifically on healthcare costs.
Let's get into this with the panel. Rick Davis is back with us today. Partner at Stone Court Capital, Bloomberg Politics contributor alongside Caitlin Legacki, partner at Four Corners Public Affairs, and Democratic strategist. Great to see you both. Thanks for coming along. Caitlin, we're going to hear from, as Kaylee just mentioned, Joe Biden and Kamala Harris today. How different will the Kamala Harris we see today be from the one we see tomorrow when she outlines her own economic proposals?
I think you'll see a relatively similar person. Obviously, Joe Biden is the current president, and he's going to take center stage at this event, in large part because these, prescription drug savings that we're seeing are a direct result of his agenda. But what we're also hearing and what's being previewed is that Kamala Harris is going to campaign on an extension of that ability for the government to negotiate prescription drug prices. So this is absolutely one issue that we know resonates very well with voters. It addresses the major issue of costs right now for the American people. And it's something that she's going to plan to carry through should she be elected. So I think, first of all, this is a hugely important story for both the Biden administration and the American people. But I think it also helps us, show that through line where you can expect to see her continue the Biden agenda versus where there may be areas in the future that she needs to chart her own path.
Well, Caitlin, if I could just quickly follow up with you on how specific you really expect her to get with this speech, knowing she's going to have another chance to address the nation really from the DNC in Chicago next week. As our Bloomberg Politics editor Laura Davison mentioned to us earlier this hour, the more you say, the more you open it up to potential areas of criticism. So are we really, and by we, I mean the Bloomberg audience, going to get what we want here?
The Bloomberg audience, absolutely not. You guys demand a level of specificity that I would not expect tomorrow. But I think you're going to start to see her chart out, the key areas where she wants to focus on creating a fairer economy, addressing issues like inflation. One of the things that I was most excited to see is that she's going to address affordable housing. We know that Tim Walz, as governor of Minnesota, made significant investments in affordable housing. And Bloomberg noted in 2023 that that was a major reason why Minneapolis was the first market to hit sub 2% inflation. So I think it'll be a good start. We'll obviously hear more from her over the course of the campaign. But I think this is an initial step to outline the broad strokes of what she wants to do to bring down costs, and then we'll hear more later.
The messaging here is tough, Rick. All of our polling, with the exception of one recently from FT, shows that Donald Trump kind of owns the issue of the economy here, and that's because of the problems that Joe Biden has had connecting with voters on something called Bidenomics. As we consider the idea of Kamalanomics, how would you advise a candidate who's trying to embrace the old in the form of Joe Biden here, but also the new with a plan that might invigorate voters and consider a new approach?
Well, Joe, the first thing I would tell them is don't call it Kamala-onomics or whatever. I mean, like we always thought that the Bidenomics was putting your stamp on a failing economy. So let's not start with a failure from the past. And then I think that informs the future. So I don't think she wants to really carry the burden of the economic policies of the Biden administration for the last 3 years. She'll cherry pick things that work great. Obviously, one of the things that you were just talking about is this prescription drug pricing. That is a good way to combat, inflationary prices related to prescription drugs. It hits every family in America. I think that's a real winning topic for them, and then she can mix it up with her own stuff. I mean, I think she still poke fun at Donald Trump by saying that she's going to, work hard to get rid of the tips for, tax on tips. And then you couple that with some of these other things on housing and whatnot. I think it'll sound like a substantive speech. Is she going to make us happy by saying, oh, and by the way, here's how I pay for it? Here's going to be my budget for 2025 going forward. No, she's not going to go into that stuff, and she shouldn't. She needs to give enough credibility to the public that she can handle the mechanisms of the economy. And the FT poll you described is the first time I've seen all year. And I'm not holding my breath on national surveys as usual, but she did pop up 1 point ahead of Donald Trump for the first time, in voters' opinion on who's best able to manage the economy. So there's progress being made with the lack of specificity that we've already had in this campaign. And if I were them, I wouldn't get pinned down too much.
Well, what if you're Donald Trump? You had an opportunity in North Carolina yesterday to speak about the economy. Not only did Donald Trump question whether or not the economy was the most important issue, as he was suggesting his people are telling him, Rick, but he also did speak in pretty broad strokes, things that we've heard before when it comes to tariffs, no tax, not just on tips, but Social Security, drill, baby, drill, as he keeps coming back to, that deregulating the energy industry is going to be the key to bringing down prices. Is he doing enough? Is he getting specific enough?
He's got the benefit of having managed a, economy that worked pretty well for most Americans for at least 3 years of his 4-year term. And so he's got a track record, which is what the polling indicates, is that people like the work he did then. So he's under less scrutiny to say, what am I going to do? Because honestly, if it were him, I'd say, well, I'm going to do the same kind of things I did before. I'm going to cut taxes. I'm going to punish those who take advantage of our, of our economy from abroad. I don't think he's got the burden of proof on him about an economic plan. And frankly, I think the things he's done is hurting. When you talk about 60% tariffs on China, 20% tariffs across the board with other countries, and of course, he always frames it in that's how I'm feeling that day anyway, right? I may or may not do it. I'm going to cherry pick who's going to get punished. But then he caps all those kinds of inflationary things off with, oh, and by the way, I'm going to have inflation, and I'm going to bring down prices. The Tic Tac thing was, incredibly, I think, off the mark. Holding up a big Tic Tac box and then a little Tic Tac box, and saying, "Oh, this is all you get for Tic Tacs." And I'm sure the audience is like scratching their head, going, "What the heck is he talking about?" There's an argument to be made about food prices, but Tic Tacs are not the way to do it.
This is the first time the Tic Tacs have come up, Kaylee. We watched this yesterday. He pulled them out of the pocket. He said, "This is the greatest ad of all time." There is something very 1980s. We'll be drinking Tab, maybe Caitlin, before the end of this campaign. Donald Trump said something interesting yesterday. He promised, this was kind of a moment, to slash energy and electricity prices by half. That was the language he used. You do that by drill baby drilling, as Kaylee mentioned, cutting red tape. But then he said immediately after, quote, "If it doesn't work out, you'll say, 'Oh, well, I voted for him. I still got it down a lot,'" unquote. To what extent did Donald Trump lower the bar for Kamala Harris tomorrow, Caitlin?
I mean, they're never being graded on the same curve, right? She is always going to be held to a higher policy standard than he is. The bar for him on these policy agendas has been quite low for a very long time. And that's part of why many of the attacks related to Project 2025 have resonated so much with voters. But the reality of the situation is that if it were that easy for any president to cut energy prices, we would have done that every single year. But under Joe Biden and under Democrats, we've produced more domestic oil and energy than ever before. That includes oil and gas as well as clean energy. Prices are under control, but I don't know how Donald Trump will wave his magic wand and cut oil prices further without getting the Saudis to just completely open up OPEC. So maybe that's his plan, but it doesn't hold a lot of water. And I think Harris is going to be held to a different standard, as any politician should be. But I don't think anyone takes Trump's policy declarations very seriously.
Rick, we just have a minute left, and we are waiting any moment now for Kamala Harris and Joe Biden to arrive and speak at this event in Maryland. But we also are waiting later this afternoon for another news conference from Donald Trump in Bedminster, New Jersey. What does he need to not do in this newser today, Rick?
Well, he's got to quit acting like a hostage to his campaign. He can't start the presser by saying, "Oh yeah, my campaign wants me to talk about the economy. I don't really want to do that, but I got to make them happy." I mean, that is wrong. I mean, you should not do that. It's not, going to get confidence in the public. He ought to just launch into it. He ought to keep it under 30 minutes and not drive everybody crazy, because every minute after that is going to be some kind of story that he's going to pay a price for. And he ought to succinctly go after the Biden administration on the economy. I mean, even though there is a lot of good news this last 2 weeks, that is not sunk into the voting public, and he can bring that back up and use it as a whipping boy. And that's what his supporters want him to do. And does he have the discipline to stick to that script?
All right, well, we'll find out about 3 hours from now. Rick Davis and Caitlin Legacki, our political panel today. Thank you so much. Now, we are watching the stage in Maryland. Governor Wes Moore is speaking now. In just moments, we are expecting that Vice President Kamala Harris will take the stage there, followed by President Biden. Again, their first appearance together since Biden dropped out of the race a few weeks ago. We'll have more coverage for you next, right here on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, You'll hear us in conversation with business icons.
This show will explore deal making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Saturday mornings, I understand you have off.
Yeah, Saturday is always a day where I power down. So I run at a relative high pace throughout the week, try to wrap things up, and Saturday is a quiet day for me in terms of work. And I start typically by playing tennis with my wife. We go for a swim all year round. After that, have a nice lunch, and then I'm on to a good trajectory for the weekend. And then Sunday, I try to prepare for the coming weeks. But through a weekend, I would send either no emails or very few emails, because I want to drive a culture where all get an opportunity to spend the weekend as they fancy. I think what we do is so difficult, and it takes so much creative thinking to succeed, that if you're always on, always busy, the bandwidth of your reflection is just too narrow. And I generally believe that Monday mornings I'm a better leader than I am, say, Friday afternoon. I also take all my vacations. I generally believe I'm a much better CEO right after a vacation than I am before vacation.
Billionaire Gautam Adani founded one of India's biggest and most controversial business groups. After being rocked by accusations from short seller Hindenburg Research last year, Adani is now preparing for the company's future in a real-life succession story. Meet the family members he's hand-picked to take over the business as we deep dive into the facts and rumors surrounding the Adani Group. Inside Adani, a Bloomberg exclusive replays all weekend, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
It's 1:40 on Wall Street. I'm Amy Morris. Stocks climbed, bonds tumbled, retail sales data underscored the strength of the economy. S&P 500 up 1.5%, NASDAQ up 2%, and the Dow up 1.25%. The 10-year Treasury yield at 3.93%, and the 2-year at 4.1%. That's a Bloomberg Business Flash. Now back to Balance of Power with Joe Matthew and Kaylee Lyons.
Amy Morris, thank you, and welcome to the Thursday edition of Balance of Power here on Bloomberg TV and radio as we count down to the first appearance. Joe Biden, Kamala Harris together on the same stage since the President of the United States dropped out of the race. They're together today at Prince George's County Community College. This is in Maryland, just outside of the nation's capital. If you're with us on Bloomberg TV or YouTube, you see the stage that has been set, lowering prescription drug costs. The language on the signage, the backdrops on this stage, they just put the presidential seal in place. Kaylee, Wes Moore, the governor of Maryland, helped to get the crowd wound up before these two emerge.
Yeah, of course, it will be fascinating to see the current president and one who is seeking to be president after him joining the stage together, as this may be in part legacy defining for Joe Biden, but also an attempt to campaign for the vice president here. And it's worth noting that after today in Maryland, Harris will be in North Carolina tomorrow giving a speech on economic policy, what she would like to pursue. And the question we've been asking is, to what extent will she try to distance herself from the policies of President Biden? Biden was asked that question on his way to this auditorium earlier today. He said she's not going to.
Well, we're going to find out about that because she does plan to propose legislation that would ban price gouging in the food business. One of the things, at least we know, she'll be outlining, but still a lot of questions, Kaylee, about what that speech might bring and, frankly, what we're going to hear today.
So let's get into it now with Matt Bennett from Third Way, where he is Executive Vice President for Public Affairs as we await the emergence of the Vice President and President on that stage together in Maryland. So, Matt, how hard is this line going to be to walk for Vice President Harris as she, on the one hand, tries to applaud the efforts of this administration that she's been a part of, but knowing the negatives that it can also come with that, may try to create some degree of separation?
Yeah, it's really tricky. And I think there's a distinction to be drawn between putting distance between herself and Biden on the things that they have done or were planning to do, and proposals that she would like to enact going forward. Those are different things. I don't think you're going to see too much distance putting. I think that she will inevitably need to run on the record that they created together, some of which is difficult for her because of the inflation, but some of which is very, very positive. They did a lot of really important and big economic things. Inflation is coming down, jobs are booming, manufacturing's coming back, the stock market's booming. So there's a lot of good things for her to run on, but she's got to articulate a vision for the future as well.
We're going to be hearing, of course, from the administration as a whole here, the Biden-Harris campaign in the next couple of moments. Matt, they're going to talk about Medicare, expected to save $6 billion. You can see if you're with us on YouTube or Bloomberg TV, the signage in the room focused on this. The first round of price negotiations on 10 widely used drugs. This is a pretty bipartisan message. Who's the audience? Is this aimed at senior voters, or is it about more than that?
It's definitely aimed at seniors and the people who love them. Prescription drugs are a huge part of the budget, the household budget for many seniors. And this is a big deal. It's billions of dollars, not only in savings for the federal government, but also in savings for people. And it's a long time coming. As you say, it was a bipartisan effort in Congress to allow Medicare to begin to bargain with pharmaceutical companies, which they were barred from doing for a really long time, that kept prices artificially high. So I think this is very important for them politically and substantively.
Matt, as we await these remarks, we've gotten some new polling data today. This is from Pew Research that does show that Harris is leading, although it's very close. We're basically talking a tie here. 46 Harris, 45 Trump, with registered voters nationally, another 7% for Robert F. Kennedy Jr. But the demographic information was really interesting. 77% of black voters said they support or are leaning toward Harris, compared to 64% who said the same about Biden in the last survey. Hispanic voters also favor Harris over Trump by a 17-point margin, especially when we consider the difference in the way these demographics are viewing Harris compared to Biden. Is that really truly at the end of the day an economic story as well?
I think it is both economic, but also broader. You know, people pick their presidents differently than they pick other elected officials. They're governors and mayors and senators. They don't look at a list of achievements. They don't look at a list of policy proposals and match them up. Well, I like this person on abortion and this person on the economy. They make it in a much more holistic way, because presidents live in people's lives in ways that other politicians do not. And so I think a lot of this is simply that they like the energy that they get from Harris and Walz, not just the youthfulness, but the kind of positivity. And I think they were not loving what they were seeing from the president in that regard. And so I think that's a big part of the difference. I don't think that a major policy shift is what is pushing these poll numbers so dramatically in her direction.
We're seeing images now of Judith Judy Aiken, a retired nurse who's going to be introducing Kamala Harris. Will speak before President Biden, based on what we understand here in the run of show. Matt, this is quite a moment for Joe Biden as we wait for them to take the stage here. What's going through his mind? Because as of this moment now, it's not about him anymore.
Yeah, I mean, this is kind of the last valedictory moment where it is. The person who speaks last is the most important in politics, and today it'll be him. But next week it'll be her. You know, he's speaking Monday and she's speaking Thursday as the nominee of our party. And that's a big deal. And I can only imagine how difficult this is for him, given the way that this all came about. However, I think what we will hear on Monday especially is a real summation and valedictory set of remarks from him about the things that he and she were able to achieve in just 4 years with very narrow margins in Congress and against some very tall odds. I mean, they took over with the pandemic still raging, with people dying, with the unemployment rate high. So that's what I think you'll hear.
Well, Matt, and our listeners on Bloomberg Radio might not see this, but on Bloomberg TV, you see the images now of Vice President Kamala Harris and President Joe Biden entering the room together in Maryland as they are prepared to give remarks. Again, we are expecting the vice president will speak first, the president after that. We're going to bring these remarks live on Bloomberg TV and radio. So, Matt, we'll thank you here. Thank you so much for joining us. Hope to have you back soon on Balance of Power. Matt Bennett, Third Way Executive Vice President for Public Affairs. But Matt, of course, speaking there to the uniqueness of this moment. Joe, Vice President, going to allow Kamala Harris to speak on the administration's behalf. First, she's just taken the podium to cheers. Let's listen in to her now.
Can we please applaud Judy? I love you back. It's good to see so many friends. It is good to see so many friends. And I want to thank you. Thank you. And let's please thank you. I love you back. Thank you. And I know we all thank Judy for sharing her story. I think we all know it takes a very special person who has dedicated over 40 years of their life to do the work that Judy has done as a nurse, that work being what? To care about other people in a way that is about lifting them up and caring about their well-being. So, Judy, we thank you so very much for being here today. I want to recognize the incredible Governor Wes Moore. Who's here with Don and their son. And Wes, I'm so thankful to you for all that you do in service to our nation in so many different ways, and your friendship, but in particular, to share such a personal story as you have. And I know it takes a lot out of you to share that story, but to do it in a way that is about lifting up other people and helping, hopefully, others who are not in this room, understanding how real people are impacted every day about this issue and by this issue. Thank you. I want to recognize the people of our administration, including Secretary Becerra, who is here, the bold administrator, Brooks LaSure, who is here, my dear friend and former colleague, Senator Ben Cardin, Representative Barragan, the chair of the Congressional Hispanic Caucus, and Representative Mfume for all of your years of leadership. And I want to recognize your next United States Senator, Angela also Brooks. And I've worked with her over the years. I'm telling you, Marilyn, you're going to do a great thing when you send her to the United States Senate. And of course, I could speak all afternoon about the person that I am standing on this stage with. He's going to speak in a minute, but there's a lot of love in this room for our president. And I think it's for many, many reasons, including few leaders in our nation have done more on so many issues, including to expand access to affordable health care than Joe Biden. And today we take the next step, thank you, Joe, forward in our fight. So we believe deeply every senior in our nation should be able to live with security, stability, and dignity. And so in the United States of America, no senior should have to choose between either filling their prescription or paying their rent. That's the subject of today. Because we know for far too long, far too many of our seniors have struggled to afford their medication. And as a result, seniors have been forced to spend their time trying to figure out how they are going to be able to fill a prescription like insulin based on the doctor's prescription, which is about saving their life, or whether they'd have to ration their pills to be able to make it stretch through a month. And why, we all know, but let's ask, why are prescription drugs so expensive? I will tell you. Well, one big reason is for years, Big Pharma has often inflated the price of life-saving medications, often charging many times what it would cost to make just to increase their profits. And millions of Americans have suffered as a result. My entire career, I've worked to hold bad actors accountable and lower the cost of prescription drugs. As Attorney General of California, I took on pharmaceutical companies for deceptive marketing and illegally inflating the cost of drugs, and we won billions of dollars. As a United States Senator, I fought to pass laws that would make health care more affordable and accessible for all Americans. And as Vice President, together with Joe Biden, our president, we finally addressed the longstanding issue that for years was one of the biggest challenges on this subject, which was that Medicare was prohibited by law from negotiating lower drug prices. And those costs then got passed on to our seniors, but not anymore. 2 years ago, we gave Medicare the power to negotiate lower prescription drug prices for the first time in history. And here is why that matters. It is nearly impossible for a patient to negotiate lower prices by themselves. Just think about that. Somebody who needs the medication, who may be suffering from a serious illness, that they would by themselves be able to negotiate against a big drug company to lower that prices is virtually impossible. It's one person against a huge corporation. But Medicare represents more than 65 million people. And so Medicare has collective bargaining power. And now Medicare can use that power to go toe-to-toe with Big Pharma and negotiate lower drug prices. Thank you, Joe. And this is to the benefit of not only tens of millions of people on Medicare, but also millions of Americans on Medicare who have long-term disabilities. And understand, as a result of our negotiations, the government will also pay less than for prescription drugs. And think about what that means in terms of helping taxpayers save money, whether or not they take these medications. So all of this is to say, 2 years ago as vice president, I was proud to cast the tie-breaking vote that sent the bill that gave Medicare the power to negotiate and let it get to the president's desk. And I was proud when our president, Joe Biden, signed that bill into law. In the 2 years since, we've been using this new power to lower the price of life-saving medications. And now to announce the result of those negotiations, it is my eternal and great, great, great honor, I have to tell you, to serve with this most extraordinary human being and American and leader, our President, Joe Biden.
We take care of their own. We take care of their own. Wherever this flag's flown, we take care of their own. Thank you. From Chicago to New Orleans, from Memphis to the bone.
Thank you, Kamala. Well, I love you guys too. I've been waiting for this moment for a long, long time. First time I sponsored a bill to let Medicare negotiate the price of drugs was in 1973 as a freshman senator with a guy named Frank Church from the state of Idaho. Folks, I have an incredible partner. The progress we've made, she's going to make one hell of a president. And Judy, thank you for sharing your story. It's a really one for far too many Americans. People like my dad used to lay in bed at night when they lost his insurance as the company he worked for, staring at the ceiling, literally. And you've all experienced, you know, people who have experienced this, wondering what in God's name happened if my wife gets breast cancer, or if I get sick, or my children get seriously ill. What happens? What in God's name, how can we pay for the drugs, prescription drugs? I'm serious, these are the discussions. You know it. Do we have enough insurance? Can we afford the medical bills? We'll have to sell the house to get a second mortgage. There are discussions that took place in my house and your house. Kamala and I both get it. We know it isn't just about health care. It's about your dignity. No, it's about your dignity. It's about peace of mind. It's about security. It's about taking care of your family. It's about giving folks just a little bit more breathing room. That's all. Look, I believe that health care should be a right, not a privilege in America. And Kamala and I are here today to make a major announcement on our efforts to lower the extraordinary high prescription drug prices. Before I do, I want to thank Governor Wes Moore and members of Congress. I served in the Senate for 270 years. I know I only look 40, but I'm a little bit older. The longest time I was too damn young because I was only about 29 when I got elected. Now I'm too damn old. But I'll tell you one thing in between. One of the finest, most decent men I've ever worked with. When I think of integrity, is Ben Cardin. Stand up, Ben. Stand up. I really mean it. I measure the people I work with by their integrity. He does what he says and says what he does. Look, folks, also, Nanette Barragan, for the longest time, she tried to pretend with me she was Irish, her name Barragan. She's a great friend, and she's one of the great leaders in this country for the Hispanic community. Congressman Fume, where are you? Stand up, man. I've never once gone to this man and asked for help, and I haven't gotten it. Not one single time. Thank you, pal. Thank you. And your soon-to-be senator. Where is she? It's a hell of a lot easier job than being a county executive. I was a county official. They expect you can solve every problem. You don't have the authority to do it. You don't have enough money. But I'm looking forward. I told her I'd campaign for or against whichever helped the most. Along with members of my administration, Javier Becerra, HHS, Administrator Brooks LaSalle, CMS administrators here today. And let me say something. We're all thinking about my good friend, and he is a really good friend for a long time, Steny Hoyer. He represents the western shore of Delaware. Y'all think we're kidding. We have that fight all the time. I wish him a speedy recovery. I understand he's doing well. Folks, this is a fight all of us have been fighting for a long time, taking on Big Pharma. We pay more for prescription drugs. It's not hyperbole. We pay more for prescription drugs than any advanced nation in the world. I could take out an Air Force One, and if you have a prescription from a drug company in America, and fly you to Toronto, Canada, fly you to Paris, France, fly you to Belgium, fly you anywhere around the world, and get you the same prescription filled for the same company for 40 to 60% less than we pay for it here. Too many Americans can't afford the drugs they badly need for life and death. So they skip doses, cut pills in half, forego prescriptions entirely because the prescription drugs are totally unaffordable. The woman you all met, the nurse you just met, she's paid $900 a month. Well, guess what, man? She's going to pay nowhere near that. $9,000. She's going to pay, guess what? Beginning January, every single prescription drug she has, including, God forbid, if she needs a really expensive drug like a cancer drug. Maximum she ever has to pay is $2,000, period. That's why from the time I was in the Senate, I worked tirelessly to give Medicare the power to negotiate lower drug prices, just like the Department of Veterans Affairs. In fact, I was reminded by staff today, one of the first major bills I worked on was in 1973. I co-sponsored legislation led by Senator Frank Church that let Medicare negotiate the cost of drugs. 1973, this fight's been going on. You know, the VA pays, as they should, 50% less than Medicare because VA can negotiate the prices. But for years, Big Pharma blocked Medicare from negotiating lower drug prices. As a consequence, they're able to maintain the exorbitant price increases and the profits are uncalled for. Look, but this time we finally beat Big Pharma. And I might add, with no help from Republicans, not a single Republican voted for this bill, period, not one in the entire Congress. Now, the reason I say it is not to make a political point about them, if they have gotten their lesson, but guess what? The guy we're running against, what's his name? Donald Dump or Donald, whatever. They want to get rid of this, what we passed. They're fighting to get rid of what we've just passed. No, I'm serious. No help from Republicans passed the Inflation Reduction Act thanks to the tie-breaking vote of Kamala made it possible. Folks, it really matters. For example, take the insulin needed to treat diabetes. The guy who invented that insulin 100 years ago didn't put a patent on it because he wanted it to be available for everybody. He didn't even patent it. Well, guess you know how much it costs those companies to make that insulin? $10, T-E-N. That's the God's truth. $10, number one. Number two, to package it and ship it, you might get it up to $13. But they were charging up to $400 a month for it. But now they can't charge more than $35 a month. It's a big deal. Oh, look, $35 a month. These guys still make enormous profits. That's 3 times what it costs them to make it. The initial legislation capped the cost for everyone who needed that insulin. How many of you know anybody needs insulin for diabetes? Raise your hand. Okay, well, guess what? For the next 3 months we got here, I'm not leaving here, and Kamala, when she's president, going to make sure if we don't get it done, everybody should qualify for that $35 a month. Every American. I mean it. Folks, that's not all. The same law we wrote, means starting in January of this year, every senior in the United States of America, no matter what their cost of drugs, and like I said, some of these cancer drugs are $12,000 a year. Every single penny they spend, they never have to spend more than $2,000 a year for all drugs. All drugs. And we're going to fight to make sure everyone qualifies for that as well. Look, all together, our reforms not only save lives, but here's the point people don't talk enough about. It saves the taxpayers billions of dollars. What we've done so far will save the taxpayers over the next 10 years $160 billion. Taxpayers, lowering the debt. I mean it. Because they don't have to pay the exorbitant price that Medicare had to pay before. They're going to pay $35 instead of $400. Folks, and those savings are only going to increase for American taxpayers because it matters. Look, but that's not all the Inflation Reduction Act did. Last summer, I announced under that law, Medicare is going to select, and it's already passed law, 10 drugs a year, going up to 20 till we get every single drug every year. Drugs treat from everything from heart failure, blood clots, kidney disease, arthritis, blood cancers, and more. And today, I'm proud to announce that Medicare has reached agreement with all manufacturers on all 10 drugs selected in the first round of negotiations. The new lower prices for all 10 drugs will go into effect in January of 2026. Not this January, next January. Negotiations cut the price of these 10 drugs for Judy and others who are Medicare nearly 40 to 80%, depending which drug it is. Let me give you one example. Non-insulin diabetes drugs cost $530 a month. Some of you may know that. Guess what? It's now only going to cost $115.
All right, folks, you are listening to President Joe Biden there with Vice President Kamala Harris, the president delivering remarks on the progress that the team has made, his administration, to lower costs for the American people. They are at Prince George's County Community College in Maryland. Welcome to Bloomberg Business Week. I'm Carol Masser, along with Tim Stanovic, on this Thursday, August 15th. This is the first time that we've seen the two together in what has been a very news-filled couple of weeks, Tim.
Yeah, the first time that the two have been together since the president ended his re-election bid just close to 4 weeks ago and endorsed Harris. This is an event outside of Washington touting prescription drug savings under the president's signature Inflation Reduction Act. If you do want to keep listening to the president or watching, just hit live go on your Bloomberg terminal.
All right, and I will say, in all, the presidential candidates are out in full force talking policies. Later today, Donald Trump will be holding a campaign event in New Jersey. So, again, there's a lot going on, and yeah, we are in a presidential election year. We've got a lot going on, including some economic news, which has been really important this this week, in what we've been focusing on. So we're going to get to that in just a moment. Having said that, we want to talk a little bit more, too, about what we just heard from Vice President Kamala Harris and President Biden. With us right now is the co-host of Bloomberg Balance of Power, Kayleigh Lyons. She is in D.C. So, too, is our Bloomberg News White House and politics reporter, Gregory Cordy. Hey, Kayleigh, let me start with you. Anything jump out for you? The race is on.
Well, the race certainly is on. I wouldn't say what they spoke about in terms of the actual efforts to lower costs for seniors and for the Medicare program overall, but with these negotiating with big drug companies, was that surprising? Because we already knew what this was going to look like, announcing a $6 billion cost savings for Medicare itself and for seniors who rely on these drugs. About $1.5 billion in cost savings is what the White House is putting out there. I think what was more interesting was to see the nature of the interaction between the vice president and the president, who is now going to be a one-term president. We heard him there in his remarks referring to Kamala Harris as the next president multiple times, while she in hers was saying, leading the crowd in chants of "Thank you, Joe," really trying to still put a spotlight on his legacy as she campaigns to be president herself after November. So it's a really remarkable thing to see, as this is the first time they've shared a stage since Joe Biden made the decision to leave the race last month. And I would also point out that Harris is going to be making a speech of her own on her own in North Carolina tomorrow, talking about economic policy. Clearly today, she is not trying to distance herself from this policy in particular when it comes to lowering drug and healthcare costs for Americans. But tomorrow may be a day in which we see her carve out more of her own lane and potentially forecast ways in which she intends to be different on economic policy than the president she served for the last 3.5 years.
Yeah, speaking of that own lane, Gregory Cordy, come on in here because you contribute to the Washington Edition newsletter. Sign up for that at Bloomberg.com or on the Bloomberg terminal. To add on to what Kayleigh was just saying, how does a vice president of a current administration, of a current president who is less popular than the vice president, manage to disassociate herself from the term that she served over the last 4 years, but at the same time not distance herself too much?
Yeah, it's definitely a balancing act, and there's a long history of vice presidential candidates who served under the presidents having a little bit of maybe friction with their predecessor. Eisenhower was famously asked if he could name a policy area where Richard Nixon contributed, and he said, "If you give me a week, I might think of one." Right? So this is something that every president and potential would-be vice presidential successor has had to grapple with. And in this case, I think I think Kayleigh nailed it. Looking at the visuals here, certainly there seems to be a lot of chemistry between these two still. Remember, this is a Biden event. This is an official White House event. So we still have Vice President Kamala Harris introducing the president. If this were a campaign event, the order of precedence might be a little different. He might be introducing her. But this is an official event, and it's in very friendly territory. It's in Prince George's County, just outside of Washington, D.C. It's the kind of place you go when you're president if you want to get out of the Capitol and still get home in time for lunch. But it's also the most Democratic county in America. This is a county that voted 90% for Joe Biden. It's sort of the home of kind of a burgeoning black suburban middle class in the Washington region and really nationally. So this is going to be a very friendly audience to Joe Biden, and you heard that with a chance of "Thank you, Joe."
Yeah, I think about like kind of the baton passing, which we know actually happened a few weeks ago. But, I do think, Kayleigh, you're right. Like the image, it's really striking. And I was thinking about, when I had last seen President Biden specifically, but to see the two of them together in very, very different roles, you do think about, okay, folks, the Democratic Party, same thing. We've talked about how they have the unity in getting behind Kamala Harris. It really does look like the baton has been passed. A new chapter is kind of been opened as well.
Yeah, absolutely. And we're going to see this on display again next week at the Democratic National Convention in Chicago. President Biden is slated to speak Monday night. One could argue that of primetime speaking slots in a convention week, that is perhaps the least important, as they traditionally build up as the week goes on. And it will culminate instead on Thursday evening with a speech from Harris herself as she formally accepts the nomination to be the Democratic candidate for president in this election cycle. So it'll be very evident in Chicago the way in which this race has shifted so fundamentally, and the party itself along with it, as you say, Carol. What will be interesting after we get through the convention and really we're in that final stretch toward the election on November 5th is what role President Biden is going to play in the Harris campaign. To what extent will the vice president and her team, along with Governor Walz, of course, want him to be there campaigning on their behalf, involved on the trail? In what way, to the point we were talking about how we could see some different messaging from Kamala Harris tomorrow, will they try to create some degree of separation from a president who left the race in part because he was so deeply unpopular, and especially on issues of the economy and the border? So how much will we be seeing these two share the stage as we did today, again, as we move forward in these final weeks of the race?
Getting ready for all of that and more campaign events. Having said that, Gregory, I want to get back to you in terms of the money behind the campaigns. What do we know about the money that continues to come in on each side, and how we are all kind of getting ready to be blitzed by tons of political advertising?
Yeah, it's already happening. We reported yesterday that there's $247 million reserved in August alone. We haven't even gotten to Labor Day, and we're talking about $250 million that's going to be spent on presidential races on really what's an expanding map. Harris's entry into this race has really expanded the battleground map. It really was formerly being fought almost exclusively in Pennsylvania. 60% of ad spending just a few months ago was being spent in Pennsylvania. Now it's all of those 7 swing states that we talk about: Arizona, Georgia, Michigan, Nevada, North Carolina, Wisconsin, as well as Pennsylvania. And so it's starting early. Trump is getting into the game after really sort of ceding the airwaves to Biden for many, many months. Biden was the only one spending, trying to make up ground against Trump in the polls, and we know how that ended. But both of these campaigns are sitting on large stockpiles of cash from these small dollar money bombs. Every extraordinary event that we've had this summer, tens and hundreds of millions of dollars of small donations come in. And the other thing that's pushing this forward is that early voting starts in about a month in Pennsylvania, if you can believe that. And so the candidates have to get their messages out. And Harris is still, I mean, she has to reintroduce herself to voters. And of course, Trump is going to have to define her as a dangerous radical liberal as well. And so really we're seeing all of a sudden the television campaign come to life in mid-August.
Kayleigh, before we let both of you go, one of the opportunities that the former president has to define Kamala Harris is tonight in Bedminster, New Jersey, 4:30. We do expect him to hold a press conference there. Why Bedminster? What do we expect to hear from him, especially after yesterday's speech in Nashville?
Well, Bedminster, of course, is the location of one of his golf courses. He spends a lot of time there, in addition to Mar-a-Lago, where we saw him hold a similar press conference last week. So this will be twice in as many weeks here. In part, this is designed to create a contrast with Harris herself, who has, to this point, not been holding news conferences like this, not sitting down for interviews. It is something that the Trump-Vance campaign have gone after her quite heavily on. So we could expect some language for him to the effect of, at least I'm here answering your questions. But especially, Tim, as you bring up that he did give an address that was supposed to be about economic policy in North Carolina yesterday. He often went off script. He at one point questioned what his campaign staff were telling him, openly saying, they say that the economy is the top issue. I'm not sure that it is, suggesting there's other things that he wanted to talk about. So the question around discipline is what we'll be on watch for again this afternoon, as there are other Republicans openly criticizing this campaign and this candidate specifically for a lack of discipline messaging. Nikki Haley, in an interview earlier this week, said he needed to stop whining along with the rest of the Republican Party. Even Vivek Ramaswamy, who after leaving the Republican primary earlier this year has been a very close, staunch advocate for Donald Trump, has suggested that he needs to take different advice when it comes to messaging and focus on specifically policy issues in contrast with Harris. So we'll see the extent to which he does so today. And of course, he'll also have other opportunities to do so. We understand, at least according to the Harris campaign, with what they say will be 2 presidential debates this fall. They've agreed to September 10th. Harris and her team say there'll be another one in October, along with the October 1st vice presidential debate between Walz and Vance that both announced they agreed to today.
Setting my VCR. Or no, I can't even say that. DVR. Sorry, DVR.
Egypt's Al Kahira News TV, citing informed sources on the Gaza talks, they're saying that disagreements between the parties remain big.
Washington Edition newsletter. Sign up at Bloomberg.com or on the Bloomberg terminal and check out Kayleigh and Joe at 5 p.m. for Balance of Power.
All right, watching politics, also watching what's going on in the U.S. economy. We did see the market react, stocks climbing, bonds tumbling as retail sales data underscored the strength of the world's largest economy, allaying fears that the Fed's high rates would be risking a pronounced slowdown. So let's get to it. Back with us, making sense of all of it, and I'm curious if he's going to vote in favor of soft landing. Bloomberg News international economics and policy correspondent Michael McKee here in studio. Is the soft landing intact?
We have no opinions here, okay? Just reporting the facts.
On the
For a
table.
minute there, I thought you were going to ask who I was going to vote for.
So did I. I was like, where's Carol Nassar?
Where is she going with this?
No, that's private. That's between you and the ballot box.
Yes. I already voted. I tweeted today. I think they've hit the soft landing.
Oh, I thought you were talking about voting for president.
No, I don't live in Pennsylvania. I got to wait till the polls open here. But the Fed has basically got an economy that has slowed but not fallen off a cliff, basically slowed to kind of the thing that they want, a sustainable level of growth. The Atlanta Fed GDP Now tracker after retail sales came out at 2.4%. 5%. That's down a little bit from 2.9, but it's still well above
growth.
Well above potential growth.
Yeah.
And then we saw inflation coming down as it has on a continual basis. So, you know, it's hard to say what a soft landing is in the sense that the economy doesn't land. It just every day we get up and do more stuff. But right now, you should say this is what they wanted, and they got there with inflation low and going down.
A very bright person on our team, Elizabeth Cedrin, said to me, is a rolling recession the same as a soft landing? Is it?
No, a rolling recession would be, well, the common understanding of it is that a certain part of the economy is in recession, and it comes out and another part goes into recession. Now, you can argue that manufacturing might be in recession now, but most of the evidence for that is in the sentiment surveys, the ISM surveys, whereas we did get a decline in manufacturing for a month today in the Fed's industrial production report, but that's the overall production has still remained strong enough, and we're still adding manufacturing jobs. So it's not like 2015 when we did have a manufacturing recession.
Hey, Mike, what metric would you have to see in order to say, not just you say this, but the general consensus be, the plane has landed and it was a soft landing. We can move on and now talk about the next economic phenomena.
Well, that's the hard part because, as I was saying, there's no real definition. But I think
would it be inflation at 2%?
Well, no, I think a lot of people would say when the Fed starts cutting rates, that they have determined that this is as good as it's going to get, and they can start cutting rates. So that would be the soft landing. You can only look at this kind of thing really in retrospect, and a year from now we can say, well, did we go into recession afterwards or not?
Yeah.
But right now it looks like they have done it. And
so Jay is breaking out the 150-year-old cognac. Kind of, and saying, hey guys, he's going to bring it to, you got to tell me, like, does he bring it to Jackson Hole?
Oh, well, I'll ask him, and if he's got some, maybe I'll sample it for you.
Yeah.
Now, if you remember the old story about the Vietnam War, George Aiken was the senator from Vermont who said that after he got fed up with the war, that we should just declare victory and go home. And that was his solution to the war. And my view is the Fed should just declare soft landing and then stop talking about it. All right, we made it. Now let's move on to what we do next.
Okay, speaking of what comes next, it is Jackson Hole. You are dusting off the cowboy boots, headed out there next week. How does the data that we got today inform what we hear from Jay Powell next week?
Well, I think it just reinforces the message that he's been giving us, that the economy is in good shape. They don't have to rush anything. There's no emergency. And yet the economy is behaving as they thought it would, and inflation is coming down as they thought it would. So they have more confidence in progress. And he'll probably say, what he has said is it will soon be appropriate to
is the soft,
change rates.
The soft July jobs number that freaked everybody out, is that an outlier?
Well, there's a lot of thought that it might be because we had a lot of people who weren't working because of weather. Now, they say it wasn't the hurricane in Texas, but weather around the country. And then you had a big jump in the number of people who were on temporary layoff. Now, when we match that up against the jobless claims numbers, remember, jobless claims shot up in July, and now they have come back down to the pre-July numbers, and what we saw is that the biggest declines were in Michigan and Texas. And Texas was where the hurricane was.
Right.
And in Michigan, the auto plant retooling. So we always kind of expect higher claims in July, and for those reasons, and this is probably reflecting that. So there is a good chance we get something of a rebound. Most economists I've talked to don't think we'll go back to the 180 level, but we will see a rebound from what we had in July.
I think there's going to be a lot of fly fishing next week because he's going to feel kind of good.
Wish.
Like we kind of got
wish.
I'm just saying. Just kind of feels. He's got to feel pretty good here.
More beverage curves than actual beverages next week.
Very nice. Very nice.
Sad a good way to put it, yes.
Michael McKee, thank you so much. International economics and policy correspondent here at Bloomberg News. Okay, so check politics, check economy. Now we've got to talk a little bit more about retail, specifically Walmart, because this stock is off and flying.
Yeah, Walmart shares up 6.8% right now, up the most in more than 4 years. The world's largest retailer, a barometer of growth, soaring, Carol, after raising its sales guidance.
Yeah, the Bentonville, Arkansas-based company says it now expects net sales to rise as much as 4.75% for the year versus previous guidance for a gain of as much as 4%. So definitely bumping that up. It also raised its targets for operating income and profits. It sounds like everything is awesome. So let's get into it with Bloomberg Intelligence senior retail staples and packaged food analyst. So psyched that she's back with us. She's there in BI headquarters in Princeton, New Jersey. Jen Bartoshis, good to have you back with us. So Walmart, it feels super good, but you're the expert, is it?
Yeah, Walmart had a fantastic quarter, and there's no question about it. And in an environment where people are seeking value, Walmart is flourishing. What I would say, there were some very interesting takeaways from the earnings call this morning. And one of them that I thought was most notable was when Doug McMillon kind of called out some of the packaged food suppliers that Walmart has in terms of pricing. And that, he said about half of them have, stopped trying to pass through price increases, but the other half are still trying to do so. And when you have that in a backdrop where the consumer is really looking for relief from inflation, it was a very interesting takeaway that Walmart seems to be signaling they're going to be tougher on their suppliers.
So is that Doug McMillon just being smart because we know Walmart is very tough on their suppliers and just saying, hey, don't play around with me. I know what's going on. I see the numbers. Or is it really that, it's something, Jen, I'll be honest with you, we've talked about, like, why haven't prices come down more? Are they do suppliers know they're in an environment where people are like, yeah, they're all talking about inflation, so they expect to pay more. We can continue to keep prices high. What's your take on it? You're the expert.
Yeah, well, I think that there's a combination of things, as there almost always is. Part of it is that Walmart does have the scale to kind of flex those muscles, but there's been also a lot of political conversation, just as you were talking about with your last guest, what are the expectations, and, there are, people are going to be talking about this as part of the election backdrop in terms of food inflation in general, making things more affordable. The difficulty is that when you look at retailers like Walmart or like Kroger or some of the essentials retailers, profit margins are only in the 2 to 3% range. So it's not like they're price gouging and pocketing the cash, right? So I think that we're going to see some of this pressure transferring up the chain back towards the packaged food companies. And that could translate over the second half of the year and into next year into additional margin pressure if there is demand that they start to lower prices more aggressively.
Okay, Jen, we're going to talk about that in just a couple of minutes. You can just read our minds with exactly where we want to go in the conversation. Before we get there, I want to kind of refer back to what you were talking about in reference to our conversation with Mike McKee a little earlier about the economy, because what struck me was actually a comment to our Bloomberg News team from Walmart's CFO, who said, quote, "We are not seeing any incremental fraying of our customers' financial health." That's John David Rainey in an interview to our own Jaewon Kang a little earlier this morning when those numbers crossed. How can we read into Walmart's results to get an understanding of the U.S. consumer?
Well, arguably, Walmart touches more consumers in the U.S. than probably any other retailer because everybody shops there usually at some point. So they do have a very, very good read into the U.S. consumer. One of the things that's interesting, and they talked about it in their call in May and again today, is that they're pulling more higher income households into their sphere of influence. So more shoppers are coming to Walmart.
The NYMEX
more
diesel
frequently than
September
maybe they had
futures settle at
historically.
$2.37 a gallon.
when you take
NYMEX
that
gasoline
aggregate together
September
and
futures
Walmart says
settle
they're
at
not seeing,
$2.35
any kind of fraying in the
gallon.
consumer,
NYMEX
I think
natural
part of
gas
that is that
September
as a
futures
low-cost
settle at
operator and as a
$2.19.
low-cost price provider, they're giving customers
NYMEX
what they
WTI
need,
crude
and so
September
customers are
futures settle at
continuing to reward Walmart with their
$78.16 a
spending and their
barrel. That's up
loyalty.
$1.18
Other
or
retailers may see some of that
1.53%.
fraying that Walmart is not.
Okay, let's I want to touch on the price gouging because that's politically a really interesting thing.
Yeah.
Jen, you started talking about margins a little bit, but because you cover packaged foods, retail staples, we got to ask you about Vice President Kamala Harris set to call for a federal ban on food and grocery price gouging as part of this broader set of proposals intended to reduce consumer costs. Her campaign said this in a preview of that first policy speech of her presidential bid. How did that statement read to you, given that you understand the economics of groceries and you also understand the role that regulators could or could not take in an environment such as this?
Yeah, I think the first thing is that everybody wants to see price relief for the consumer, because if consumers feel better, they spend more, and that's a great thing overall for our economy. When it comes to putting a ban on price gouging, it's very difficult to pinpoint what you consider price gouging versus not. The most successful cases that we've seen in the last 2 or 3 years that have actually resulted in settlements are price fixing cases that are really about commodities. We've seen that about pork. We've seen that about chicken. We've seen it about eggs. We've seen it about sugar. These are actual commodities where it's easier to prove that there is price fixing happening, or that there is some sort of unfair practice that's occurring. Once you start trying to implement that at individual retailers, that gets very, very hard to monitor and to identify exactly who may or may not be violating a ban.
So could regulators go after those suppliers rather than the sellers of the products from those suppliers to actually...
The Department of Energy buys 1.5 million barrels of U.S. crude for the Strategic Petroleum Reserve for delivery in January.
To enforcing a ban like that would be with the suppliers. And that goes back to kind of what I was alluding to when I talked about the packaged food companies, and perhaps they may bear a bigger part of that burden than the retailers themselves. In general, packaged food companies have slightly higher profit margins, not meaningfully higher, but somewhat higher. Same with with regards to EBITDA margins. So there's a little bit more room to give, but most of the packaged food companies that we're listening to through this earnings period are talking about still struggling with costs.
Hey, listen, you mentioned consumer sentiment. Just 20 seconds here. When you keep an eye on, what do you watch in terms of the health of the consumer and then these consumer company space? What's the most important metric? Is it consumer sentiment?
Sentiment's important. It's just really about how often are consumers going out to stores and how much are they spending. So ticket and traffic are kind of the two big things that we always watch in retail.
Oh my God, you're the queen of consumer packaged area. We love it, love it, love it. Jen, thank you so much. Bloomberg Intelligence Senior Retail Staples and Packaged Food Analyst Jen Bartashis with our Bloomberg Intelligence team there in Princeton, New Jersey. We do have a story crossing the Bloomberg terminal.
Yeah, Redhead, California Governor Gavin Newsom plans to propose legislation requiring oil companies in the most populous U.S. state, that would be California, to amass stockpiles of gasoline and other fuels to prevent supply shortages and price spikes during refinery outages.
Yeah, such reserves would shield Californians who already pay some of the highest pump prices in the nation from the sort of run-up seen in 2022 and also last year. This is according to a Newsom appointee who leads the state's Division of Petroleum Market Oversight. If such a measure had been in place, it would have saved consumers as much as $650 million last year alone, this individual putting that out there. So, there's a lot going on, and we're thinking about cost to individuals, consumers, in a big way.
I'm also thinking about markets because I'm seeing a lot of green across the screen. The NASDAQ up 2.3%, the S&P up 1.6%, and the Dow up 1.3%.
All right, you are listening and watching Bloomberg Business Week. Carol Master, Tim Stanovic. This is Bloomberg.
The top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp up, well, that's slowing down everybody. And that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some self-awareness.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Billionaire Gautam Adani founded one of India's biggest and most controversial business groups. After being rocked by accusations from short seller Hindenburg Research last year, Adani is now preparing for the company's future in a real-life succession story. Meet the family members he's handpicked to take over the business as we deep dive into the facts and rumors surrounding the Adani Group. Inside Adani, a Bloomberg exclusive replays all weekend, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
It's 2:40 on Wall Street. I'm Amy Morris. Stocks climbed, bonds tumbled, retail sales data underscored the strength of the U.S. economy, allaying fears the Federal Reserve's high rates would be risking a pronounced slowdown. Retail sales advanced 1% in July, the most since early 2023. The number of Americans applying for unemployment benefits fell last week, another sign that the job market remains resilient in the face of high interest rates. This is the second week in a row jobless claims fell, now to its lowest level since early July. Ahead of retail sales, we got retail earnings from Walmart. The world's biggest retailer raised its profit outlook for the full year as it expects to reel in more deal hunters. Walmart says its outlook based on performance so far this year, but there's still some uncertainty around the election and the war in the Middle East. Walmart shares now 7% higher. And St. Louis Fed President Alberto Musalem says he believes the time is approaching to reduce interest rates, joining a handful of other Fed officials signaling that they are close to supporting a cut when the FOMC meets next month in Washington. Let's check those markets for you as we do all day here at Bloomberg. The S&P 500 up 1.6%, NASDAQ up 2.3%, and the Dow is up 1.3%. The 10-year Treasury yield at 3.93% and the 2-year at 4.1%. And that is a Bloomberg Business Flash. Now back to Bloomberg Business Week with Carol Masser and Tim Stenovec.
Got it. Amy, thank you so much. Amy Morris in D.C. Well, free speech versus forces cracking down on incendiary content like hate speech. Welcome, everybody, to our brave new world, and one that has thrown the world's richest man and his ex-social media platform into the crosshairs of governments, Tim, worldwide.
We're talking about Elon Musk, of course, and his absolutist version of free speech. With more on this story by Bloomberg's Kurt Wagner and Michael Shepard, we head to Michael, who is Bloomberg News senior editor for tech and strategic industries, who joins us from Washington, D.C. The UK is actually a star of what's been happening in recent days. Michael, bring everyone up to speed, because if you aren't always online following what's been going on, you might not be up to speed.
Well, that's a great place to start, Tim, because this is one of the episodes that has really drawn a lot of attention to this conflict between, free speech and the absolutist version that Elon Musk has been promoting, especially on his Twitter platform.
And Brent crude futures settle at $81.04 a barrel. That's up $1.28 or 1.6%.
Took place in the UK following the July 29th murder of 3 schoolgirls. Since that attack, there was a surge of disinformation on X, but on other platforms too, like Telegram, that sought to foment the crime and turn it into an anti-immigrant moment. And far-right groups in the UK and elsewhere really seized on it. And we saw an eruption of violence in cities across the UK for several days.
What is free speech? Because I think about it, I'm like pulling up the First Amendment, right? Congress shall make no law respecting an establishment
I do not envy Michael, who has to answer this question. I'm just going to say that right now.
The free exercise thereof, or bridging the freedom of speech, or of the press, or of the right of the people peaceably to assemble and to petition the government for a redress of grievances. What does free speech, which is, I think, if you ask most Americans when they think about what is America, I would think free speech comes to mind, that we can kind of say whatever we want, even if it's controversial. So what is free speech?
Carol, this is a great question, and this is the ultimate tension underlying the discussion here, and that we're seeing on X and on other platforms, really is how do you define it, and whose speech is it? But it is also a question of what is the speech seeking to do? There's a difference between controversial speech and even hateful speech, things that may be of a racist nature or sexist nature, but speech that tends to incite violence or harm people or cause harm. Even the U.S. Supreme Court, which has, resolutely defended the First Amendment and this idea of, virtually unfettered expression by Americans and really by others here in the U.S., and a sentiment shared by other governments and other countries, other democracies as well. One of the differences is, what about shouting fire in a crowded theater? What about crying wolf in a way that could cause stampede or could cause harm or could incite riots? And that is one of the questions really at hand in this whole discussion, that should the platforms that carry some of this communication do something to step in and say, hey, wait a minute, this could really cause some trouble, so we will not air that. In other words, exercise some judgment about what they are carrying and what appears and what gets spread out to millions of users. And this also includes the question of disinformation. Yeah. After a certain point, falsehoods can have an influence on public opinion and even election results.
I think, Michael, what is a challenging, particularly for these technology platforms that you and Kurt write about, is what is considered free speech in Brazil might not be considered free speech in the US or the UK or perhaps India, for example. So even though these platforms are available in all of these different parts of the world, what a user sees in one of those areas might not be allowed for a user in another area, no?
Well, Tim, I'm glad you brought that up, because we have seen differing approaches in different large democracies like the US, like Brazil, like India, where governments have taken different stances. In India, in February, the government was able to pressure X to suspend several accounts that were linked to incendiary content that risked stoking these farmer protests. and making them into really violent actions. And so they, the government was able to get the platform to back away. And in Brazil, we saw similar pressure on X from the government, from the nation's highest court, the Supreme Court, which was pushing to get some accounts suspended over the dissemination of what authorities in Brazil saw as fake news related to the country's 2022 election. That's still an issue being disputed, in fact, by Musk. Just the other night, some documents were unearthed related to the Supreme Court, and he posted them on X and pointed to it as what he saw as evidence of Brazil trying to curb free speech. Now, in the U.S., it's a different question. And the problem in the U.S. really is that we don't really have laws that allow regulators to step in with as much vigor.
But it's hard, right? Because social media, I always think about it's media. And increasingly, people get their news from social media. Right. And I think about, I grew up in the world, whether you were a New York Times or a Wall Street Journal or a Washington Post, that if you put out incorrect, or an ABC or an NBC or a Bloomberg, that if you put out wrong information, you had to correct it. If you put out an opinion piece, it was very clearly an opinion piece. And so I do wonder, how are we supposed to look at social media? Should it not be policed? Yes, freedom of speech. But when there are inaccuracies, what's the responsibility of those platforms?
Well, Carol, that's another great question there about the responsibility of these platforms versus some of the old media vanguard. I came up myself through the newspaper industry before joining Bloomberg, and even at Bloomberg, we have a rigorous approach to accuracy and making sure that if we make a mistake, we correct it, that we vet our articles before publication. And on these social media platforms, there really is no vetting. There is no screening. And at X, in fact, after Elon Musk purchased it in 2022, he made a number of drastic cuts to the workforce. It's part of a cost-cutting move. But one of the areas that was especially hard hit was the section that was devoted to writing and enforcing some of the rules governing user posts. And Elon Musk really wanted, no holds barred. And he wanted users to be the ones who were the police force, sort of like a posse in the old West days.
All I would say is, I just pulled up Elon Musk on X, Twitter, whatever the heck you want to call it, but he's got 194.6 million followers. And so,
even if you don't follow him, he'll show up in your feed.
Well, and the point is,
if you do click the algorithmic feed.
Followers policing, not all followers. I mean, he obviously has a lot more might on the platform, or somebody like a Donald Trump when he was on the platform has a lot more might. And so, I don't know. I don't feel like policing is so equal either. So, yeah.
That's right. A lot of people have faulted the community notes as being an inadequate tool to be able to rein in some of the what is seen as harmful content.
It's a brave new world, as we said. Michael, so glad we could check in with you. Bloomberg News Senior Editor for Technology and Strategic Industries. Check out this story. You can find it at Bloomberg.com and on the Bloomberg Terminal. Coming up next, the $113 million pay package that launches Starbucks' incoming CEO also launches him into the stratosphere when it comes to pay. We'll get to that in just a moment.
The biggest risk in property and casualty is that now climate change?
Yeah, so absolutely. When you look at natural catastrophes, the number of events has significantly increased, and not only the very big events like hurricanes, but also what we call secondary perils, so wildfires, floodings, and drought. And this leads to the fact that you have far more events and therefore a much higher cost of all of the natural catastrophes.
How do you really assess the risk of climate change? Because how can you possibly know whether there's going to be a hurricane or a flood? It's just based on the past or the projection of the future? Or how do you do that?
Since the dynamic has changed, we need to also look forward. And what we do a lot, we work a lot with scientists who understand what the warming of the Earth and climate change will mean for the question of taking risk. And secondly, we take much less risk than we used to take because we have to be careful.
So let's suppose there are a lot of hurricanes. Is that good for property and casualty insurers or not? Good because people say, well, there's going to be more hurricanes, I should buy more insurance, or not good because you got to pay a lot of claims?
It depends. I would say it's good because it creates the awareness to do more prevention. What we see today is that, as I said earlier, there is more events. It becomes more and more difficult to insure, and therefore we work a lot with our customers around preventions.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Now, your company news headlines on Bloomberg Radio.
From Bloomberg in Washington, I'm Amy Morris. Retail earnings from Walmart, the world's biggest retailer, raised its profit outlook for the full year as it expects to reel even more deal hunters. Greg Malik is with Evercore ISI.
Well, I think Walmart's been gaining traffic amongst all consumers really now for a good 8 quarters. And I think what you're seeing is that broadening out, that people are going to Walmart not just to save money on food, but they're going there to find where they need things. They can get some extra and really great value versus what else is out there in the market.
Evercore's Greg Malik, and Walmart shares advance about 7%. Norwegian Cruise Line Holdings President and CEO Harry Sommer explains that prices will absolutely go up for the remainder of this year and likely into 2025.
We're guiding in Q3 and Q4 for prices to go up. I mean, you may imagine, with the long lead time I described, Q3 and Q4 are substantially sold out. So we have great visibility, and we stand behind the guidance we just issued a few weeks ago in our quarterly earnings call. Pricing will absolutely go up in both quarters, and it looks that way for 2025 certainly as well.
CEO Harry Sommer tells Bloomberg Television that demand is high, while offering that predicting consumers' needs years into the future is a component of success. Shares of Norwegian Cruise Lines are up about 5%. And shares of Cisco Systems, the biggest maker of computer networking equipment, rose the most in more than 4 years after the company's bullish revenue forecast for the current period and its plans to cut thousands of jobs as part of a strategy shift. CFO Scott Herron says the workforce reduction isn't about saving money or boosting profits, but to free up resources to shift into AI. Cisco shares now 6.5% higher. Those are the company stories that we've been following this hour. I'm Amy Morris, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
All right, everybody, you are listening and watching Bloomberg Business Week, radio, TV, YouTube, Bloomberg Original. So, this is among our most read stories on the Bloomberg. We've all been talking about it.
Yeah, which one? I mean, there's like 3 stories about it. They're all different stories, I should say.
Ka-ching.
Yeah, we're talking about Starbucks incoming CEO Brian Niccol. He's set to start next month. People were wondering about his pay package. He was, I think people would fair to say he had a good tenure at Chipotle. No question
totally.
There. But by leaving Chipotle before all of his stock award grants have matured, he's actually leaving some money on the table. So that goes into the new calculation for his Starbucks pay package, Carol.
All right, so let's get to it. So Brian Niccol is going to start next month with a pay package worth $113 million, a large part of it, which is equity, to replace those awards from his prior employer that he'll have to relinquish, according to filings. Package will likely make him one of the highest paid CEOs in the United States. The change led to an instant return, though, in terms of the company's stock price. So after the announcement, stay with me, shares at Starbucks soared by 25%, the most ever, and added $21.4 billion to the company's market cap. So some might say, not me, others who are observing that it was money well spent.
You're just pointing out the numbers, Carol.
Time will tell, though. Yes, I'm just pointing out the numbers.
It's not just a substantial payday for Brian Niccol, though. Outgoing CEO Laxman Narasimhan, who was terminated without cause with respect to his contractual entitlements, will leave with a payout likely worth roughly $10 million. That's according to filings in his 2022 offer letter. Remember, he was there for fewer than 2 years. He also holds equity awards worth millions of dollars, which he may collect in part depending on the terms of his exit. So he still has skin in the game, you could say.
Yeah, it's kind of interesting. You and I were kind of having a conversation in the newsroom, like this whole idea of, executives, especially sought after executives. Somebody said to us, I can't remember if it was on air or off air yesterday, that they must have paid him Brian Niccol, a lot to get him away from Netflix. Not Netflix, I'm sorry, from Chipotle. Sorry, Chipotle. He's been there for a while, got it through the pandemic.
Chipotle and chill, Carol.
Chipotle and chill. Well, he's not chilling. He's going to leave. No. But is he really leaving? Because he's going to be working in the same city.
Exactly. So that's another one of the most read stories, is about how he'll be allowed to work 1,000 miles from Starbucks headquarters. He won't be required to relocate to Seattle. Instead, he'll commute to the home base of Seattle as needed to do his job. The company said in a filing yesterday. The current employer, Chipotle, located in Newport Beach, California, it's where Starbucks will pay for a remote office to be set up about 1,000 miles from Seattle.
I covered Chipotle for a long time. I mean, their home base was definitely in Colorado, in the Boulder area, and no doubt about it. So it was interesting that when Brian Niccol took over, that his home base was in Newport Beach. And what's interesting is the story that gets into it and covers that, Niccol will be allowed to continue to work from Newport Beach. It says being allowed to work remotely is becoming more common for CEOs and was part of the package that Starbucks used to recruit Brian Niccol to their company. And so his compensation includes a $10 million cash signing bonus and a $1.6 million annual salary. There's just a lot of moving pieces to it.
That said, white-collar employees at Starbucks were required at the beginning of last year to return to the office at least 3 days a week. It's a move that sparked backlash from some workers.
Do what I say, not what I do.
Hey, maybe he will be there 3 days a week. Part of the terms of the contract include finding temporary housing for him in Seattle while he does look for a secondary residence there.
Yeah.
So I assume he'll be spending quite a significant portion of time.
Well, if you've got a family, you don't necessarily want to uproot them. I totally get it, especially if your kids are younger. We're having some fun with it, but I also think it's interesting the flexibility of allowing CEOs, and maybe that will trickle down to more workers.
Everything is negotiable.
Going in.
If you're
going in,
a highly
so
rewarded
they say.
CEO. Yeah.
All right, everybody. For those who are watching on TV, the close is coming your way in just a moment. Tim and I are going to continue on Bloomberg Business Week.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. This is the close.
Stocks rally, bonds sell off as investors have two decidedly different takeaways from the latest economic data. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Steele. The everything rally except bonds.
Yeah, it's a something rally.
So it's the mostly everything rally. So here's a check on the markets. What I'm trying to understand is what the retail sales data showed us in terms of the market, right? You look at equities telling us that good news is good news, right? But then you look at bonds on the dollar, and that's telling me actually maybe good news is bad news. Maybe the Fed doesn't have to do as much as we thought, with bonds surging on the 2-year up by 14 basis points. We haven't seen that kind of move since all the way back in April, and the dollar index, not to be left out, also rallying as well. So I'm trying to understand good news equals question mark, Romaine.
Yeah, it's definitely a big question, Mark, but there's no doubt that retail sales report we got this morning did at least appear to raise confidence about the resiliency of the economy and the stock market. But that is the big question today. Is that confidence misguided? While the government data did show 10 of the report's 13 categories posting increases, most of the overall gains in that report came from a sharp bounce back in car sales. And the next biggest contributor, that came from must-have purchases like food and beverage. Now, that report came an hour and a half after Walmart raised its guidance for the year, saying it isn't seeing any incremental fraying of customers' financial health. But most of Walmart's sales gains came from less discretionary items and more from must-haves like food and beverages, groceries, an indication that value-seeking shoppers are indeed prioritizing essentials. Now, ultimately, though, it's not consumer spending, but the labor market that remains the key factor for when and by how much the Fed cuts rates. Applications for unemployment benefits have trended up, but remain subdued near those 2019 levels. And the latest numbers out this morning showed a second week of declines, a sign that MasterCard chief economist Michelle Meyer says might mean the Fed doesn't need to be too aggressive.
We are still seeing record low jobless claims. We're just seeing a moderation in the rate of hiring. We're still seeing the consumer spend. We're just seeing a consumer that's a lot more choosy and really conscious of the prices that they're accepting. We're still seeing investment, but again, a prioritization of the type of corporate investment. So to me, it's an economy that needs a normalization of monetary policy, not a dramatic easing of monetary policy.
Michelle Meyer appearing on the network a little bit earlier in the day as we kick you off to the close here at 3 p.m. Eastern Time. Seth Carpenter joining us in the studio. He's the chief global economist over at Morgan Stanley. When you looked at this retail sales report, did you have a definitive opinion on the health of the economy one way or the other, or is this that Rorschach test that we've been getting, it seems like, every week or month?
Yeah, no, I don't think this was a Rorschach test. I think anybody who was expecting weakness in the report was disappointed. This was a solid report. It showed that the consumer is still there, the consumer is still spending. I thought some of the details, though, that you were giving before about the nuances with Walmart, about the way things are going, it's really important. We've been calling for a long time that the economy is going to slow but not slump. We're very constructive on the outlook. We have been for a long time. We were sort of in the first vanguard of soft landing people. But the market really likes absolutes, good or bad, up or down. And we've been saying, exactly. And we've been trying to say, well, wait a minute, you can get slowing from the really rapid pace we had next year without it being a disaster. And that's what we're looking for, a moderation.
Well, unpack that for me. I mean, we no doubt cherry-picked a couple of things to sort of make a point. But let's say if you back out that bump up in car sales, which a lot of people think was just catch up, and you back out some of the gains that we saw in food and beverage, what else in there was positive to you?
Well, so I think just first off, when you look at, say, the control group, that really gives you a lot of information about consumer spending for GDP. It was positive. There was some risk, and we had in our forecast some actually a lower print just on some of the technicals of the seasonals, and all that clearly wasn't a problem. I think the autos, I think you could sort of put that aside. There's been over the past years some lumpiness. The shift, as you were saying, towards away from discretionaries towards more staples, I think, is there as well. But that's consistent from last year's really unsustainably strong spending growth to this year going back to something much more normal, and that's what we see in these data.
Which then raises the question, what does this mean for the Fed? 25, how fast do they have to go? I was really struck by Raphael Bostic talking to the FT, and in that piece he said, waiting brings risk. That's why we need to be vigilant on this, because our policies act with a lag in both directions. We can't afford to be late. We have to act as soon as possible. I mean, it's true, right? If there's a monetary lag in the beginning, there has to be one at the end too. So what does that mean for the Fed for September?
Completely agree, and you can always count on wisdom from someone named Bostic.
But
right?
he seemed to change. He seemed to change fairly quickly, though, after that inflation number came out yesterday.
So I think that's right, and there is a risk, and I think risk management is the name of the game. We have been now for a long time in the 25 basis points in September, but also 25 basis points at every meeting from now through the middle of next year. For a while, people thought we were extreme. Think there was too much. For a while, people thought we were extreme and not expecting enough. It's a risk. I think inflation now, pretty clearly after the last CPI report, that risk has diminished notably. The labor market has slowed. I think last month's labor market report probably overstated the softness, and so it's balancing risk. I think they can go for rate cuts. I think they can go for a chain of rate cuts because now is the time to try to support the continued expansion.
It is really funny because just last Jobs Friday, it felt like you guys were the really conservative ones in terms of rate cuts. So you don't think 100 basis points, the market's still off on that for this year?
I think that's probably overstating things. Now remember, the market has to price not just the single most likely outcome, which is what our forecast is, but also the whole set of probabilities around that. And so We could be wrong. At some point, we're going to be wrong. And it probably is skewed a little bit more towards more slowing than less. And so I don't think the market's sort of completely out of whack. But I do think I'm still comfortable with our forecast.
When you look at the market reaction to this, and we're going to talk about that a little bit deeper with our next guest, but I am curious as to whether they're saying the same thing. There's a lot of people looking at the rally in stocks, the sell-off in bonds, and then they looking at credit spreads and saying, well, they're not blowing out. I mean, put that all together. What is that telling us about sentiment out there right now?
Absolutely. I think people are searching just a little bit for what exactly it does mean. We've been looking for this soft landing where you could get reasonably tight credit spreads, where you can get interest rates coming down a bit, but not crashing. And I think the rally that we saw in rates, when rates came down a lot on the payrolls print, I think it was because a lot of people got spooked. Maybe things have to get a lot worse. And so the rise in rates now, I think, is people getting much more comfortable that the Fed doesn't have to be quite as aggressive to save the economy. And the equity market is in fact saying the same thing as well. Probably less risk of a recession than people thought before. We can go back to being a little bit more constructive on the outlook. That's been our view. Credit spreads are off their tights. They're nowhere near as enthusiastic as they were maybe a little while ago, but in the grand scheme of things, they still look pretty solid.
So markets are repricing disaster. Is that
moving away from it? I like to think of it as markets are moving away from disaster and coming closer to Morgan Stanley's view.
I'm sure you do. Where could you be wrong? Where's the kink?
So, I mean, we are going to get, at the very beginning of September, right after Labor Day, the labor market report for August. Tomorrow, in fact, we're going to get state-level data for the July report, and so we're going to understand how much of that soft July report was maybe hurricane or not. The print we get at the beginning of September for August is going to tell us, is this, in fact, a trend down? Or was July really just a bit of noise and we're sort of bouncing back? Our best guess, our baseline is the second, that we're going to learn that people overreacted to July, but that's where we could be wrong.
All right, great stuff, Seth. Always wonderful to see you and get your insights. Seth Carpenter, Chief Global Economist at Morgan Stanley, helping to break down the economic data that we got this morning. When we come back here on The Close, a fuller breakdown of the market reaction to that with Nisha Patel over at Parametric. This is Bloomberg.
Or other authorities.
Could face bigger challenges next.
Fed was going to keep rating World Cup.
This is a three as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg. Season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs.
Taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
S&P still up by about 1.6%, surging, and guess what? So our bond yield. So I love this chart. It shows that big move in the 2-year, right? We haven't seen that since April, and yields moving, like I mentioned, and S&P also adding to its 6-day winning streak. I write my own intro and then I mess it up. What does that mean?
I know that.
So usually these two don't necessarily move in tandem. That move in the bond market and that move in the equity market, it really was a head scratcher as to why that's actually happening.
What I love about this chart is, Alex, probably in a couple of days, you're going to have to flip this chart upside down and tell the exact opposite story.
I know, but at least we have it made. Nisha Patel is Senior Fixed Income Portfolio Manager over at Parametric. Nisha, what do you make of the reaction function today in the market in relation to the jobless claims data and the retail sales data?
This is a reversal of that flight to quality and that rally that we saw after the jobs number, right? So this is a correction in the market saying, look, things are not as bad as they seem. And so we're viewing this as really, two main takeaways. This is kind of a perfect scenario. It gives the Fed a lot of room to continue to cut, not that 50 basis point cut that might have been even jarring for the market, but get rates, long-term rates more in line. And for investors, this is a welcome gift, right? You have bond yields that are up, clients that have been sitting in cash. So we're viewing this as a very welcome opportunity.
Opportunity to where?
Opportunity to invest in bonds. So if you think about, I know we all talk about all this cash sitting on the sidelines, right? But if you take a look at where you're generating income, where you can put money to work, these are yields that we haven't seen in a long time. So even just looking at the 10-year Treasury, average has been, since the financial crisis, about 2.5%. We're almost back up to a 4%. So this, again, is that gift for clients that have been sitting in cash, focused on income. You can earn a good amount of income in high-quality bonds, and this is something we haven't seen in a while.
But why do I need to take on that duration risk right now? Because, I mean, I don't know if you're using bonds in the broadest sense, because I'm still looking at a 6-month bill where I can get 5%. And at least before today, you were seeing the rest of the curve kind of dip down here. So I feel like that gap between, say, a 10-year and say a 6-month or even a 1-year is just getting wider.
Yes, you teed this up so well for me. So but this is a number one question we've been having with our clients, right? I'm earning 5% or I'm earning 4.5%. That is very temporary and that's short-lived, right? As you know, as soon as the Fed starts cutting, that's going to start readjusting. So your reinvestment risk is very high. Once that starts rolling off and matures in 6 months, then what? Right, so our point is extend out the curve for two things. Lock in yields for an extended period of time, for 5 years, even 10 years. And then the benefit is that you have some duration. So look, we may not be in a rapid easing cycle anymore, but bonds have historically done very well, right, when you see a reshaping of the yield curve. And so as you enter that easing cycle, in a Fed easing cycle, by having duration, right, so because you expect bond yields to fall as the Fed starts to ease.
So the gains are more price?
So the gains are more price and you have price appreciation. So let's just say you have a 5-year duration bond and yields fall 1%, hypothetically, right? That's about a 5% price appreciation to make this very kind of back of the envelope type of math, plus your income that you could generate.
Just so I am curious, though, about the potential for seasonal issues. And obviously, when seasonal, I'm also putting in sort of the U.S. election and other things that are coming up along the way. A lot of people are going to be either reticent to enter new positions or even close out old positions. There's going to be tax implications, I think, going into 2025 that are unlike what people had to deal with coming into 2024.
Yes. So I think there's a few things happening here. I mean, look, in a lot of markets, my team and I focus in, the corporate bond market, municipal bond market. We've seen a lot of issuance. And it's no different than most election years. Most issuers want to get ahead of any volatility around the election time. But listen, demand's also been very robust, right? You've had $1 trillion of issuance in the IG corporate market. And, not even a blink of the eye. I mean, demand has been there to soak this up. So we're telling our clients that while you have a little bit of volatility, this window's open a little bit longer with some uncertainty, which is a good thing. Get in now before you start seeing massive flows and money moving into motion, in which case that's kind of the lagging money that comes in, right? You want to be kind of the smart mover, the first mover into bonds. So we're really kind of recommending this to our clients.
When we saw that spike in the VIX to like 60, 65, you had corporate credit spreads didn't really do much. I mean, they widened a little bit, but there was no like blowout. What does that tell you? Is that a demand story? Is it or was that just, hey, things aren't that bad in the economy story?
Yeah, I really think it's the latter, right? So today's spreads are tight, but you really have it fully baked in and priced in that the economy's not I mean, we're in a great spot. Some of the data is coming in softer, but this is what a tight monetary policy should be doing. So even today with where spreads are, you have a lot of cushion for spreads to widen out a little bit from here, right? And that's in a scenario where, you know, things could be pretty bad from an economy standpoint. If it truly is a soft landing, spreads may not have to adjust a lot, but then you have the duration and you're able to lock in yield. So I think this credit spread story to us has really been telling the story that I think equity market is now saying that, look, things are really not that bad. So we're saying, look, this is a softer landing more scenario. Things are looking great.
Yeah.
Get into the market and lock in these yields.
We only have time, I think, for one more question, but I do want to get your thoughts on volatility. I mean, we had a big spate of it, I guess, just over the last couple of weeks. It's subsided now, but everyone seems to be under the mindset that volatility will pick up over the next couple, 2 or 3 months.
Yes, look, I think let's just take the past week and a half as a snapshot of volatility, right? I mean, everything, and we've been saying this for a while, but it seems even more so, everything is to be so data dependent. Because now you have two schools of thought possibly of saying, look, are things good? Every time a number comes out, today's number justifies, look, things are not so bad. As soon as you have a weak print, well, bad news will start getting priced into the market. Every piece of data, I think, just gives more room for volatility for both bonds and stocks. Look, bonds, remember, at the end of last year, were pricing in 6 rate cuts. And then in April, we're actually pricing in 1 hike, right? And here we are back to 3 to 4 and actually less than 4 in just a matter of 1 print. So I think volatility is here to stay. And look, for some investors that, you know, may be tough to stomach. What we're just saying is this window of opportunity from an absolute yields perspective is very attractive for bond investors.
All right, great stuff,
Yes.
Nisha. Great to have you. Nisha Patel, Senior Fixed Income Portfolio Manager as stocks hit session highs and bonds right now. Treasury's hitting session lows. A lot more coming up here on the big program. Between that hot retail sales number and Walmart boosting its yearly outlook, consumers are indeed still spending. We're going to break down some of the trends hidden in those numbers with the CEO of Foresight Research.
All right, plus, Buffett is slicing and dicing, adding to Berkshire's portfolio. We're watching some of the new names he loves and the old names he's ditching straight from Berkshire's 13F filing.
And Dutch Brothers Coffee, UBS raising its recommendation on that stock to buy. We're going to talk to the analyst behind that call and why this has suddenly become one of the hottest stocks out there. All that and more coming up in a second, right here on The Close. This is Bloomberg.
If you look at private equity just as one piece of the institutional equity market, there are 3 times as many dollars invested than uninvested, right? So you have about $3.5 trillion in the ground that needs to get resolved versus about $1.5 trillion that's wanting to be invested. So if you're a private equity manager, you're trying to decide, do I take my capital and put it into my existing portfolio to either defend what I own or to try to grow it and create more value? Or do I use some, to your point, some creative financing to extend the duration or the runway of what I own and then try to put the capital into the new market environment? And everyone's taking a different approach. It's a function of where you are in your life cycle. Everyone is dealing with that. Even the highest performing PE firms, you're seeing slower fundraising. And in this deal environment, you have to start thinking creatively about how to get liquidity back to your investors.
All right, time now for our top calls. The big movers on the back of analyst recommendations. And we start off today With Robinhood snagging an upgrade to buy over at Deutsche Bank, with the firm saying that between the recent market sell-off and potentially volatile conditions into the U.S. elections, e-brokers like Robinhood are best positioned. In the near term, they see more than 20% upside for Robinhood in the next year. The share is getting a 5% run up here on the day. Next in line, let's take a look at Brinker International, the owner of Chili's. KeyBank asking for seconds with an upgrade to overweight, with the analysts believing that those recent results that we got out of the company that sent the shares down 30%, that they were misunderstood and they deserve credit for improved same-store sales and increased traffic. The analyst says the company is making the right choices and the earnings will soon show it. The share's up 8% on the day, and we're going to talk to the CEO of Brinkers just a few minutes later in the show. And finally, let's take a look at Dutch Brothers. Raised to buy from neutral over at UBS, a new price target of $39. And the firm saying that it sees several factors that could fuel the company's growth, including the rollout of mobile ordering and a wide open path to opening 4,000 stores. Those shares rallying 7% on the day, and those are some of our top calls. But we want to stay on that last one and get to the analyst behind it. Dennis Geiger joining us right now over at UBS. And that's a pretty bold expansion for a company that I think just a few years ago, a lot of people even weren't familiar with. Is the cost structure of that expansion going to be commensurate with the revenue and profits that it could generate?
Yeah, absolutely. If we look back over the last several years, you've seen significant growth, right? We've seen, depending on the year, 20+% store growth. As we look ahead, we think at least mid-teens % store growth going forward. And really that's underpinned by a few things. It's strong unit volumes where they're opening, particularly in newer markets. It's strong return on that investment. Depending on the structure they use, they can have up to 65% cash-on-cash returns on those stores. So with that level of return, we think very much supportive of continued opportunity for growth, and obviously tremendous white space across the rest of the country for a brand that is very much on trend and again is seeing strong results in new markets that they're going into.
Dennis, talk about that trend part of this, because there are a lot of people that will look at this and they'll say, okay, what's really different about a Dutch Bros versus either a Dunkin' or a Starbucks or any other company out there that specializes in these sort of to-go coffee drinks? What is special about this brand?
Yeah, I think it's a few things. I think you have to look at menu first, right? Where a big portion of the menu, of course, is coffee. Call it, coffee-based, maybe being half of that. You have a quarter of the menu or so that's energy drinks. We sort of know that's an on-trend category. The growth there is strong. Quite frankly, you're seeing other larger brands like Dunkin', like Starbucks, trying to mimic and trying to roll out their own energy beverage. So I think very unique from a menu perspective, and then from a culture perspective. When you go to the restaurant, you get that sense from the employee of the culture within the store. The service levels are strong. So again, it's a differentiated menu. It's a differentiated experience for the customer. Heavy drive-through, sort of in and out, and maybe there's an opportunity we can touch on there as it relates to mobile order on the phone. But really some differentiation, menu and customer experience, which I think has driven a lot of that success over the last many years.
At this point, Dennis, who's a fair competitor to Dutch Brothers? Like Starbucks is so huge, so that maybe isn't the best comparison. So who can I think of as a good comp?
Yeah, I think you can look at a lot of the other private brands, of which there are some. Seven Brew might be one on the private side who's doing the combination of coffee as well as energy. Again, I think you're going to see and will continue to see growth from more of these private, smaller, emerging brands looking to try and replicate some of the success that Dutch Bros has seen. And again, I think you're going to see some of the larger players try to do some similar things with energy, with some of the on-trend coffee drinks, protein coffee, et cetera, that has driven some really strong sales and very good margins to boot.
And Dennis, when you talked about the mobile growth rollout, like where are they in that? What's the upside there? And also, what's the money they got to put down for that?
Yep. So really significant opportunity, we think. Only in about 200 stores out of the 900 plus or so across the country right now. We expect the majority of that will be done by the end of 2024. So generally be in place for 2025. We think this is going to be again a big unlock for the company. You look at Starbucks back in 2016 or so, maybe right after they had launched it, they got to probably 4% utilization. Now they're at over 30% utilization. I think if Dutch Bros can see that trajectory, we think some really solid same-store sales contribution, at least couple of points next year. And I should mention, obviously, mobile adoption much further along today, of course, than back then. So I really think some nice benefits potentially for Dutch Bros into 25.
All right, Dennis, appreciate it. Dennis Geiger over at UBS. Thank you so very much. I'm looking at the 911.
Yeah. Okay.
6 shots of espresso.
What?
Half and half Irish cream
Is that
syrup.
legal? Is that legal?
Calories for a hot one over 600.
Okay, well, I'm going to see if I'm going to one-up you, because I was taking a look at the Cookie Dough Freeze, which is a blended chocolate chip cookie dough coffee with soft top and cookie dough pieces. It does not actually list the nutrition information on it, but I'm sure it must be high.
Oh, that's a whole other thing that I'm looking at.
You know, actually, I don't want to know it. I just want to enjoy my cookie in a cup, which apparently is all it is.
Okay, I'm looking at it. All right, coming up, we're going to talk more about retail sales and the resilience of the consumer. This is Bloomberg.
Saturday mornings, I understand you have off.
Yeah, Saturday is always a day where I power down. So I run at a relative high pace throughout the week, try to wrap things up, and Saturday is a quiet day for me in terms of work. And I start typically by playing tennis with my wife. We go for a swim all year round. After that, have a nice lunch, and then I'm onto a good trajectory for the weekend. And then Sunday, I try to prepare for the coming weeks. But through a weekend, I would send either no emails or very few emails, because I want to drive a culture where all get an opportunity to spend the weekend as they fancy. I think what we do is so difficult, and it takes so much creative thinking to succeed that if you're always busy, the bandwidth of your reflection is just too narrow. And I generally believe that Monday mornings I'm a better leader than I am, say, Friday afternoon. I also take all my vacations. I generally believe I'm a much better CEO right after a vacation than I am before vacation.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostic.
And I'm Alex Steele. And just to keeping track here, Walmart stock still up over 6%, obviously, as consumers are still spending.
It was a great quarter.
It was.
I mean, I know a lot of people are going to quibble, saying, oh, it's mostly from groceries and all that. But, I found an interesting stat today. I didn't realize Walmart gets 60% of their revenue now from groceries, from food items.
Right?
Yeah, I mean, I knew they were big in groceries. I didn't know they were that big.
Huge.
Yeah.
Which is interesting, too. I think the question becomes how people are paying for stuff. And this chart comes from the New York Fed. It was released on Monday, and it basically shows that the average likelihood that consumers would miss a debt payment in the next 3 months rose to over 13%. Haven't seen that since 2020.
Yeah, and that's a concern. I don't know. Some people dismiss it. They say, oh, well, you got to look at this ratio of something, and it's not as bad. But I don't know. It seems bad to me.
I mean, so you're spending, but how are you spending? That must make a difference. Joining us for more is Deborah Weinswig, founder and CEO of Coresight Research, a data-driven research firm that focuses on the intersection of retail and technology. What did you learn from Walmart and retail sales from today?
I think that when we look at the Walmart numbers, the amount of revenue and operating margin being driven by data was unbelievable. What they're saying with regards to retail media. So we're talking alternative revenue sources, which to me is allowing them to go back and reinvest. I think they said, right, we're kind of like people-led, tech-driven. And that really came through for me in the quarter. They also threw in, right, they're doing a lot around generative AI and how you search and how you experience the store. They're focusing on supply chain. Every box I would want to check, they checked for me. And I can't remember that happening on an earnings call in general in quite some time. So like you said, it was really kind of all coming up roses.
I mean, if we basically have higher end consumers trading down now to Walmart, so it's really trying to expand that pool of people to buy stuff. If the economy recovers, though, how can they keep attracting those consumers?
I think that it's more than that, too. And I do agree that there's this, maybe it's a trade down, maybe it's a trade over, but as they're making it easier to shop, like truly omni-channel, right? We've been talking about omni-channel since the beginning of time, but now that it truly is seamless. And I think with the Walmart Plus membership growing, right, we're seeing Sam's Club membership growing quite nicely. This idea that it's a seamless experience if it's out of stock in your local store, right? So maybe you can't pick it up today or get it delivered today, but you can have it delivered to you all in the same kind of basket. We're really simplifying the sales process for the consumer. And I think one of the things that we haven't talked about yet is what they're doing with third-party marketplaces. You're improving the selection. I mean, you can get Chanel and Gucci and all of that now on Walmart's marketplace, but it's all in one cart. So I think the whole experience is truly changing and evolving at a pace that is certainly faster than what many investors expected.
Why aren't we seeing other major retailers sort of follow this lead? I know you have sort of more pure play online retailers like Amazon, which are trying to do something similar, obviously, with their brick and mortar footprint as well. But you haven't necessarily seen a Target push this deep the way Walmart has, or some of the other competitors.
Now, I think that, I will say I've always thought that Walmart with its size would take, and I think many of us on the investing side would take longer to do things than they do. And whether it's around supply chain transformation, right, their ability to monetize their data and whatnot. And they've just gotten to kind of the end game faster. And right now they have to create a new story. But I think they've probably gotten things done a year earlier than even they would have thought. Mm-hmm. And so I think it's more of the ability to almost do like these surges and from almost a mechanization perspective, get things done in a very kind of systematic way so that they have more wins than losses and they're able to get the consumer there in a different way and a faster way than maybe some of the competitors. And I do think that if you think about the global picture, they're learning so much, whether it's from Flipkart in India, from China, from Walmex, that they're able to bring back to the home market that I think is also allowing them to ignite a lot of what we're seeing and what really came to roost in this quarter.
Yeah, I want to broaden this conversation out a little bit to just the overall health of the consumer, because there's been some speculation that some of what made this a great quarter for Walmart was that they had more customers who maybe weren't traditional Walmart customers gravitating to their stores in search of value. Is that a trend that you're seeing?
I think that we are definitely seeing this, because I actually thought we'd see it a little bit earlier in the year, because in an election year, we almost always see the consumers seek for value because there is a lot of volatility, right? That's just math. And so, right, when there's a lot of headlines and they're usually negative, right, that does change how the consumer perceives their own health, right? And I mean health of their balance sheet, health of their kind of earning potential and whatnot. And so I think that that's number one. Secondly, we've been in a kind of highly inflationary environment, especially it relates to groceries, right? The average consumer goes to the grocery store 2.1 times per week. So these are prices that they are seeing and that are top of mind for them. And, Walmart, I think, was the first to really start to talk about lowering prices, rollbacks, right? Everyday low prices. And I think that that's gained mind share and market share for them. And then lastly, this idea that the consumer has, certainly those savings from, 2020 and 21 are not necessarily what they were. And I think they're looking at their bank accounts and thinking about how they're spending. I mean, their 401ks are a totally different story. So it's a bit of like you're betwixt and between. I think overall they feel good, but they don't feel great.
Yeah, good but not great. That's a great description, actually. Deborah, what are your clients asking you right now? Like, what's the number one question that you're getting?
The number one question is 25 or 50 basis points in September. That is absolutely number one. Number two, why are we not seeing enough focus on supply chain? And number three, what are retailers doing with Gen AI right now that's actually making an impact?
All right, Deborah, great stuff. Great to talk to you. Deborah Wines-Wiggs, she's the founder and CEO over at Coresight Research, keeping an eye on some of those trends in the retail space. Alex, we did have some breaking news just a little while ago, and this involving Kroger. Of course, they're almost 2 years into this effort now to merge with the other grocery store chain in this country, Albertsons. Of course, a deal that's been under a lot of regulatory scrutiny for whether it's going to raise prices for consumers. Now, previously, they had said they were willing to offer as much as $500 million in price cuts to consumers, and now doubling that, pledging to cut grocery prices by $1 billion if that merger is actually approved by the government.
And I'm finding the timing of this particular part very interesting. Remember the other day, was it yesterday? Vice President Kamala Harris calling for a federal ban on food and grocery price gouging, also specifically targeting the Kroger-Albertson deal as one that she really wants to take another look at. So it's interesting to see that come down now.
Yeah, and this just seems like kind of bad timing. I mean, even when it was first announced, people said it was bad timing, and now with so many people hyper-focused on consumer costs here, they've definitely got to offer something to give people a little bit more confidence.
More on board on that. Also, we have more retail coming out next week, right? Target. That's going to be quite interesting.
Target, Macy's.
And my question with Target, though, is Walmart eating some of Target's lunch? Or is Target going to hold up because it is promotional? They're going to be lapping some of the boycotts that they had about a year ago. And is that going to wind up helping them, or is it just still a Walmart story?
I am curious about that too. I think the only thing that from our BI analysts they talk about is that Target's footprint is a little bit different than Walmart. So there's the Venn diagram isn't quite a full overlap, but I don't know if that helps them longer term or not. But,
yeah, and you know Macy's, right? Sales.
And Macy's.
I'm going to want to know about sales. Will we have sales at Bloomingdale's?
This is for a friend? You're asking
for a friend? I'm asking for a friend. That's the only thing I care about is inventory of Bloomingdale's for Macy's, so we'll get back to you.
All right. When we come back, though, we are going to take a look at some of those 13F filings and some of the big stocks that are moving on the back of them, particularly some of the ones that Berkshire Hathaway has decided to include in its portfolio. One of them is an investment in your face. Stock of the hour is coming up next. This is The Close on Bloomberg.
Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
All right, it's time now for our stock of the hour, or I should say stocks, plural, of the hour. Berkshire Hathaway boosting its financial stock weighting by more than any other industry in the 13F filings that have been rolling out over the last couple of days. The company also taking a new position in Ulta Beauty, SiriusXM Holdings, and they cut back their massive stake in Apple by about half and shed off Snowflake. Abigail Doolittle joining us right now to wrap this all up for us. Let's start off with Apple here. I mean, this is a stock that's been on a pretty good run, but when you sell off half the stake, is this profit taking or is there something more?
Well, I think it's a little bit of both. So the really interesting thing about Apple is, of course, they started selling this position at the beginning of last December, and in the recent report, and now the 13F confirmed that about half of their position is gone. The interesting thing is it's still their largest holding at about 33% of the total portfolio. Now, his quote-unquote lieutenants, they apparently were the people who back in the day bought Apple, Ted Weschler and Todd Combs, but it is Warren Buffett who is known to have ramped it up significantly and then to have taken the profits. And it makes a lot of sense in terms of the way they did it. When they bought it 11 times forward earnings, and when they sold it recently or over the course of the last, however many months, 33 times. So in some ways it's a call on, it's a call on the market. It suggests that they are negative in some ways on equities and repurchasing. And you can also see this with their cash position. Their cash position has really been bolstered higher.
And near KSR, just to that valuation standpoint, we had a great column today about how this might have been a valuation call that, they still like Apple, but as you said, 33 times or whatever you said, times earnings.
Oh, yeah.
Maybe not as valuable as it used to be.
It's usually it's like, hey, I'm gonna get it to cash because I made a nice profit and do something with the cash. That still is not happening. There's still a boatload of cash. What I find interesting, though, is that Warren Buffett's known for investing in things he can see, he can touch, he can see, he can feel, and they started a stake in Ulta.
One of our favorites, actually.
Invest in our base. Well, what I read
once again, I'm out of this.
No, he's into it.
Oh, you're into Ulta.
So what do we know here about that stake?
So it is $266 million. It is a new position for them, and I think that their main thing here is that they got it on sale. Even with today's greater than 10% rally, the stock is down 25% year to date. And if I take a quick look at earnings or valuation, forward 14 times. So it is relatively cheap. And I think that it's aligned with your thesis, Alex, that you want to invest in your face.
Yeah, well, somebody does, certainly so. And obviously Buffett and his lieutenants think so as well. There were a couple other names in there that we threw out as well that I think caught up some people's attentions.
Yes. Well, Snowflake caught my attention. Because Berkshire Hathaway and Snowflake, the software company, who knew? But supposedly that could have been, it's speculative, that a trading position on the part of Ted or Todd. We don't know that for sure, but that's a possibility. They also bought some serious, that may be some sort of an arbitrage deal with Liberty Media.
Yeah, that one really was a head scratcher.
Yes, it's also in terms of the complexity of the arbitrage. It's definitely, frankly, it's a little bit above my head. But it's interesting to see that they are. And then they added to their Chubb position. They paired Capital One and Chevron. And then it's interesting to note, just because this whole portfolio really is a microcosm of the S&P 500 and the economy, energy and railroads are not doing well. So when I think about them taking off positions from Apple at 33 times after buying it at 10 times, that they have this cash pile here, 45% of their investments, it seems like they're not market timers, but it seems as though there's some possibility that they're at least hunkering down for some sort of a possible storm.
Well, except, I mean, for Chevron, like if Exxon might have been a different story if you'd owned that stock at the end of the day. All right, Abigail, thanks a lot. Really appreciate that. Bloomberg's Abigail Doolittle joining us on Warren Buffett and those lovely 13F filings. All right, coming up, we are counting it down to the closing bell. 15 minutes to go. Lauren Goodman, economist and chief market strategist at New York Life Investments, will be joining us next. This is The Close on Bloomberg.
Total money market fund assets rose by $28.38 billion to $6.22 trillion for the week ended August 14th, according to ICI.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo Pet Products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that you know most households where most of the dollars go against the
1 minute until we get the market on close.
But treating, and then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
If I had invested with you, which I wish I had, what kind of rate of return would I have had over that 10-year period of time?
Over 100% a year on average. On average.
100% a year, that's pretty unusual.
Bloomberg covers the world with unmatched reach and resources.
Market on close imbalance. The S&P 500 2.2 billion to the sell side. The NASDAQ 100 1.5 billion to the sell side. The Dow 30 500 million to the sell side, and the Magnificent 7 370 million to the sell side.
It will be exciting.
Nobody covers earnings like Bloomberg.
We've been calling for a long time that the economy is going to slow but not slump. We're very constructive on the outlook. We have been for a long time. We were sort of in the first vanguard of soft landing people.
Seth Carpenter there, the chief global economist over at Morgan Stanley. He kicked us off to the close just about 50 minutes ago, Alex, on a day where we're seeing a huge rally right now in the equity market and a huge sell-off in the bond market on the back of those relatively encouraging retail sales numbers.
Yeah, and tech really continuing to climb higher here, very much outperforming. The Russell jumping higher as well. You have consumer discretionary, obviously the best performing sector within the S&P. But my question is, again, volume. Volume is still really, really light. Are we really going to be able to take these gains seriously? However, we were talking about, I was reading an article by Natalia Knežević of the Bloomberg Equities team about systemic funds are now buyers rather than sellers, that the upside could be for them as well.
Is that a contrarian signal, or is that, or am I just supposed to buy right into that and say, okay, we're going?
I think we're just going to the races a little bit.
All right, well, everybody's really trying to read the tea leaves here of where the market goes next, and of course, where the market goes next is dependent on where the economy goes next. Lauren Goodwin is joining us right now, who, well, fortunately for us, wears two hats. She's an economist and chief market strategist at New York Life Investments. All right, Lauren, let's get right to it. I mean, the overarching question really is, what kind of economy are we in right now? And did the data that we got today, or really over the last 3 days, provide any real clarity on that?
I think it did provide clarity, because this is an economy that is slowing, but for which the normal indicators that I would expect to signal it's time to move risk off, recession is at our doorstep, those signals are not yet here. Even with slowing inflation, a slowing labor market, I would typically look for unemployment claims rising above the 260 level, or a deterioration in earnings growth to signal that recession is at our doorstep. Those are not what we're seeing in the marketplace. And so though I do expect that over the next 6-9 months, the economy will be touching into a mild recession, until we see that further evidence of a more pronounced slowdown, investors need to be fully invested and more balanced in their approach to portfolio strategy.
Well, what does that look like, though, Lauren, assuming that your economic scenario plays out? What does balance look like?
Well, importantly, the data that we've seen over the past couple of weeks have marked a meaningful transition. In fact, I think it would be difficult to overstate how important the transition we've seen in the data. When the inflation figures moved into, let's say, better control, the market has become much more focused on the labor market, which is really growth. That means that good news is now good news, bad news is now bad news, and the market's going to be much more susceptible, we believe, to indicators in either direction. So today, constructive news from retail sales, constructive news from unemployment claims. That's a day where we can see the market move in a more risk-on direction. But we're likely to see days in the opposite direction as well. And so volatility in both directions, that means starting to diversify and broaden your bets, and we can elaborate on that, but that more balanced portfolio construction, we think, is the most important takeaway from the market right now.
Lauren, are bonds telling us the same story right now?
They are, to an extent. While we're not seeing spreads widen meaningfully in credit, again, the economic data is holding up relatively well, we are starting to see moves across the Treasury curve that suggest that this economy is likely to be slowing, and that changes in the bond market should be expected. One of the things that investors are often sort of grappling with are not only spreads versus rates, but also long versus short duration. One of the key messages I've been hearing in the past couple of weeks from other investors is that as the Fed is beginning to cut rates and the yield curve normalizes, it's time to move longer in duration. One caution that we have about that, one area where we're not as comfortable saying that view just blanket outright, is the fact that we are seeing much more supply and uneven demand in the long end of the Treasury curve. And so while we do expect that for most investors, it's appropriate to move out of cash into bonds, start locking in higher rates, which is naturally going to move a portfolio.
In 5 minutes time now, at the top of the hour, see the release of the US overall net capital flows. Prior read was 15.8 billion. Also see the US tick long-term transactions. Prior negative 54.6 billion.
Have also said in that we're seeing sort of a slowing but not a slump in the economy, and then to allocate accordingly. Where does that put small caps?
In order to see small caps really outperform, you need to be in a re-accelerating economy, a clear recovery. We're going to have days where the market feels like that, but it's not likely to be a durable investment strategy until we're on the other side of, again, what I expect to be a mild recession. That's not just to do with small companies, though. It really is the nature of the small cap indices in the US and other countries as well, where profitability and higher interest rates have been a challenge, and where really strong investor confidence is necessary to see a sustained recovery. In other areas of small business, like in private equity, the lower middle market as an example, we do think that there are some opportunities for more value creation, but that's a relatively sort of deeper look into the markets. For small caps specifically, we're not convinced that that's a durable play.
So then where does that sort of leave the Fed, Lauren? I mean, obviously everyone's looking ahead to the September Fed meeting. Pretty much the expectation is we are going to get a cut, but more importantly, what's the communication going forward with regards to maybe continuing that easing cycle, assuming it starts in September? Is the data there, as Jay Powell would say, enough of it there for them to continue with a full-blown easing cycle?
I think that the inflation report we saw yesterday met the bar that the Fed needed in order to signal consecutive interest rate cuts over the next few quarters. This is an economy that is coming much better into balance, slowing but still relatively sustained. The Fed sees its policy as restrictive, and that's not an environment, especially with inflation indicators pointing closer to the Fed's end of year for the next couple of years targets. It's not an environment where a highly restrictive stance is necessary. And so I expect that we will start to see a signal towards not just a cut in September, but the likelihood of sustained cuts back to neutral. Let's call it a 3 to 3.5% policy rate. I think the real challenge for the Fed and the needle that they're likely to thread is that it's tough to signal that interest rate cuts quarter after quarter, meeting after meeting, are necessary without some slowdown in the economy. And because the market is going to be more focused on growth, signaling that move back to neutral as opposed to panic is going to be a communication challenge for them.
All right, Lauren. Going to have to leave it there. Lauren Goodwin, economist and chief market strategist at New York Life Investments, helping us count you down to these closing bells. Alex, just about 2.5 minutes to go. Stocks still holding on to sizable gains.
And money market funds now, new record, 6.22 trillion. Yeah. We're not seeing that moving anywhere else.
You're making 5%. Why would you move it out right now? A lot of people just see the safety of it, right? 5% with effectively no risk.
Anisha Patel saying this is your window, right? If you don't take the window, then what happens?
Well, that's the other problem is you're trying to time something and maybe you just don't time it. Maybe you just roll out the duration. Full market coverage coming up right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Steele taking you through the Closing Bell, a global simulcast. It starts now with Scarlett Fu in the TV studio, Carol Masser and Tim Stenovic in the radio booth as we welcome our audiences across our Bloomberg platforms. That includes our partnership with YouTube on yet another day here where we're seeing some really, really strong moves in the equity market.
Yeah, well, we're up 6 days in a row here on the S&P 500, and so we've seen quite a bounce in those days. It feels like that soft landing we're talking about a lot. Is it possible that that is exactly what's happening? We'll see what Jay Powell has to say next week at Jackson Hole.
Yeah, I mean, look, I think it's fair to say that investors really like the retail data the retail sales data that they got earlier today. Walmart and Walmart commentary about the American consumer certainly helping to lift the markets as well.
Yeah, good news is good news once again, because last Monday, bad news was bad news, and then we turned into bad news is good news.
I can't keep track of that.
Exactly. But you know what the real catalyst is going to be, I think, next week when NVIDIA reports earnings. There's still earnings coming up from a big tech company.
Yeah, next week, Jackson Hole. Don't forget that. We got to get through that before we get to NVIDIA. I still think the bond market's quite interesting. I was really flummoxed by that move as well as the equity move. Are they saying the same thing? Or are they saying something different? It seems like Seth Carpenter, Morgan Stanley guys, was talking to us that it's all about slow, not slump, and that from that perspective, we're all kind of on the same page.
Yeah, absolutely. Here, we should point out volatility has been tamped down.
US overall net capital flows 107.5 billion, 107.5 billion. Tick long-term transactions 96.1 billion, 96.1 billion.
So actually below where it was before all of this really started to pop off all the way back at the end of July. The numbers here for the day are going to please a lot of equity investors. Green across the screen with the Dow Jones Industrial Average back above 40,000, up 560 points on the day, or about 1.4%. The S&P 500 up 88 points, or 1.6%, while the NASDAQ is going to close out the day higher by about 2.4%. And the Russell 2000, look at this, outperforming just barely by about 2.45% on the day.
Yeah, fascinating, right, to see that. In terms of, I'm going to go back to the big caps. I mentioned the S&P 500 up 6 days in a row. That's about a 6.5% gain along that. And then if I look at the S&P 500, Scarlett, you've got most names in the index, 414 to the upside. Tim had a really hard time finding decliners.
I know. I was thinking that too. Poor Tim. We'll give him a few more minutes to look for some decliners. But then that's really largely mimicked in the sector performances as well. 9 out of 11 sectors in the green, led by consumer discretionary. So those include your retailers, your home builders, as well as your car makers. Ulta Beauty leading the way there. Tech also gaining 2.5%. Materials, a surprise third place entrant there at 1.5% advance. And the laggards, REITs and utilities were a little changed.
A lot of green there. All right, let's go to Walmart. Let's start with that name. Up about 6.5% in today's session. We know it was a top name in the S&P 500. The company raising its sales guidance for the full year. They talked about consumers buying necessities, seeking deals, even as they curtail spending elsewhere. But that upbeat outlook really gave investors some reasons to buy that one. Cisco up almost 7% here. Again, a top gainer in the main indices. That company rising the most in more than 4 years, at least on an intraday basis, gave the company gave a bullish revenue forecast for the current period, also announced plans to cut thousands of jobs as part of a strategy shift. We know that this has been going on. Scarlett mentioned Ulta Beauty up 11%. It is, or at least, it's the number one gainer, folks, in the S&P 500. Warren Buffett's Berkshire Hathaway disclosed that it took a new small stake in the cosmetics retailer. That was a 13F filing. Their shares, they bought more than 690,000, and that stake now may be worth about $251 million today, so a big one. I should mention Paramount, too, also gaining, of course. The Seagram heir, Edgar Bronfman, saying to be preparing a bid for Paramount Global. I just wanted to throw that in, up about 7% today.
Yep. Invest in your face, guys. Invest in your face. Okay, Applied Materials coming out with the third quarter earnings. Net sales beating estimates, coming in $6.78 billion. You also had adjusted earnings topping estimates, coming in at $2.12 a share. Shocker. President and CEO Gary Dickerson saying the race for AI leadership is fueling demand for our unique and connected portfolio.
We have posted out the US June tick data report on the feed for anyone interested.
Markets for the longer term, that AI play.
All right, shares of AMAT down by about 1.2%. In the meantime, I was able to find a few decliners out there. They were few and far between. Thank you to Carol Masser for quite a bit of help on these. Not every retailer higher today. Look at what happened at Dillard's, down 10.8%. Fell on Thursday, this after the department store company reported net sales for a second quarter that missed the average analyst estimates. Comp sales fell 5%. Consensus estimate was 2.9%. Men's accessories and shoes were the worst performing categories. Grab Holdings, the largest of Southeast Asia's ride-hailing and delivery firms, shares fell today by close to a little more than 7%. This after the company reported revenue for the second quarter that missed the average analyst estimate. And look at this one, Spire Global. It's not a company we talk about each and every day. We have had the CEO on our program. They're a space-based data analytics and space services firm. Shares tanked, falling more than 33%. This after the company notified the SEC that its 10Q for the quarter ended June 30th will be late. They're going to reschedule their second quarter results conference call and announce the timing once the filing date of its 10Q is confirmed. Investors responding accordingly.
All right, well, we had a pretty dramatic sell-off all across the bond curve, particularly in that front end, guys. The 2-year yield moving the most since April 10th of 2024. Yields really popping higher and holding on to that gain all throughout the day, guys.
All right, guys, thinking about, we've always talked about getting together, doing a road trip or class trip together. So I have one for you.
We did?
We could do it between August 26th and September 2nd.
Who's driving?
If we go on New Jersey Transit, we could do
Transit?
I don't know about that.
We could do this ride, and it's going to cost us nothing. So wouldn't that be a lot of fun?
What better way to thank the passengers of New Jersey Transit, at least according to Governor Phil Murphy, than offer free rides after the chaos of the summer? My question for you guys is, how does this help with sort of the crunch, the budget crunch?
It doesn't.
That the transit is facing as a result of, well, a lot of things that have happened for many years?
It's just like, look at something bright and shiny here. Free rides.
When nobody's going to be on transit because everybody squeezes in their last vacation days that weekend, right? Or around that time.
As a New Jersey resident, are you impressed by this? Are you disgusted by this?
Do you know what I think? My taxes are going to go up because that's one thing that happens a lot in New Jersey. I love you, Governor Murphy, but...
This doesn't cut it, does it?
No. What do you guys got for us?
Well, there's a new study that's found that Americans appear to be pulling money out of their brokerage accounts to fund online sports betting. For every $1 spent on sports betting, which is legal across most U.S. states, net investments in stocks and other financial instruments dropped by just over $2. Again, an academic study, but Romain, do you think this is more correlation than causation?
Is this why we've been seeing the decline in volume in the equity markets? Let's face it. I mean, we always joke. Look, we have a lot of great people on Wall Street that we love, but we also know there are a lot of degenerate gamblers on Wall Street. So I think the Venn diagram between the type of people that would, take their money out of the stock market and go to the casino or vice versa, it's pretty strong.
Well, also, I feel like it's what they're measuring, right? Meme stocks, say, versus sports betting. But what about like zero-dated options? Like that, the retail share of that has been expanding, right? In the article they point out, it's over 18%. So is it really apples to apples in that sense?
What sport are they betting on, though?
Any sport, I think.
Anything.
You can bet on anything.
I don't know. Yeah, I think there's a correlation.
I do wonder if we're going to start to see.
Whatever there's a line on.
I do wonder if we're going to start to see because gambling used to be something that was constrained to Las Vegas, constrained to only certain areas of the country, and now it is everywhere. It's on apps. It's so easy to do. I do wonder if we're going to start to see some sort of widespread pushback.
You could, but there's also the argument that people who are involved in gaming would make, which is it's not gambling, it's entertainment. People who are putting their money into sports betting don't necessarily expect to make money, but if they do, bonus. Otherwise, it kept them busy for a couple of hours.
You can lose a lot of money.
Yes, you can.
It's only gaming if you win, right?
There's a real reason why it's a business, right? That these companies are in business because the house wins. It makes me.
There's also a reason they call it gaming and not gambling.
True.
The connotations are different.
Yeah, that's a good point.
No, the connotations are completely different.
It's the American Gaming Association, not the American Gambling Association.
But here's my point. It's your money. Can't you kind of do with it what you want? Is that bad to say? Like, if you want to bet on a meme stock or you want to bet on boxing, then, you can go ahead and do that?
Yeah, as long as you're not using meme stocks or sports betting to fund your retirement, sure.
I mean, but you could also do that too, and then that would just really suck for your retirement. But I'm just saying, it's not apples to apples.
Sure you don't want to join me on New Jersey Transit?
We're really sure. Yeah, but thank you so much for offering.
You're very
Carol.
welcome.
We very much appreciate your generosity.
We can take it to Atlantic City.
Oh, yeah.
There you go.
That's a wrap. Our cross-platform coverage, guys. Alex is heading out. Romain and Scarlett continuing on TV. Tim and I are going to continue here on Business Week on radio, but we will all see you same time, same place tomorrow. Well, not Tim. He's going to take the day off.
Again?
Yeah, I know. Tell me about it.
And we continue our coverage right here on Bloomberg Television. Stick with us. Mark Gansey, the CEO over at Digital Bridge. He'll be joining us next. This is The Close on Bloomberg.
how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea, but ultimately you still have to do a lot with it. It just give you very superficial ideas, and but at the end you still have to customize it, how to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment. Yeah.
Are you concerned one day we won't be able to differentiate designs by AI and designs by an actual designer?
I don't know. For me, I feel that when a designer doing, it's the spirit, it's the heart that the computer don't have.
Morning, this is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. A really strong rally that we had here in U.S. equity markets here with an S&P 500 managing to close out the day higher by about 1.6%. Similar moves for all the other indices, with the Dow up almost more than 1% and the NASDAQ indices up more than 2% here on the day. You see the yield picture there, but I want to draw your attention to the two lines here on the screen. The VIX index at 15, that's actually lower than where we were right at the end of July before we started to see that volatility really start to explode. So we've done a complete round trip there. And you take a look at the XRT retail ETF here, having a phenomenal day, up 4% here. That's the strongest gain we've seen for that ETF going back to November of last year. And I think that might have to do with at least one big company.
Yeah, and that would be Walmart, right? It really tops the list of our big movers today. Walmart gaining 6.6%, closing at a record high here after a beat and raise quarter in which the CEO says we're not seeing any incremental fraying of our customers' financial health. So allaying some concerns about consumer spending here in the U.S. Meantime, AST Space Mobile gaining 51% on the day. The telecom company confirmed an early September window for the first ever, or its first ever, commercial satellite launch. And Sega Technologies down about 20%. It did plunge as much as 43%, so closing off of its lows. The drug maker said a study of its experimental therapy to treat